Hi. Okay, so good morning, everybody. My name is Cecchetti and I'm one of the organizers. Kai, Mikael and Tuomas are here as well, so you can wave a little bit. Yeah. And on behalf of all the organizers, warm welcome to Helsinki. The weather seems to be quite nice today. And this is, I actually don't remember, is this the 9th or 8th? The RiskLab, BoF and ESRB conference on systemic risk analytics. And I hope that you will have very productive 2 days in here and you will enjoy your stay in Helsinki. The conference opening will be given by Dr. Olli Rehn, who is the governor of Bank of Finland. Olli has been the governor and chairman of the board from 2018. And Governor Rehn holds a degree of Doctor of Philosophy in International Political Economy from the University of Oxford, and he has held many European and international posts for many years. He has been the Vice President of the European Commission, a member of the European Commission, where he was responsible for enlargement and then for economic and monetary affairs as well. Governor Rehn is a member of the Governing Council of the European Central Bank, and he has also held since this spring the position of the Vice Chair of the ESRB. So please, Olli, the floor is yours.
Thank you, Katja. Good morning, ladies and gentlemen, colleagues and friends. You are all warmly welcome to Finland and to the sunny Helsinki. As we were chatting before the conference, for the foreigners it's useful to know that the summer in Finland is short, but on the other hand it doesn't snow that much. And if you have any problems with light during the night, like I do, I'm maybe not a typical Finn, so I can recommend you black curtains and good eye covers. Finnair eye covers serve the purpose quite well. So that's the way of surviving the Nordic light summer. So let me welcome you to the conference on systemic risk analytics, which is jointly organized by the RiskLab, Tarkada, Bank of Finland and the European Systemic Risk Board. And as said, I also welcome you to the Bank of Finland, Suomen Pankki, which is the 4th oldest central bank in the world, established in 1811. So we have just been celebrating our 212th anniversary. In fact, there is a longer history of central banking tradition in Finland because the oldest central bank in the world is considered to be, or is the Swedish Riksbank, or Riksha as we call it. Riksbanken was founded in 1886. And at the time, Finland was an elementary part of the Swedish realm. So with that logic, we have the claim for the oldest and the 4th oldest central bank in the world. In fact, it was only rightly so that the previous governor, Stefan Ingves of Riksbanken, who just retired in December last year, Stefan served as 17 years as governor of Swedish Riksbank, and he originally comes from Finland. He's originally in Finland. I've tried to encourage Stefan to be more present in Helsinki as he has started to be, but I bet he is now on his summer cottage somewhere in Western Finland for the moment, which is probably the right choice. In my opening remarks, I'll focus on financial stability in the world of geopolitical fragmentation and rapid technological change. Meanwhile, I will not even touch upon monetary policy, as we have just started the ECB's silent period a few hours ago. As Governing Council members, we don't speak about monetary policy 7 days before the monetary policy meeting. Let me begin by noting that the global financial system and banking system have remained remarkably resilient after the global financial crisis, despite recently being hit by several waves of unexpected shocks. COVID-19, Russia's brutal and illegal war against Ukraine, and a sharp increase in inflation. However, the failure of Silicon Valley Bank and some smaller banks in the US, as well as the forced sale of Credit Suisse to UBS just 3 months ago, what has been called the March Madness, reminded us that we can never take financial stability for granted. With that in mind, I'm very much looking forward to soon hearing Professor Stephen Cecchetti's views on how to make banking safer in his keynote speech right after my opening remarks. Welcome, Stephen, to Helsinki. I also appreciate the strong focus of this conference on non-bank financial intermediation and climate risks. The role of non-banks and say money market funds and insurance companies in the global financial system has clearly been increasing recently. And it goes without saying that climate change, if not properly addressed, may create further serious risks also to financial stability. So, dear colleagues, in the last few years, we've seen that crises can happen at any time and take unexpected forms. Just after the world had recovered from the pandemic, the war broke out in Europe, and the geopolitical environment is currently changing as rapidly as it did in the late 80s and early 90s. At that time, the Berlin Wall came down, the Soviet Union collapsed, Eastern Europe broke free, Europe was united, and China was also integrating into the world economy. As a consequence, the world became safer and more prosperous place to live for a while. No end of history. Now, sadly, we are moving in the opposite direction towards a new Cold War and a breakdown in international cooperation. Autocracies like Russia and China are forcibly challenging the rules-based international order. The security policy environment of Europe is being transformed as fundamentally as it was 30 years ago, only this time in reverse gear. The current geopolitical headwinds are very detrimental also to the world economy. In the last few years, some have even predicted the end of globalization. Fortunately, though, the rumors of the death of globalization have thus far proven to be exaggerated. In fact, if you look at macro statistics, the volume of world trade has already surpassed its pre-pandemic levels and is now close to its record level. At the same time, however, protectionism and friendshoring are increasing and supply chains are being shortened. In the world of high geopolitical tension, strengthening and maintaining the resilience of the financial system has become ever more important. And to make the financial system more safe and resilient, we need rigorous financial regulation and supervision. We also need high-quality macroprudential analysis and macro policy, which is another key topic of this conference. Several sessions and presentations of this event are indeed devoted to the analysis of the impact of different macroprudential measures, both borrower-based and capital-based measures on households and banks, housing and labour markets, and even on tackling climate change. So, dear friends, let me try and complement the forthcoming presentations with some thoughts on how macroprudential policy making in Europe could potentially be improved. I have three observations in this regard. First, it would be useful if the application of the capital-based macroprudential tools, especially the so-called OC buffer requirements, was based on more uniform criteria across the European Union. In highly integrated banking markets, banks with equal or close to equal systemic importance should not have very different capital buffer requirements. Similar application of tools would foster a level playing field and reduce any pockets of vulnerabilities. Second, in the longer term, the borrower-based tools targeting housing loans and household indebtedness should be based on some minimum and common EU-level requirements. At the moment, those tools are solely based on national legislation, and they are frankly rather diverse across countries, too diverse in my view. In addition to credit institutions, these EU-level regulations should be applied to all lenders providing housing loans. Such regulations may not be needed right now, but they could be very useful next time when the lending cycle starts to rise again in the next credit cycle. And third, the EU legislation should explicitly allow, and forgive me the jargon, but I'm only using the legislative concept derived from EU law, European law, the use of the so-called positive neutral countercyclical capital buffer requirement. As this is an expert audience and not precisely a town hall meeting, I dare to use this concept. So positive neutral countercyclical capital buffer requirement. That is, national macroprudential authorities should be able to set that buffer requirement at a positive level during normal times. Meanwhile, in times of unexpected and or sudden crisis, the buffer could be flexibly released if needed in order to support bank lending and economic recovery. That's how countercyclical macro policy could be made work. So, dear friends, in addition to Stephen Cecchetti's keynote starting in a minute, I believe you are eagerly awaiting the other two keynote speeches of this conference, Alex Jung's presentation on machine learning and Michael Platzer's presentation on AI-generated synthetic data. Before those and before closing, let me tell you about my forgotten or unknown history in computer programming, if you allow me to share some personal experiences. In high school, that is only a few years ago, I was an avid member of our school's, it was called ATK Kerho, Automated Data Programming Club. And for the youngsters, automated data programming nowadays means basically digitalization and artificial intelligence. There we, for instance, practiced programming languages such as BASIC and Fortran after school, and we were writing codes. Unfortunately, the school did not have any computers yet at the time, so we did only dry runs. We wrote our BASIC and Fortran codes only on paper. Perhaps not surprisingly, the training matches of the local football club youth academy taking place at the same time began to feel more attractive, and I became a dropout from the automatic data programming club at the age of 12. Well, so the world lost one potential coder in me. I'll let you judge whether monetary policy was ultimately a winner or loser in that outcome. Up to you to choose. Even more seriously, the potential threats and opportunities of artificial intelligence and machine learning are, as you know, very hotly debated at the moment. I think we may assume that in the field of financial services, the developments in AI and machine learning can bring substantial benefits, for example, in risk management or, say, loan underwriting and customer behavior analysis. The developments may also help the work of financial supervisors. That said, I think we should be certainly aware of the potential dangers of the misuse of such powerful tools. And above all, we should improve our understanding of these fascinating technological developments, also in order to make better policy choices going forward. In that, the forthcoming keynote speeches will certainly be most helpful. With these words, let me wish you warmly welcome, and let me wish you a stimulating and productive conference and a pleasant stay here in Helsinki. Thank you.
So many thanks, Governor Rehn. The next speaker will be Stephen Cecchetti, who is going to give a keynote. So Stephen Cecchetti is the Rosen Chair in International Finance at the Brandeis International Business School. He is also the Vice Chair of the Advisory Scientific Committee in the European Systemic Risk Board, a research associate of National Bureau of Economic Research, and the research fellow of the Center of the Economic Policy Research. From 2008 to 2013, Professor Cecchetti served as the economic advisor and head of the Monetary and Economic Department at the BIS. And during this time, he also participated in the work of the Basel Committee of the Banking Supervision and Financial Stability Board, making also the regulations. The other jobs in his working life, he's been also the Executive Vice President and Director of Research at the Federal Reserve Bank of New York, and he has been the editor of the Journal of Monetary Credit and Banking. His academic record is outstanding, and we are very glad to have him here. So please, Stephen, the floor is yours.
Oh, okay. Thank you very much. No, that's not on. Okay. Sorry, just a second.
It's okay.
There we go. Okay, great. Thank you very much. Thanks for having me. It's wonderful to be back in Helsinki. It's a lovely day, and I have to say the last time I was here, the sea was frozen, so and it was very dark. So this is different. I wouldn't say that experience is bad. It's just different. So let me thank the organizers, thank Kaj Michael and Katja and Thomas for inviting me, and thank Governor Rehn for the warm welcome. I guess I could tell my stories about programming as well. I started programming using tape, which were but I think I'm older, so that's and there were I actually did get to run the programs though, so so that's somewhat of a difference. So my topic today is about bank regulation and supervision and the need for further improvements in the framework that we have. And I say further improvements not just because my time in the official sector taught me to use that terminology, because if you just say improvements, it means there's something bad. So if you say further improvements, it makes it sound somehow like you've done something good already. But in this case, I think it's actually true because, again, as Governor Rehn pointed out, the system that we have in place after the 2007-2009 financial crisis, the improvements in banking regulation, in insurance regulation, in resolution, in central clearing, there's this long list of things. I think it's clearly made the system much more resilient. Nevertheless, I think the low interest rate period of the past decade, during that period, systemic risks clearly built up, and we can trace those vulnerabilities to numerous sources. Some of them are deeply structural. There's this fact that institutions that are engaged in maturity and liquidity transformation are prone to runs. Whether they're banks or non-banks, it doesn't really matter. If that's what you're doing, then you're prone to runs. Others involve accounting rules. Accounting rules are clearly different across the world in ways that create problems. EU accounting rules look like they may be a bit better than US accounting rules, at least in some cases, but possibly not in every case. So I think we should be thinking about accounting rules. Many of us, I think many people who are trained in economics and finance probably learned accounting as a byproduct of what they were doing. Unfortunately, it's much more central to what we're doing now than we would like. And beyond that, I think there are problems associated with supervision, and the fact that supervision is probably, at least as far as I can tell right now, probably going to be difficult to the point where you don't want to rely on it too much. You need supervision in the same way that you need people enforcing speed limits, but it's not going to, you're not going to keep people from speeding all the time. That would be draconian rules. In the same way, supervision, I think, is not going to solve all our problems as much as some people like to hope. These weaknesses clearly came to a head in March of 2023. A few months ago, there was the failure of SVB and Signature Bank. These were two mid-sized banks. There was also the UBS purchase that Governor Rehn referred to of Credit Suisse, which was obviously one of the banks that was on the globally systemically important banking list. And the resulting turmoil has subsided, at least for now, but the circumstances made clear that frameworks regulation, supervision, and resolution are inadequate. So now I'm sure you're all familiar with the details of what happened in the United States and with Switzerland since March. But just to remind you, I'll go through a brief description of what happened at SVB. To fund its assets, which were growing very rapidly during the pandemic period, SVB relied almost exclusively on uninsured deposits. Those made up 90% of their deposit base. They didn't have a lot of other sources of funds beyond those deposits and their capital, which was dwindling. The concentration of these deposits was also in a small number of clients. The top 10 depositors, as far as we know, had about $13 billion out of $173 billion worth of deposits at the end of 2022. So that's a pretty high concentration. And clearly on the asset side, SVB failed to manage risk. I mean, this is an amazing thing from my perspective. It seems as if interest rate risk management is sort of like, that's the first thing that you do if you're running a bank. I mean, maybe you provide customer service and all this kind of stuff, but the very first thing that you do is you manage risk. And in the case of SVB during 2022, when interest rates were rising and known to be rising, and interest rates across the yield curve were going up significantly, SVB was actually increasing the duration of its assets by about 2 years. That's huge. So the asset duration, weighted average asset duration of SVB went up to about 5.6 years from something in the middle threes. So mid-threes, that seems sort of reasonable already. You know, you want to manage it, but allowing it to go up. Now, I should point out that we don't really know, or at least I don't know, how much of this was passive and how much of it was active. Some of it could be passive because a lot of the holdings of SVB were mortgage-backed securities, and the duration of mortgage-backed securities rises automatically during periods when interest rates are going up because prepayments fall. And so this is this convexity thing that I'm not sure what's convex about it, but financial risk managers like to describe it that way. But in any case, that could have been automatic. But the main thing is that this was rising, and at the same time this was rising, they were actually removing the modest interest rate hedges that they had and booking the gains that they had on those as profits. Now, if SVB had marked to market their unrealized losses at this point, my guess from reading their quarterly reports is that they would have been close to insolvent, close to zero capital, roughly in the middle of 2022, But even so, depositors were turning a blind eye to this. Investors were turning a blind eye. We know from the Barr report that supervisors were trying to do something about it, but it was very, very difficult to do something about it. The difficulty actually for doing something about it at the supervisory level came from two sources. One of them is the complexity of the system, something that's shared in a lot of other parts of the world, where you have to get a lot of different groups to agree before you actually sanction somebody. And that sort of, there's this tendency to have a race to the bottom when that happens. And the second thing is that there had been a relaxation at the level of the Federal Reserve's supervision. Federal Reserve supervision is, it's important to keep in mind, is extremely centralized. People want to blame the reserve banks and their supervisors. That's, in my view, incorrect, because the supervision is centralized at the board. It's a delegated function, and the supervisors of SVB were working for the Federal Reserve Board. They were not working for the Federal Reserve Bank of San Francisco. Now, in banking, like, attitudes can change very quickly. Most most depositors, not just you and me, but even very big ones, are ill-equipped to monitor the financial well-being of a bank. You know, if I asked all of you, what do you know about your bank's assets? My guess is, I don't mean those of you that are supervisors, what do you know about a bank that you supervise? The one where you have deposits, okay? I mean, I happen to have looked at mine because I like to ask this question, but my guess is that very few of you have actually bothered to look, and very few of you know much about it. And if you went and asked a bunch of people, if I went out and asked a bunch of businesses, even medium-sized ones, how much they know, the answer would be similar, that they haven't actually bothered to look at the assets of their banks. And even so, it would be somewhat hard because they would have to figure out how to look through regulatory filings or public disclosures, because the bank's not going to just hand them to you. So the point here is that most of us, including medium-sized firms, treat their deposits as safe and information insensitive. Yet if something happens, though, then all of a sudden we become attentive, and if you question the soundness of the bank, you're going to run. So what happened in SVB's case was that there was a series of things that happened, and then there was a lot of communication, and everybody tried to run at the same time. In the case of SVB, the trigger was something on the 8th of March in which they reported the sale of securities at a loss, which then required some accounting changes, and everybody realized that they were actually probably insolvent. And then they tried to raise capital, which is obviously something you can't do in a circumstance like that. So unsurprisingly, this led to this huge loss. And on Friday, March 10th, the California Department of Financial Protection closed SVB and appointed as the Federal Deposit Insurance Corporation as a receiver. Now, this news actually fueled the run on Signature Bank. Signature Bank was probably in much better shape, but it had lost a lot of business associated with crypto stuff. And also, Signature, I'm sorry, had a lot of mortgage lending, which if you tried to mark that to market as interest rates were rising, you're going to end up with some similar problems. Now, in order to keep these failures from turning into systemic problems, the FDIC, with this complicated approval process that involves actually the President of the United States, had a systemic risk exception, and it guaranteed all the deposits at both of those banks. Now, as I said here, this bank was systemic in death, but it wasn't systemic in life, and that's something that we really need to think about. Who's going to be systemic in death? And it turns out that these banks were. Now, I'm not going to go through the more complex story about Credit Suisse, except to say that they had a resolution plan, and that the choice of the Swiss authorities was not to implement that resolution plan. We don't know much about why that's the case. I hope that we eventually learn why it's the case, but I think that we do need to think very hard about the consequences of a globally systemically important bank having a resolution plan, having lots of cross-border activities, and having the home country choose not to implement that resolution plan. What does that mean for cross-border banking? Does that mean, for instance, that host countries are no longer going to really allow cross-border banking, and that they're going to force some sort of de-evolution? I don't know. Now, to continue with the story, the collapse of SVB and Signature, as well as the failure of First Republic, which came later, it came at the beginning of last month, this led to, I think, two important insights about the way that banking works. The first is, even, as I said before, even large uninsured depositors are not monitoring banks. Just because it's always, it's hard these days to give a talk, although I think that Governor Rehn succeeded in not mentioning crypto, but you had AI, so I guess that's a substitute at some level. So the story of Circle is an interesting one. This is a Boston, Massachusetts company that issues something called USD coin, which is a stable coin. It's an interesting case because in the crypto world, Circle is one of the very few organizations, in my view, that's attempting to be respectable. In the sense that they're very transparent about where they're located. They have audited financial statements. They're very clear about who their customers are and who they're not. They disclose the backing of these USD stable coins actually almost daily. So they may be facilitating criminal behavior because all stable coins facilitate criminal behavior, but they're not criminals themselves the way, say, Binance appears to be, and a number of these others. Coinbase is probably not criminals either. They just facilitate criminality. Obviously, my view of this is it's like, you know, we should probably shut it down. But that's neither here nor there. So Circle, interestingly, had a $3.3 billion deposit at SVB, the bulk of their deposits, by the way, are, just for those of you that are interested, are in something called the Circle Reserve Fund, which is a government money market fund that was created by BlackRock exclusively for Circle. Circle is the only qualified customer. This was an attempt at a regulatory arbitrage at one level. I think the hope was that they would be able to qualify for depositing the proceeds of the Circle Reserve Fund in the Federal Reserve's overnight reverse repurchase facility. The Federal Reserve got wind of this and banned it. That's somewhat of a different story. This is again an attempt by Circle to be respectable. But clearly Circle wasn't monitoring this. Okay, and so that I find to be interesting. Now, I don't have a lot of sympathy for Circle. Obviously, I don't have any sympathy for anybody in that sphere. But the other case here, which you may not have heard of, is extremely interesting and in some ways more revealing. This is a story about a company called Rippling, not Ripple. Ripple issues XRP and is a crypto thing. This is not a crypto thing. This is a payroll service provider that has thousands of small and medium-sized businesses as customers. Only the largest companies can actually afford to have their own payroll services. Having payroll services is an extremely complicated business. And so most people don't do it. I guess I only know about the country I live in. I don't know about other countries, but I would be surprised if I walked out to one of the shops here and asked them if they ran their own payrolls, if the answer would be yes. Because you need complicated things, and you know, laws are changing all the time, and it's one of those things where scale economies and scope economies really kick in very early. So this is an outsourced function, but what this means is that every week there are huge flows of funds coming into the account of the payroll service provider and then going out to the employees of the firms plural. And in the case of Rippling, the numbers were about $500 million. And they were running this through SVB. Now imagine what happens if between the time that the customers of the payroll service provider send the money to them, to the company, to the payroll service provider, and the time that the payroll service provider disperses the funds, that the bank fails. Okay? Now aside from the fact that this has extremely bad legal consequences for the firms themselves, which are actually liable for the payroll, the problem for the economy and the financial system is pretty bad too. Something similar. This leads you to think, I think, immediately also about medium-sized companies having operating funds that they need to run. So this whole story drove me to talk to the CFO of my university, which is a medium-sized company that has about $450 million a year in revenue, so it's not very big, and about 5,000 employees. And I went and I happened to know him, so I said, you know, what did you do, and how does this all work? And it turns out they have accounts between $30 and $60 million at any one time, okay? to run this thing, and but they're all at Chase. And in the aftermath of SVB, they started doing some other cash management. Now that's a big enough company to do its own cash management and to have a sophisticated finance and treasury office. And they also do their own. They contract out for software to do payroll servicing, but then they make their own payroll payments. But that I view as being a sort of a threshold. So even in a country like the United States, where there are something in the neighborhood of 18 million firms, I would guess that there are less than 5,000, probably less than 2,000, that are managing their own finances in this way. And even so, they have big, they're going to have big balances in there. So the point here is that the providers of vital services, as well as small and medium-sized enterprises, have large uninsured deposits, and they do this for business reasons that are very, very difficult to eliminate, and they are not expert at monitoring their banks, okay? Now, if we look at uninsured deposits in the banking system in the US as a whole, during the pandemic they grew substantially, and this was true for a variety of reasons. This is the black line, which is the percentage on the right. It's the orangish bar, the orangish area is the size of uninsured deposits. You can see the large increase in overall deposits that occurred during the pandemic in the US. And as I said, and much of it was in the form of uninsured deposits. Now, why is this happening? It's happening for a whole bunch of reasons. You had a very expansionary fiscal policies that were creating large transfers. You had expansionary monetary policies with central bank asset purchases, where the mechanics of the asset purchases easily result in the creation of uninsured deposits. You had large increases in buffers. Everybody's staying home, and so people aren't actually transferring the funds out of their deposit accounts. And also, policy rates close to zero means that the opportunity cost of holding deposit accounts was basically nothing. Nobody really cared. You wouldn't go to any trouble to move the money out. And when I talked to the CFO of my university, he said, "Oh yeah, we're buying more treasury bills." And so I said, "Well, how much are you paying for that?" And he said, "Well, we have this relationship with Chase, and they charge us 2 basis points." So I said, "Oh well, that's like nothing." So that was also somewhat surprising. Is that you can, if you have a banking relationship with a very large bank that's also a broker dealer, that you can buy sovereigns for almost nothing and shift the money into that, and shifting it in and out is not a problem. But we can see that in the aggregate there was an increase in deposits from about 14 to 20 trillion US dollars, most of which was in the form of uninsured deposits. Now that started to decline in 2022, and then it collapsed this year. That's what you see there. This is we only have quarterly data for this that's disclosed, but these are the approximate numbers. Now, these uninsured deposits were invested in long-term securities. That's what banks do, right? They do maturity and liquidity transformation. So if you ride the yield curve when interest rates are low, though, you're taking a lot of risk. And the risk shows up in this picture here, which I find rather startling. This is an updated version of the picture. This was disclosed by the FDIC for the entire banking system on the 28th of February. They publish these data quarterly, and the data are both for held to maturity, what in this part of the world is normally called banking book assets, that are kept at cost, and those classified as available for sale. And here's a very strange quirk of the U.S. regulatory system, that the available for sale securities, in the case of not all banks have to mark those to market for the purposes of regulatory capital. So it's flowing, the available for sale losses are flowing through to their profit and loss statement, but not to their regulatory capital calculation. So these are the two parts of this. If you mark to market the securities, and this is just the securities on these portfolios, and at their peak, you can see this is about $700 billion in assets that are associated with this, and that accounts for about 40% of the total regulatory capital in the system. Now, it's important to keep in mind that this doesn't include loans, and a lot of loans can be marked to market. At least there you can come pretty close to it, especially for things like insured mortgages and stuff. And if you do that, you more than double this number, and so it looks as if you just look at the asset side of the U.S. banking system's aggregate consolidated balance sheet, there isn't a whole lot of regulatory capital left. Now, this does bring up the issue about marking to market the liability side, which at some level seems like a rather strange idea. I remember vividly an argument in late 2008 by some big American banks that they should be allowed to market their liabilities because they'd been downgraded. If you're downgraded, the market value of your bonds actually will go down, obviously. But I'm not exactly sure why that should be profits to a bank. There's no state of the world that I can think of in which the bank is solvent where it actually gets to benefit from that. People make a different argument about this deposit franchise business, but marking to market the value of your deposits and claiming that they go up as interest rates go up, I think is rather odd. We can discuss that further if you like. Now. The thing is here that everyone actually knew what was going on. This is I'm not recommending this, but if you were to read not just the Barr report, but also the documents that came with it, which were quite voluminous, you would discover in their briefing materials for a briefing to the Federal Reserve Board on the 14th of February of 2023, which is a quarterly briefing by supervisors on the state of the U.S. banking system. And as of the third quarter of 2022, unrealized losses exceeded 50% of the capital of 722 banks. Now, 722 out of 4,500 about may not seem like a very big number, but it's kind of like an indicator of what's going on. And 31 banks had negative tangible equity at that point. And of course, these weren't getting shut down. And the question then is, why weren't they shutting it down? If I use publicly available information that we had by the end of February, we can adjust the risk-weighted capital levels for all of the mid-sized U.S. banks. The black dots here are reported regulatory capital, and these are clearly all above the 8% minimum, which I guess I should have had a horizontal line there, but let's not worry about that. The orange dots here adjust for securities losses, and the red dots include an estimate of loan losses. The highlights here are the 3 failed banks, but you can see the problems here, and you can see that that this was well known to banking analysts. This particular picture uses data that was provided to me generously by a friend of mine at Chase, JP Morgan Chase Asset Management, and they were computing these numbers, and they were publishing them in the junk that you get like in your email when you're on their mailing lists. You know, some of this spam is worth opening sometimes, it turns out. The problem is figuring out which stuff is worth opening. Now, we can also do another very interesting calculation, which is we can take those numbers that I just showed you, and I can plot them against the uninsured deposits as a percentage of total deposits. For the U.S. bank, for those U.S. banks. I don't have these are the ones for which I can do the match. The numbers are not there for everything. And if I go along to the right, I've got more volatile funding, and down I have riskier assets. Okay? And the point here is just to say that a bank can do one of 2 things, but it can't do both. It can either have volatile funding or it can have risky assets. Now, of course, you say, well, isn't that what liquidity regulations are supposed to actually address? And the answer is yes. These banks weren't subject to liquidity regulation. It's not clear to me that the liquidity regulation structure is sufficiently robust at this point to actually stop this anyway, because the banks and the banking system, the bank lobbyists usually manage to get the definition of high quality liquid assets expanded to the point where it's kind of meaningless. But the runoff rates aren't quite right and all that kind of stuff. But in any case, I think that the lesson here. The lesson here is pretty clear, and that is that the banks that we saw fail had some big problems. There's some more banks here which I think I would say are kind of at risk, maybe even still, and those are the ones that are the brown ones. The red ones failed. The red ones aren't with us, at least not in that circumstance. Oh, just as an aside, maybe similar to the story about somewhat about personal experiences in programming. This is about personal experiences in banking. It turns out that I had a CD from Signature Bank. And I just want to say that in the current circumstance, I noticed it when Signature Bank failed. I hadn't really been paying much attention. Again, back to the previous point. But it was seamless that from my perspective, that it changed name in my statements when Signature Bank failed, and then when it matured, it was redeemed, and I got all the money. So the system, in that sense, the system's working fine from the perspective of the totally uninformed depositor, namely me, So I think that's kind of interesting, and that was the case I think for all of these. First Republic, by the way, was a purchase and assumption, which always ends up guaranteeing all of the deposits. The standard way of dealing with these things is you sell them at a negative price, and that's essentially what happened. What happened there? Signature and SBB failed too quickly, at least from the perspective of the people actually doing it. Why they weren't ready, I don't know, but that's not my business. They were clearly ready for First Republic, and they had shopped it around before they shut it down. Okay, so what are the implications of all of this? Risk management at these institutions failed pretty spectacularly. Banking 101, they hadn't they didn't remember their lessons. Supervisors failed to detect obvious frailties at the weakest banks and failed to sanction them. The market discipline failed to punish the fragile banks. I was showing you a lot of market-based information, and the question is, why was it that the market price of these banks remained so high, basically until 2 days before they failed? But it did. Accounting rules vastly inflated regulatory capital, and deposits, in my view, are not a hedge against large securities losses. Now, the point here is if somebody makes this claim to you, and this is this deposit beta business, ask yourself whether or not in the worst circumstance the hedge actually works. So if people become aware that the bank is actually holding huge unrealized losses, will the hedge work? So you want a hedge that presumably works in the bad state of the world. This is a hedge that does not work in the bad state of the world. It's a hedge, you claim to this as a hedge, but then what happens is that everybody runs. So when you hit the bad state of the world, you get a run. I'm not sure, that seems to me to be wrong way risk, not a hedge. And then, as I said at the beginning, authorities are treating banks as systemic in death that they did not treat as systemic in life. So for the remainder of my time, how am I doing? I don't know how I'm doing. I don't know when I started. For the remainder of my time, I want to ask the following question. think about the lessons that we've learned from this, the deficiencies of the system that we have, and ask, what does the agenda have to be for reforms? Okay. Governor Rehn mentioned a number of important considerations that I think are somewhat EU specific for how it is that we want to work, that we need here to work on macroprudential regulation, which I view as being at least partially a governance issue. That governance issue exists in other jurisdictions as well. I mean, I realize the EU is in fact special in a lot of ways, but when it comes to stuff like this, the United States is so fragmented that it's hard to imagine it being any. It's actually, I think it's probably worse. For those of you that don't realize this, the U.S. does have federal level authorities, so national level authorities for regulation and supervision, of which there are about 7 or 8. But then every state has at least 2, and some of them 3 additional authorities. They have banking, they have insurance, and then depending on how they're working, they may have securities and pension fund regulation, although they may be inside of those other ones. It depends on how they're organized. But what that means is that you're looking at 150 regulators or something like that. So yes, of course, there's people who are kind of in charge and can give orders and stuff, but the system is hugely fragmented as well. When people complain about the U.S. at the federal level and the inability to harmonize or delegate properly macroprudential regulation and the battles that you see among, say, the Commodity Futures Trading Commission and the Securities and Exchange Commission, it's the tip of the iceberg. It's really far, far worse. Anyway, so I'd like to go through and ask what it is that we need to be thinking about. Turmoil revealed by the existing systemic frailties, we'll start there. I'll just mention very quickly what I think of as the unchanged regulatory and supervisory objectives and tools. Then we have to talk about the deficiencies of the system, the principles, and then I'll look at some regulatory reforms. And having set up a framework where I've looked at deficiencies and principles, I can ask whether the reforms meet those, address the deficiencies and meet the principles or not. So starting with these frailties, this is a repetition basically of what I said. Discretionary supervision is very difficult. There's a list of why. And I won't go over that again. I will, however, I do want to focus on the second one, which is something that I think is extremely important to keep in mind, and that's the fact that authorities have an impossible time, and I mean impossible, credibly committing to enforcing sanctions, limiting deposit insurance, limiting emergency lending, and implementing resolution plans. Okay. Now, what I want you to think about is put yourself into a position like the one that the authorities were in that Friday afternoon in the United States, where they were worrying about SVB and Signature Bank's failures. And ask yourself whether you would have insured the deposits or whether you would have risked the meltdown of the system. You have the option to insure the deposits. Clearly, it was in the regulations. It was a pain to do because you had to go through this whole process of getting all of these officials. The Federal Reserve Board had to agree, the FDIC Board had to agree, the Treasury Secretary had to agree, the President of the United States had to go, okay, fine, all right, that's fine. You can get all those people have telephones. It's not a big problem, okay? But the question is, would you do it? And I don't think my own introspection suggests that in almost any circumstance where the decision is do something that creates moral hazard that I maybe promised that I wouldn't do, or risk the system melting down with even a modest probability, I'm never going to do the second one. Okay? So this is something that we have to keep in mind. So we need a system, in my view, that recognizes the weaknesses of supervision. Again, we can have a discussion about what those are, but also the authority's inability to commit. And just to be clear, this isn't about individual people and like the weaknesses of their personalities or something like that. This isn't about that at all. It's about the it's about the nature of the system, and it's about the fact that you put anybody into that position, and this is what they're going to do. Okay. Okay. So to move on. It's important that we design the system, to take a step back for a second, let me just mention that I think that that as we see all of this going on, we want to keep in mind that we have a set of objectives, and those aren't changed at all. And we have a set of tools, and those aren't changed. So on the objectives, I really have sort of two objectives. One of them is I want to maintain the payment system. And the second one is that I want to maintain the supply of credit, okay? Beyond that, I'm, like everything else, sort of seems pretty second or third order to me. This is about financial stability policy and what the objectives are of financial stability policy. We can have objectives of all sorts of other kinds for all sorts of other officials and stuff, but this is what financial stability policy is about. And we really only have a couple of types of tools for this. We have balance sheet tools to affect the structure of the balance sheets of the banks. Almost everything we talk about actually is about this. It's about either capital regulations or liquidity regulations. And and again, we can have a separate discussion, and there's a whole separate conversation about static versus dynamic ones. I'm not a very big fan of dynamic components for capital requirements and liquidity requirements, with the exception of stress testing, mostly because I just don't think that they work very well. I'm not a fan of, by the way, of the countercyclical capital buffer. If you want higher capital requirements, just have higher capital requirements. Don't play around with these silly things, because then you have debates about indicators, and the indicators none of them really work properly. They're all backward looking. If you announce higher capital, if you announce a countercyclical capital buffer, you can't, it's not a tool like monetary policy, right? If you announce a change in interest rates or asset purchase programs, at 2 o'clock in the afternoon, the change occurs at 2:01. Okay, if you announce an increase in the countercyclical capital buffer at 2 o'clock in the afternoon, it happens 12 months later, or something like that, right? I mean, sort of like, but anyway, that's another, like I said, that's another discussion. On the safety net, we have lenders of last resort, where we need a set of rules, and we have deposit insurance as well. Okay, so what are the deficiencies of the system? Again, this is just a list that comes from the discussion that I had all the things I said a few minutes ago. Uninsured deposits are prone to runs. They're not a hedge against securities losses. Complexity is thwarting enforcement and promotes gaming. I've always had this view that rule-based regulation was so. If you write a set of rules, they're usually these sort of bright line rules. They're like they tell you exactly what you're supposed to do and not do. And you can think about this either as a set of rules for how to abide by rules, or a set of rules for how to cheat and go walk right up to the line, right? And I'm mostly think about them the second way, which is that people want to exploit them as much as they possibly can. And figuring that out is hard. Actually, just as an aside, I mean, if I was a supervisor, I would actually be intensively supervising exactly one thing on every bank's balance sheet, and that is where they're making the most money. If they're not making any money, I don't care. If they're making a lot of money, then I want to know. And that would be my rule. Show me where your highest return on assets is. Show me who's really making you money, because that odds are, so I don't believe in geniuses. What I do believe in is people hiding risk. And so I need to figure out where they're hiding it. And the only way to do that is to study the places where you're making a lot of money. Anyway, Changing preferences. This is again, it's not about personalities, it's about the fact that when you change personnel, different people have different preferences, different perspectives on the world, and that reduces the credibility of any individual set of rules, because the nature of the rules themselves, as well as the nature of the enforcement, can change depending on who's in charge. Accounting conventions, again, I've said this several times, are reducing accuracy of asset valuations. We know that there are inadequate regulations for non-banks that favor risk shifting into non-bank intermediaries. And there's a sort of throwaway at the end, which is that managerial compensation schemes encourage risk, and it's very hard, again, to do anything about that. So none of these are new. They've just been re-emphasized, I guess, by what we've seen. And so the question is, what can we do about them? So a set of principles for regulatory reform. These are my principles. I guess as Groucho Marx says, if you don't like them, I have other principles. But I think we can disagree about this, but I think this is a process that we need to go through if we're going to do any sorts of reforms. I happen to like very rule-based things. I myself live my life in a pretty rule-based way. I'll give you my adult children's telephone numbers, and they'll tell you that they lived in a pretty rule-based environment. Rules enhance credibility, especially with children. And if we treat our banks as children, then we want the same thing. You want them to be as simple as possible and certainly very transparent. I like strong rules. I think strong rules prevent you from having to do things that you don't want to do. And I think that our rules are generally not strong enough. I think the most important thing is to keep in mind that we really do want a system in which banks can fail without putting the system at risk. The way I've always thought about this is that when I think about bank failures, what I think about is, and as a sort of metaphor, a model for it, if you will, is I think about restaurants. I like to go to restaurants, but restaurants fail. And restaurants fail all the time. Just to give you some example, I've spent time off and on in my life living in New York City. New York City has a steady state number of about 12,000 restaurants that are registered, and it has about 2,000 new restaurants a year. Okay, so you can figure that out pretty fast. So, if my favorite restaurant fails, I may be sad, right? At least for a little while, till I found a new favorite. But it doesn't really affect my life that much. So I like to think about it, I can still eat. But if my bank fails, I probably am going to have a hard time even eating. So it's a big problem. So I need to make sure that my goal is to make the bank failures look like the restaurant failures. That's a sort of an unrealistic aspiration, but I think one to keep in mind. Okay, so what about reform proposals? And this is the last of what I have. There are two sets of reform proposals, two categories out there that are related to the tools, the sets of tools that I mentioned a minute ago. The first one is to strengthen the existing capital and liquidity standards. And the second one is to adjust or replace deposit insurance in some way. And some of these are pretty radical proposals, so let me talk about them at least briefly. And I just want to say that I'm going to list proposals. You can have other proposals, that's fine. But the question ultimately is, do the proposals adhere to the principles and do they address the deficiencies that are in the system or not? And that's how you want to measure them. So here are a couple of, here are 5 possibilities. When I started this a couple of weeks ago, I had more than 5, but it didn't fit on a slide. So So I figured this is a discipline device, right? It's a similar device, by the way, that you should use in financial stability reports. You should maybe restrict yourself to 5 risks. You know, except of course for the fact that the official sector is infinitely risk averse in its own way, and so it doesn't want to have something happen that wasn't listed. So that's kind of that's what pushes against it. But I think this is a discipline device that I kind of like. Anyway, so raise capital requirements. I would raise capital requirements. I would raise capital requirements significantly. And that I think, you know, it turns out if you raise capital requirements, the more you think about it, the more you realize if you raise capital requirements enough, that's probably about all you have to do. And so we'll come back at the end to what kinds of numbers I might think about. You could require subordinated debt for all potentially systemic banks. And this is an enhancement of the system that we have already in place. But what I have in mind here is a proposal that was made about 25 years ago, which is to force every bank to have laddered subordinated debt issuance. The subordinated debt could be relatively long-term, say 10 years, but there would be new debt that would have to roll over and have to be refinanced every 3 or 6 months. And that way you would get a market indicator of what people thought about the bank. You could strengthen and simplify liquidity requirements for a long time. I've tried to point out for some years now that the LCR and the NSFR are actually mirror images of each other. They're duplicating. There's really no reason to have both of them. And the NSFR is like really complicated and has a lot of cliff effects and stuff. And so I would focus on the liquidity coverage ratio, although I would do it with I would change the runoff rates, and I would change the size of the window. I would have the window roll off, by the way. This thing that up to 30 days the weight's 1 and after 30 days it's 0 seems pretty ridiculous. Why not have a slope to that and have the runoff rates be more associated with what you actually see out there? I would also probably pretty much limit what qualifies as high quality liquid assets, and I like committed liquidity facilities. But that's those are details. We need to modify financial accounting rules. We just can't live with this for much longer. It's creating huge problems. We need to shift to mark-to-market accounting for as many assets as possible that are on banks' balance sheets, and we need to stick with it. You can smooth it if you want. You don't have to do it. I'm not talking about mark-to-market accounting on a minute-by-minute or day-by-day or even week-by-week basis. But if you did it quarterly on average prices over a quarter or something like that, and you publish that would be pretty informative. We also need to improve stress tests. We're not running stress tests very well at the moment, if you ask me. As I point out here, you want to stress what's profitable, that's for sure. You want to include non-banks. You want more than one scenario. I'm a huge fan of reverse stress tests, and I'm not sure why we can't run them. Banks whine about the costs of running stress tests, and that running reverse stress tests is too costly for them. Well, why? I mean, this is a technology question. It's something that we should be able to fix. The other thing is that there are these, what I view as very odd complaints sometimes about the stress test scenarios being worse than anything in the historical experience. Well, if you're going to do only one-shot stress tests, which is what we know how to do, we don't know how to do multiple rounds, where you have banks reacting and then you do it again and like that, then having them worse than the historical experience seems to me to be the right thing to do, not the wrong thing to do. But those are, again, second-order problems. Moving to deposit insurance, so those are the 5 things there. The first thing is to eliminate, this is a peculiarly US thing. This is from my email from the 23rd of May. I got an ad from Vanguard offering me, since there are 2 of us, $2.5 million worth of deposit insurance. I was actually surprised it was so low. Because if you broker deposits, there are 4,400 banks or something like that. I mean, you know, I could have a $250,000 deposit that's in each one of them, and under the current rules, they would all be insured. Okay, but the point is that I'm getting on my email an ad offering me $2.5 million worth of deposit insurance, which is kind of weird. But this is a pure regulatory arbitrage. It's a product that was created by a company called Promontory, which has since changed its name, but you may know it as Promontory, and they do this deposit brokerage thing. The other possible refinements to this current system, the first one is to target increases in the caps for SMEs. So I was describing the problems associated with Rippling, Circle, for whom I have less patience, and the operating balances that would be associated with medium-sized enterprises, which can get fairly large. You might want to produce caps for deposit insurance that actually gave them safety, the people that were running those businesses, and so that they wouldn't run. You could have 100% deposit insurance for everyone, which is what we seem to have ex post largely, and so that's something to worry about. If you have it ex post, then you probably have it ex ante because you can't credibly commit to not having it. And so if people are behaving as if you have it, then they're taking the risks that are associated with it, and you want to deal with it. The other one is to replace, I'll describe this in a little bit of detail in a minute, Mervyn King's idea of a pawnbroker for all seasons. This is an idea that all the liabilities, all the liquid liabilities in the system have to be discountable at the central bank. So let's talk about that for a minute. So the idea here is that if you issue a liquid deposit account, you must have assets that are worth that much pre-positioned at the central bank and eligible for central bank lending after the haircuts. Okay, so you know you've got a security. You issue a deposit that's worth $90 or 90 euros. You have a security worth 100 euros, and with a 10% haircut, you have to pre-position that at the central bank. So 100% of your liquid liabilities. This is sort of like a committed liquidity facility where the liquidity coverage ratio is 100%. On all liquid liabilities. And it applies to the entire financial system, not just to banks. So money market funds would have to do this as well. Anybody that's issuing a liquid liability. In fact, an open-ended mutual fund with daily redemption would also have to do this. Okay? So the interesting thing about this is that the haircuts for the bank assets are going to determine the capital requirement effectively. It completely substitutes for deposit insurance. If you do this, you do not need deposit insurance at all because the deposits are all backed by the central bank. Now, one of the things you got to think about is if you do this, the haircuts that the central bank sets are going to drive credit allocation in your system. We can have a discussion later about whether or not the Eurosystem's collateral framework's already doing that with its 25,000 securities and 120 or 50 or whatever it is haircut categories and pricing that is daily by some machine sitting in the bowels of the Banque de France someplace. But anyway. This would be a huge change. Nobody has tried to do this, so I don't really know. I don't know how it works, but it might be worth it. So the final thing that you could do is you could create narrow banks. Okay. Now, I am not at all a fan of narrow banking because I don't believe that narrow banking actually fixes the problem. What it does is it shifts credit supply outside of the banking system, and the things that are doing the credit supply then are going to do the maturity and the liquidity transformation instead of the banks, and they're going to get run instead. Okay, so, okay. Now, what that means is that we could, if we wanted, have narrow banks inside of our current banks, but we don't have them, and the reason that we don't have them, I think, is that they're expensive. And nobody wants to pay for this. So that's interesting. And just as an aside, central bank digital currencies are a form of narrow banks because, of course, they're brokered. I believe there should be the equivalent of there should be like a CBDC, a treaty across the world, like the nuclear test ban treaty, that everyone agrees not to issue central bank digital currency. Because as soon as a large jurisdiction does, there's going to be a rush to do this. And as soon as that happens, you're going to see like the financial systems and the monetary sovereignty of small, unstable countries just get demolished. And the banking systems inside the countries are going to have huge problems. But again, a different discussion. So how can we evaluate the proposals? Do they meet the characteristics of the robust framework that I set out, and do they address the deficiencies? I have a table, which I'm not going to go through. I think the slides are going to be available, and I'm eventually going to write this up. So if you look at this, and so the green things mean that you're doing pretty well. The top are the principles and the bottom parts are the deficiencies. Higher capital requirements are great. Higher capital requirements, as long as they're high enough, do a pretty good job. And some of the other things work pretty well too. The Mervyn King's proposal works very well as well. But some of these things, the orange things make it worse, not better. So some of these things, add to complexity. Some of them are very inefficient. Some of them make deposits more prone to runs and the like. So anyway, this is an evaluation. So if you look at that and you ask sort of where are the priorities then for reforming the system, this is my list. Higher capital requirements, always higher capital requirements. Recalibration of liquidity requirements, pretty straightforward. Improvements of stress tests and modification of accounting standards. I think those are things that we should be able to do. Other things are more radical and maybe we can't do. Although if I was running a small advanced economy like New Zealand or something, I might think about the last one pretty seriously. And so finally, in conclusion, the turmoil that we saw revealed a bunch of fragilities in the system. I think it's essential that we address the reform. We agree on reforms. These reforms have to acknowledge the weaknesses that we face in supervision. So don't load it all on supervision, and build a system that is based on the assumption that authorities can't credibly commit to various things that they could change. And my priorities are, as I said, something like a 15% leverage ratio. That's probably where I would start, and then these other things. The 15% leverage ratio is, of course, if your risk density, the risk density in most of the world is now over 2, so that's a risk adjusted requirement in the range of 30 probably to 40%. And that's not too different from TLAC requirements, but it's capital, not debt. So, and with that, I'm happy to. I don't know what the rules are here, but if you want to have further discussions now or later, I'm happy to do it.
Okay. Many thanks, Stephen. I think we have time for a couple of questions, maybe. Yeah. So, any questions?
So first of all, thank you for a very interesting presentation. I had a question on this mark-to-market accounting suggestion that you propose, because I get how you would do that on sort of assets that are in an open traded market. But if you look at the banking book, most assets aren't really on a traded market. Like if you take mortgages or if you take consumer loans, at least, for example, if you take Nordics, there isn't really a traded market for them. So how would you then circumvent the banks would basically have to treat them as like level 3 assets that they have a huge, very opaque apparatus about valuing?
So I guess the first question is whether or not they're discountable at the central bank. Are they available? Anything that's available for in the euro system for refinancing is priced. It's priced by that machine at the. I remember. So the 25,000 used to be more on the public list, which, as you probably all know, and this is a pretty informed audience. You can download the spreadsheet daily with all of the list of securities. So that's the start. Those are all priced. And only about something in the range of 5% or so have market prices, but the rest of them have model prices that are generated. And so I think that while you're absolutely right about the true level 3 assets, those of course are not true level 3 assets. So a lot of what's on the bank's balance sheets is, in my view, going to end up being you can in principle price it. Now, of course, in the king view, you're going to have to be able to price everything. So I think that I agree that it's an issue, and I agree that the level 3 asset problem exists. But I think you should be pricing what you can price. Now, is that going to drive more banks to more level 3 assets rather than the stuff that's priceable? I'm not so sure. Maybe it'll drive the priceable stuff into other forms, and that might not be good. But we'd have to think about it. So, okay, thanks. It's a good question.
Okay, thank you.
Oh, Nikola, hi.
I have a question. Actually, first, thank you very much for your thought-provoking speech, and also, more importantly, a very entertaining speech. Thanks for this. I wanted to emphasize 2 points that I strongly agree with. Your point about bank failures, bank exits. Yes, I think that is a very important point to keep in mind. We don't see enough bank exits, and not only bank exiting when they fail, but exiting just because their business models are not good enough. There are a lot of banks like this in Europe. One of them had to fail to exit. Others are still there, even though their business models are very, very weak. We don't see these exits, and that is weighing on the financial system. The other point I strongly agree with is the one on the disciplining function and subordinated debt plays. If TLAC is a very complex structure and creates lots of complexities in the system, but if there is one benefit to it, is that it creates the incentive to have a subordinated debt in the capital structure, and this has a very important function to play in the financial system. So my question has to do with maturity and liquidity transformation. Up until slide 23 or so, I thought you were arguing against this, that you're going to set up a structure in which you're going to completely suppress maturity and liquidity transformation or eliminate it. And that is because it was actually not one of the objectives that you listed, keeping maturity and liquidity transformation in the banking system, because we know how to do it, and that has been there for quite a bit of time, and it has provided social function. But then afterwards, you spoke against the narrow banking. So it seems that you are not trying to drive the system in that direction. I still see that there's some kind of inconsistency in that regard. So how are you going to limit, increase liquidity requirements, strengthen them, mark everything to market, assume away deposit franchise and still keep maturity and liquidity transformation in the banking system?
Thanks. It's a good question. So first of all, on the failure, I mean, it's very interesting that so we have seen a recent failure in the U.S. of a bank that's business model failed, an exit, not a failure, which is Silvergate. So I think there are models for that, and so then the question is, how do you actually translate that into the ability of other banks to fail or to exit? And I think that you're absolutely right, and I hadn't thought about it in those terms that we need exit. On subordinated debt, I have very mixed feelings. I like it in principle, but I think that capital's better. So if I can force people just to hold capital instead, so let me just say that I think that the complaints. So the complaints of the banking system that capital is expensive are accurate from a private but not a social perspective. I believe that they're telling the truth when they say it's expensive for them. It's expensive largely because of in most jurisdictions the different tax treatment of interest and dividends. Okay, but presumably the CFO of the bank is in the business of equating the marginal cost of all types of liabilities. So they're actually at some level taking into account tax differences, enforcing Modigliani Miller on their liabilities. Okay, so given that the difference between the cost of debt and equity to a bank is caused by tax distortions and externalities associated with government guarantees, I don't see why we don't just force more equity. So that's my argument on that. I think that we do need I do need to think about your question much more, but let me just say that I didn't mean to imply that maturity and liquidity transformation should or could go away. I do believe that banks are in the business of providing liquidity on both sides of their balance sheet. A lot of the problems associated, or at least one of the big problems associated with some of the radical proposals is how do you deal with lines of credit and how do you deal with repo? Now, you may say repo's bad, I don't want repo, but I'm not sure that's a reasonable conclusion. You certainly, I think no one would think that lines of credit are bad. And we all have lines of credit, actually. Every single one of us have lines of credit. And we also have, but by the way, I would guess that we all have unsecured lines of credit. Okay? I know I do, because I probably used it last night when we had dinner. So I think that, so we need that. So you're right, I have to think more about the internal consistency of the argument because I don't want to get to the point, I don't want to leave the implication that you said. So.
And then we have final question from Tom.
I think it's on. Oh, now, yeah, okay, I think.
Thank you very much, Steve, for the excellent presentation. Actually, a few quick questions. So, first of all, do you think you mentioned that not many of us know about our banks, but I'm actually not sure that even, let's say, the supervisors know enough about their banks. So the question is, do you think we have enough information, enough data, enough up-to-date information about our banks, and how actually the information could be also made more public so that the people actually, so there could be more market discipline, and how this information could be usable so that the people could actually distinguish easily and the firms which are good banks. And then the second question is, it's hard to not to agree with your reform ideas. The question is, how do we get them done? And what is preventing us of not having them already in place? Because I think many of them make sense. But then the question is, if we implement all this, we have so-called non-banks or things which make bank-like activities. So how do we then make sure that indeed, if we, let's say, regulate a lot the banking system, that then the activity and the risks don't shift there. So how do we make the level playing field for the banking type of activities? Thanks.
People ask hard questions. Okay, so some of these are homework questions, I think. So on the first one, about information, the short answer is no, we don't have enough information. I'm not optimistic about getting it. And so I think that we need a system where we accept that we don't have it and that we're not going to get it. And this isn't really about, again, it's not about people, it's not about banks per se, it's about not knowing what we really need. And where we really need to look. So that's why I think we need a system that's robust under as many possible states of the world, under the assumption that we don't know what's going on. And this just brings me back to capital. On how to get the reforms done, I think that's actually difficult, and there I would point to the fact that the first step in getting reforms done is to stop listening to the banking system, and remember that the banks are creating externalities. That means that we're imposing costs on them in order to get them to internalize their externalities. If you're imposing costs on somebody that's creating externalities and they come to you and scream and say, "This is really expensive," your answer should be, "Yeah, it's supposed to be. You're doing bad stuff. You know, you're creating pollution. I need to get you to stop creating pollution. And that's going to be expensive." So the first thing is to accept, and this I think has to be a rule for all people making regulations and all supervisors, which is if the banks are not screaming at you, you're not doing your job, okay? That's a precondition for actually knowing that you're doing your job. If they stop screaming at you, then you're being too lax, okay? So how do we get that done? Well, we have to get across that idea across to the politicians and all the public officials, is that this is an externality that they should think of the same way they think about pollution, okay? Maybe in this way we could maybe use the climate stuff, which I don't think creates systemic financial risks. We can use that as I couldn't resist, Paul. Which we as a model for this, because we've managed to succeed in getting them to understand that this is a problem, right? That climate risk is a problem and climate change is a problem. So it's the same way as that. On non-banks, we've spent 15 years failing to address this. We know it's a problem, and the question is whether or not we can move towards functional, or some sort of function-based regulation, and I just don't know the answer. But I think I've gone on for too long, so thank you all very much for your attention, and I look forward to listening to all of you talk now that I'm done. So.
Okay, many thanks. Maybe we can continue the discussions of the refreshments, because I think that there are some coffee and some other drinks as well.
Okay, let's continue, everybody, and welcome from my side also. My name is Kai Mikael Björk from RiskLab Finland. And in this first session, we will start with the first talk entitled Uncertain Credit Loss Phases and Bank Capital, and it's Nikola Tarashev from Bank of International Settlements. The floor is yours.
Thank you. Thank you for the organizers for the possibility to participate in this event. This is joint work with Mikael Huselius, who is also in the room, and the usual disclaimer applies. So, as some of you might know, Steve Cecchetti, who spoke before me, he was my boss. He said we should be talking at most about 5 risks. So in accordance with that, I'll actually be talking only about one risk. It will be about credit risk. Not that the others don't matter, but that is the focus of the paper. And it all starts with a simple observation that there is a credit cycle. So that credit losses, they tend to stay low for prolonged periods of time, and then all of a sudden they spike up and they come back down again. So there are these high and low loss phases. What is important to us is that these are actually very difficult to predict. The turning points in the credit cycle are very difficult to predict. There are quite a few papers in the literature that are actually extremely skeptical that it's possible at all to predict these turning points, and I cite them there. Mikael and I, in a companion paper, we're actually less skeptical about that, but we do believe that there is some possibility to predict these turning points. But even we are not very difficult to convince that material uncertainty does remain, and it is actually very important to take into account. And what uncertainty calls for are prudential safeguards, basically capital buffers, very often in the spirit of what Governor Rehn referred to earlier as this cycle-neutral capital buffer. Now, these buffers are actually costly, and for this reason, it is important to know under what conditions the benefits of having the buffers are particularly high, so that the cost-benefit trade-off is actually in the bank's favor. And this is the question that that's the main question in the paper, the question that we're trying to address for the rest of the talk. So what we do in a nutshell, we're going to implement a very parsimonious extension of an already parsimonious risk model that serves as the basis of regulation for credit risk on the banking book. And this model allows us to take into account uncertainty about credit losses and how a bank's problem changes when they take this uncertainty into account. We will see that this uncertainty leads to a decoupling between expected losses, which is kind of the average probability of default in the portfolio, and unexpected losses, which are a high percentile of the loss distribution minus expected losses. So typically expected losses are taken into consideration through provisions and unexpected losses through bank capital. Now, and then we're going to ask 2 questions. How does exposure to macro risk factor within a credit risk phase, and that exposure is captured by one parameter rho, which will be coming up later again. How does such exposure affect the failure probability of a bank that ignores phase uncertainty? And how does this exposure also affect the benefit of improving forecasts when you are aware that there is uncertainty? What are the benefits of improving these forecasts of turning points? What we find is that ignoring uncertainty is more important and bites more if the exposure to the macro risk factor is smaller. So that means that if your portfolio is actually more diversified, you you're more exposed to failure as a bank if you ignore uncertainty. And the same logic applies as regards the impact of improving phase forecasts. So it's better to improve your phase forecasts if you have a more diversified portfolio. Now, given this finding, then this begs the question, so is it possible to actually tell apart two portfolios, like rank them in terms of the diversification? And we believe that it is possible on the basis of the unconditional distribution of losses. And we'll look into the shape of that unconditional distribution, and I will try to elicit information from that shape as regards portfolio diversification. So this is the roadmap. I will describe the stylized risk setup. Then I will show you how the decoupling between expected losses and unexpected losses occurs. Then we'll study the shortfall of loss-absorbing resources that arises either because a bank ignores uncertainty or because it just has uncertainty. There's nothing it can do about it. Then we'll do this comparison of exposure to the macro risk factor or the portfolio diversification across portfolios. And finally, if I have time, I'll talk about takeaways. So the model that is behind what I will be talking about is called the asymptotic single risk factor model. Asymptotic because we assume there are lots of exposures in it. None of them are very big, so we can take a limit. This limit allows us to stop thinking about idiosyncratic risk. Then the losses at any particular point in time are given by that formula, which I will now try to explain. In that formula, there is one risk factor there's one risk factor and the rest are parameters. So the risk factor is GT. This is the macro risk factor, the thing that is that actually drives deposits, drives defaults away from the expected level. The loading on that factor, rho, is first there's no I there, so we assume homogeneity in the portfolio, just not to worry about differences in the exposures and only think about uncertainty about probabilities of default going forward. So no parameters have, all parameters the same across exposures. So rho is the loading on the common risk factor. The higher is rho. The less diversified is the portfolio, the higher is the volatility of losses at any point in time. And as rho declines, eventually the portfolio becomes extremely diversified. And at the limit of rho 0, we see that the loss is exactly equal to the probability of default. Now, even though rho has a time subscript there for most of the talk, it's safe to assume that rho is just fixed over time and it is known. That's our assumption. The key, the uncertainty comes through the modeling of the probability of default, PDT. And we'll model uncertainty by imposing a two-state Markov process that captures phase switches. And we will here we basically show that fitting such a model does a pretty good job in terms of fitting real-life losses on different portfolios of US banks. So for that Markov process, we need several parameters which are at the bottom of the screen. The probability of default in the low state, probability of default in the high state, and the probability of actually staying in one state or switching states. And for the purpose of the talk, these parameters are also going to be time invariant. Alpha is the target regulatory parameter that we'll get to in a minute. Now, I will be talking about 3 banks that kind of help us fix ideas about uncertainty and different attitudes towards uncertainty. But the 3 banks are going to have the same objective. They will build loss-absorbing resources, which is provisions and capital, to ensure that their 1-year probability of failure is alpha. That is the parameter that I mentioned earlier. Alpha is typically a very small number, 0.1% over a 1-year horizon. And loss-absorbing resources equal to expected losses and unexpected losses. So first we'll start with an informed bank, which knows the probability of default in the state. So the state knows the probability of default. And this bank can basically apply directly the standard asymptotic single risk factor model as in Basel III, and it sets its loss-absorbing resources according to that formula. And then those can be divided into expected losses and unexpected losses. So this bank for us is the benchmark bank. Then the second one, probably more realistic, is the uninformed bank, which faces now uncertainty about the probability of default. It doesn't know which state it is going to be in over the horizon over which it is over the horizon for which it is building loss-absorbing resources. So for this bank, then the loss-absorbing resources they come out of a more complicated function, basically which takes into account that this uncertainty. So if you just look at the first term, it is the probability of finding yourself in a particular phase. Times the probability that you will, if you are in that phase, the bank will fail if it is to have loss-absorbing resources of the amount of capital lambda. Plus doing the same thing for the other state, and summing these probabilities up, this has to equal alpha, which is the target probability of failure. And then the loss-absorbing resources lambda that solve this solve implicitly this equation are those that attain the loss-absorbing. They attain the target probability of failure. And third is the naive bank, which has the same information set as the uninformed bank, but it ignores it. It ignores the fact that it is uninformed, and it pretends that it knows the state. So basically what it has the same unbiased forecast of the probability of default, which is equal to its expected losses. So the expected losses of the naive and uninformed banks are the same. What changes now is that the naive bank treats this expected loss as the actual probability of default, because it thinks that it knows the state. So, given that it is blissfully ignorant, its loss absorbing resources are actually determined by a simpler function, and which has the same form as that for the informed bank, but we know that in this particular case it is misspecified. So these are the three banks, and I will play with them in order to see what happens if there is ignorance of uncertainty, and if there is uncertainty just to begin with. But before that, I would like to just get across the point that now there will be decoupling between expected losses and unexpected losses. So the decoupling can happen already in the context of the traditional ESRB model that is used by Basel III. If we think of this loading on the common factor rho parameter, which is the loading on the common factor that is active in each of the phases and which determines default clustering. So that is depicted by the left-hand panel on the slide. The left-hand panel there. So you can think of two banks. One of them has a portfolio in which the loading is low, and towards the left of the panel, another one has a portfolio with a high loading. The second bank faces losses with a high volatility. High volatility means high unexpected losses. The two banks, however, have the same expected loss because this loading on the common factor does not affect first moments. Okay, so that is standard. And that is the only way in which the expected loss and unexpected losses could decouple in the Basel model. And actually the Basel model rules this away because it assumes that rho is a function of the probability of default. Now, for the rest of the talk, I'm going to assume that rho is fixed for the bank, and we'll be comparing probably banks with different rhos. But what will be driving the decoupling between expected and unexpected losses is uncertainty about the probability of default. And again, here in this proposition, we just come up with two different scenarios in which we kind of model two different banks, one of them with lower uncertainty about the probability of default, the other one with a bigger uncertainty, and the bigger uncertainty, a bank facing a bigger uncertainty actually faces a high unexpected loss. All right, so that is probably straightforward. Now, let's see what happens if a bank, so in this case it will be the naive bank that we modeled, it ignores uncertainty. What happens to its loss-absorbing resources and its probability of failure? So in order to determine this, we have to be very careful which perspectives we are taking. So we're going to take the perspective of the uninformed bank and evaluate from that perspective the loss-absorbing resources and the probability of failure of the naive bank. Okay, so the two banks have the same information sets. So from the perspective of the uninformed bank, the naive bank has a loss-absorbing resource shortfall, and that is just a direct implication of proposition 1. Now the question is, what happens to this shortfall? Under what conditions the shortfall is particularly pronounced? And for this, we put ourselves in a situation in which today is the low probability of default phase, and here we're considering different banks. Each dot on this plot corresponds to a bank with a different portfolio. Across the lines there, it's the uncertainty about the probability of default that is different, and along a line, it is the exposure to the default clustering factor within a phase that is different. And we see that it doesn't matter which level of uncertainty the naive bank is effectively facing, if its exposure to the common default clustering factor is actually lower, its probability of failure increases. Its probability of failure is higher, and it actually, irrespective of what the level of uncertainty is, the probability of failure converges to one number, and that number is actually the probability of switching to the high probability of default phase. Now, what is the intuition behind that? To see the intuition, here we're plotting the unconditional distribution of default losses from the perspective of the uninformed bank. And the middle two panels actually are quite telling about what's going on. So the middle two panel, they show that there are two factors of that play. The first factor is the phase switching factor, in the Markov process, which basically results in there being two very distinct parts of the distribution. And then the volatility within each part is driven by this macro risk factor that operates within each credit risk phase. So, and the more important is this macro credit risk factor, the more spread out is the distribution within a phase. Now, so this is the distribution from the perspective of the uninformed bank. The naive bank is ignorant about this, so it thinks that it is aware of what the phase is. So basically, what it perceives wrongly is a probability distribution that lies somewhere in between the two humps. So what that means is that it underestimates the high percentile, which comes from the high probability phase, And that is the high percentile that is telling it how much loss absorbing resources needs to hold. So because it underestimates the high percentile, it's going to have a loss absorbing resources shortfall. However, it doesn't have to fail all the time, and it's going to fail less frequently if this common macro risk factor actually plays a big role, because even in the high probability of default state, this macro risk factor could happen to be actually quite benign, and in this way cover up the underestimation of the naive bank. Now, this is more likely to happen if the common risk factor plays a big role. But as the portfolio becomes more and more diversified, the role of that macro risk factor declines, and in the limit here, where rho is equal to 0, we actually have the probability of falling in the bad state. That is the probability of having not enough resources for the naive bank, and that is when the naive bank is sure to fail. So similar logic applies if we look at the Dilyara shortfall due to uncertainty, and then we compare the uninformed and informed bank. Under the same, basically pushing the same logic through implies that greater portfolio diversification makes it worse to miss a phase, and missing a phase is more likely to result in bank failure. Now, given the importance of the two of this loading on the common risk factor, so the question now is, can we actually compare portfolios on the basis of this and just basically say, okay, it is really important to worry about uncertainty in that portfolio, not so much in the other one. So the logic of our empirical exercise is again rooted in this picture. It basically says that, well, the shape of the unconditional loss distribution, or the modality of the unconditional loss distribution, is very different depending on how diversified the portfolio is within a phase. The more diversified the portfolio is, the more likely it is going to be that a test is going to reject a unimodality null hypothesis, because the two modes are more pronounced. So we push this logic, and on the basis of it, run a battery of tests on unimodality. We imply these 3 tests on the total portfolio that the US banks are holding, or just on the business sub-portfolio, the real estate sub-portfolios for which we have data. And we see that we can reject the null hypothesis of unimodality in the case of the business sub-portfolio, but not the real estate sub-portfolio. Now, we do some robustness checks in the paper because these results could be due to relatively small sample size. We use with Monte Carlo simulations on the basis of our estimates of Markov switching parameters, and on the basis of basically changing the value of rho over a grid. And this Monte Carlo simulation exercise basically at the end of the day confirms that our conclusions about modality are quite robust. And the upshot is that the business loan portfolio is statistically significantly more diversified than the real estate portfolio. So this is just an example that with real world data, it is possible to tell apart the level of diversification. And with this, let me conclude. So there are some real world takeaways from the comparisons that we make between these two very stylized banks. If we compare the uninformed with the informed bank, we saw the importance of improving forecasts. In this context, it is for us what is important to take home is this decoupling between expected losses and unexpected losses. Decoupling means that there isn't a single summary statistic that kind of captures the entire loss distribution as assumed under Basel III. So which means that when one forecasts losses, one has to forecast different parts of the loss distribution. In order to forecast different parts of the loss distribution, it is important to to take into consideration different forecast or explanatory variables. And in the companion paper that I mentioned earlier, we find that debt service ratios and credit to GDP gap actually come in with very strong forecasting power. Now, no matter how far we push the improvements of forecast, we'll have to accept that there will be limits to our forecasting capacity. So the uncertainty will remain. And then what most of the paper is arguing for is to show under what conditions building buffers or loss absorbing resources as safeguards against this uncertainty is particularly important. And the main takeaway is that the more diversified your portfolio is, the more you should worry about uncertainty, and the higher should be the safeguards. Thank you.
Okay, is there any questions from the audience here? Yes.
Good morning, Javier Suarez. Can you hear me? So thank you for the paper. I just wonder whether the terminology more diversified is a standard, and my self-answer is not, because what you call diversification is low raw, which is low exposure to the common risk factor. So a perfectly well-diversified portfolio will have a non-trivial correlation to the single risk factor. So a low raw portfolio is actually a strange portfolio of exposures that do not move with the aggregate macroeconomy, right? So it's more like a zero beta portfolio in a portfolio selection context. So I will not call it a diversified portfolio. Otherwise, I like very much the approach and the Markov switching perspective on probabilities of default.
Okay. Yeah, it's a point well taken. In principle, that the portfolio is fully diversified for any row because we assume that it's asymptotic, so all idiosyncratic risk is gone. And now, at the same time, we know that all of these models are some kind of a metaphor or simplification of reality. So the more our thinking is here is that the more diversified you are, the less risky is or the smaller is the volatility of your realized losses. That is basically the bottom line. But we're willing to think of another terminology for that.
Thank you. Any more questions online or here? Okay.
Thank you for an interesting presentation. So I understand, like, I mean, typically when we use this, like, I come from a bank myself, so typically when we use these formulas, like, we look at a very long run average, that would basically be, like, as for the PD for the expected one. So that would be like your expected loss. But when you show like this naive bank one, you just use like the low PD one, not the high Markov switching one. So is the point that it's a risk of using the formula if we haven't seen the high risk or like the high loss region in time?
Okay, so the point that you're making, I believe, is that there could be situations in which there is bias in the estimate of the probability of default. Of course, that's a very important real-world problem. We actually want to abstract from that, say that even if there isn't such a bias, there is still an issue if you ignore uncertainty. So if you wish, we set aside any problems that could arise because of misestimation of the first moments, and we also only worry about second and higher moments. So the naive bank in the model is actually unbiased in its forecasts.
Thank you. We have time for one more question if there is one. If not, thank you very much.
Thank you.
And before we give the floor to the next speaker, I would like to just make a short note that we are also streaming this event. And there are about approximately 100 people listening, so we are not all here. And those who are also online are, of course, have the possibility to pose questions or comments in there. So please, those online watching, use that opportunity. But now let's go to the second talk in this session, and it's called Differential Effects of Macroprudential Policy, and it's Nina Biljanovska from International Monetary Fund who will deliver the talk. Thank you. The floor is yours. Thank you.
Okay, thank you very much to the organizers for including the presentation in the program. It's a pleasure to be here. It's my first time in Finland, so thank you very much for that. The paper that I will present today is titled Differential Effects of Macroprudential Policy, and it is joint work with Sophia Chen, who is also at the International Monetary Fund. And I missed to include the disclaimer in the presentation, but of course the usual disclaimer applies that these are our own views and not necessarily the views of the IMF. So let me start by giving you the motivation of our paper. So basically, macroprudential policy, or like there has been a lot of research on macroprudential policy, but this research has mainly focused on evaluating the effectiveness of these policies at the aggregate level. As a result, very little is known about the effectiveness of macroprudential policies across the income distribution, or potentially its differential effects. So what do we mean by differential effects is that perhaps when some macroprudential policy instruments tighten, some households might be more affected by getting less credit compared to some other households or borrowers. So with that in mind, when we started writing, or when we embarked on this project, essentially what we were thinking of answering was first, does macroprudential policy affect some segments or borrowers more than others? And in particular, do the effects on credit vary with households' income? And last but not the least, what are the potential channels through which these differential effects could operate? So then what we do in this paper, basically we examine if new mortgage lending differs depending on household income characteristics when certain macroprudential policies tighten, while controlling for a series of household level characteristics as well as loan level characteristics. So in doing so, we are focusing on two lender-based macroprudential policy instruments. So the first policy instrument that we are examining in this paper will be taxes on financial institutions. And the second policy instrument that we will examine is the minimum capital requirements. So what is important here to note is that these two policy instruments are different because minimum capital requirements, the way it is calculated, explicitly accounts for the riskiness of assets of the lenders compared to the previous one, or the taxes on financial institutions that does not take riskiness of borrowers into account. The last thing that we are going to do in the paper, as I mentioned in the beginning, is that we are going to discuss the potential channels through which these differential effects could operate. And we will find evidence for two channels in particular. The first one is the cost of lending borrowing channel. And the second one is the flight to quality channel. So these are the channels for which we find evidence, but I will also talk about other potential channels through which the differential effects could operate, but for which we don't find evidence. So before going into the data and the empirical analysis, let me give you an overview of our results. So what we find is indeed different macroprudential policy instruments could yield opposite differential effects. And in particular, we find that low-income households tend to receive lower amounts of credit when minimum capital requirements tighten compared to high-income households. On the other hand, when levies or taxes on financial institutions tighten, we see that the effects are stronger on average for high-income households, or that they receive lower loan amounts. So basically, in a nutshell, just to summarize, this key result is that we see that different macroprudential policy instruments could have different effects on different group of households. So let me illustrate this point actually by using the instruments that we consider in this paper. So let me start with potential. Consider that there is a tightening in taxes on financial institutions. So how would this operate? So when taxes on financial institutions tighten, this could increase this would increase the cost of lending for the lender, which could then be passed on to higher borrowing costs to the borrower. To the extent that high-income households have more liquidity, they could supply higher down payments and as a result get smaller loans. And in that case, we would see that tightening in the levies or taxes of financial institutions would have stronger effects on high-income households. On the other hand, now let's consider what happens if there is a tightening in minimum capital requirements. So if there is a tightening in minimum capital requirements, we need to remember that this policy accounts for the riskiness of assets. So if in response to such tightening, lenders, what they might want to do is that they might want to contract the issuance of high-risky loans, which are typically those loans that are with high LTVs. And what we find in our sample, and also what has been found in the literature, such loans are typically held by low-income households. As a result, such policy would end up having stronger effects on low-income households because they would end up receiving smaller loans on average compared to high-income households. So in the interest of time, I will not discuss in detail the existing literature, and which has been getting crowded more recently, but I would like to highlight two papers. So the first one is the paper by Acharya and co-authors, which was recently published at JF. And basically what they find is that there is mortgage loans reallocation from low-income households to high-income households when LTVs and loan-to-income ratios tighten. Another paper that I want to highlight is the paper by Pedro and Rodriguez-Tuz, who find that low-income borrowers essentially receive fewer high LTI loans from constrained lenders. So the reason why I wanted to highlight these two papers is because they're also considering the distributive effects of macroprudential policy, but unlike us, they're focusing on borrower-based tools such as the loan-to-value ratio and the loan-to-income ratio. And the second important difference is that they're looking only at one of changes in these instruments that took place one is in Ireland and the other one is in the UK. Compared to us, that we are looking the change in these two instruments that we are considering, but we are across different countries and also over a longer period of time. So let me now move on and describe briefly the data actually that we are using. So we're combining two main data sets. So the one is on macroprudential policies. So this data is sourced from the ECB's macroprudential policy database. And as we know, unlike monetary policy in the euro area that is uniform, macroprudential policy in the European Union differs much across countries. So in this data set, there are in total 11 categories of macroprudential policies, but we focus on two specific ones, which I mentioned, the taxes on financial institutions and the minimum capital requirements. So in addition to the fact that we are interested in understanding the distributional effects of these lender-based policies, the other reason why we are focusing on these two instruments is that they exhibit the most variation within our data set. And at the end, what we are using as a measure of macroprudential policy is essentially the net tightening versus the net loosening actions. Now, moving on to to the household level data. So basically, for the household level data, we are using the survey that is conducted by the ECB together with other central banks, and this is the Household Finance and Consumption Survey. So why this survey is particularly suitable for our analysis is because it contains rich information on household financial and socio-demographic characteristics, and in particular it contains very rich information on mortgage borrowing in terms of the collateral that is supplied, the price of the collateral, different characteristics on the loan in terms of the interest rate, maturity, and so on. Okay, so now let me move on to describe the empirical model and our baseline specification. So basically, our main goal of the analysis, as I mentioned already, is to estimate the potential differential effects of taxes on financial institutions and minimum capital requirements on new credit. So to this end, our main specification takes the following form, which is specified here in equation 1. So here on the left-hand side, the variable is the log value of the loan amount. That's why it is indexed with L. I denotes the household, C is the country, and T is the time period. Our main variable here of interest is essentially the interaction term, which is between the macroprudential policy, which is either the taxes on financial institutions or minimum capital requirements, and that one is interacted with income, which is measured in terms of deciles at the country level. And we're also controlling for household level characteristics, which is here denoted in the vector H. And these variables include essentially net wealth, household size, and the gender, age, education, and employment status of the household's reference person. We're also controlling for loan level, for loan characteristics, which is denoted here in the vector L. And the variables that we include as controls are the loan maturity, a dummy of whether the loan is issued at a variable or a fixed interest rate, a dummy variable whether the loan is used to purchase a new house or if it is used for refinancing, and a dummy whether this is a loan with a high LTV, and here the threshold that we are using is 80. We are also including country time fixed effects to have the tightest possible specification. So in this slide, I'm showing the main results, which are basically from the regression that I just described. So what we find is that in the first column, the interaction term between the taxes on financial institutions, which is our first macroprudential policy variable of interest, and income decile is negative and significant. So what this result suggests is that higher income households on average experience a larger reduction in mortgage loan size compared to low income households when the regulation on taxes on financial institution tightens. In the second column, we have the similar result, but now we're not using taxes on financial institutions as our main macroprudential policy variable of interest, but we are using the minimum capital requirements. And as we can see that the sign has flipped. So what this means is that lower income households on average experience a larger reduction in mortgage loan size than higher income households when the minimum capital requirements tighten. So what these results suggest is that basically the two macroprudential policy instruments have heterogeneous effects on households, with tighter taxes on financial institutions exhibiting stronger effects on high-income households compared to minimum capital requirements, which exhibit stronger effects on low-income households. And when I say these stronger effects, I think it's getting a bit confusing for some people, or at least this is the feedback that I have received. But by stronger effect means that essentially these households receive on average smaller loan amounts. So the reason also that the fact that we are getting the opposite signs in these regressions is also could be suggestive that different channels could be in operation, or that these differential effects could be operating through different channels. So this is what we examine next. So first we are trying to understand why tighter taxes on financial institutions essentially affect high-income households more. So as I also mentioned at the beginning of the presentation, our hypothesis here is that higher taxes on financial institutions could increase the cost for lenders, which in turn could increase the cost of cost for borrowers through higher borrowing rates. And then to the extent that higher income households have more liquidity than lower income households, they can hedge against this higher borrowing cost by supplying essentially larger down payments and getting smaller loans. So to test this channel, to which we refer as the cost of borrowing channel, we first check whether a tightening in the taxes on financial institutions indeed increases the rate at which the rate of the cost of borrowing for borrowers. And subsequently, we also test if high-income households indeed supply larger down payments. So to this end, we first run the regression specification, which I have outlined here in regression in equation number 2. And here the dependent variable is essentially the rate of the loan or the rate at which the loan is issued. And the tax on financial institution is our main variable, explanatory variable of interest. In this case, a positive and significant coefficient on the highlighted variable would indicate that the interest rates increase with higher taxes on financial institutions. In this regression, we continue to control for household level characteristics and for the loan characteristics, and we also include real GDP growth as a control, in addition to time and country fixed effects. After we run this regression, we also, in the second step, we test if down payment increases with the household income when taxes on financial institutions tighten. And basically here, specification, the regression that is specified in equation 3 is essentially our baseline equation that I showed in the previous slide, but instead of using the log loan amount on the left-hand side, we are using the log down payment and see whether households with high income would essentially supply larger down payment compared to low-income households. So So the results from these two regressions that I just described now are shown in the slide here. So basically, in the first column, we see the results for the coefficient on the tax on financial institutions, and it is positive and significant, suggesting that the cost of borrowing indeed go up for all households when there is a tightening in taxes on financial institutions. In the second column, we show the coefficient on the interaction term between taxes on financial institutions, which is positive and significant. So these results suggest that high-income households increase their down payment in response to tightening in taxes on financial institutions. So based on these results, we argue that there is evidence that taxes on financial institutions affect households. New 5? Oh. Okay. Yeah, no problem. I will speed up. So that there is evidence that. So based on these results, we argue that there is evidence that taxes on financial institutions tend to affect high-income households more compared to low-income households. So subsequently, we analyze to understand what is the channel through which the differential effects of minimum capital requirements operate. So we hypothesize here that these differential effects could operate through this flight to quality channel. And what this means is that, how we have been thinking about this is that when minimum capital requirements essentially tighten, for banks to comply with the tighter regulation, they may start reducing their exposures to risky loans characterized by high LTVs, which are typically held by lower income households. So such reduction in the lending will affect lower income households more. And due to lack of data, we cannot directly test for this channel, but we could still provide some evidence to see whether it is operational. So how do we do that? Essentially, we run split sample regressions, and we test basically to see whether our baseline regressions on some sample of loans with different LTV values, essentially to understand what portion of the distribution is driving the results. So then if we find that the flight to quality channel operates, we would expect that essentially the effects to be more pronounced in the sample of risky loans with high LTV ratios as banks contract lending to the riskier segment. So the table here shows actually the results from the split sample regression. So in the first column, we have the results for the full sample. The second column shows the results for the sample of loans with LTVs between 50 and 100. And the last column shows the results for the sample of loans with LTVs that are smaller than 50. So what we find is that the subsamples of loans with LTV ratios between 50 and 100, so the coefficient in that sample is larger and also statistically more significant. On the contrary, when we consider only the loans with LTV ratios of smaller than 50, the coefficient on the interaction term is still positive but is not statistically significant. So what this split sample regression essentially gives evidence is that low-income households are affected by a tightening in the minimum capital requirements more than high-income households, but only those that are basically in the riskier or segment or those that are getting loans with high LTVs. I think I will not have time to discuss the other channels in more detail, but basically we have received by discussants comments that there could be other channels through which the differential effects could operate. And one such channel could be the risk-taking channel. In a nutshell, what this means is that as taxes on financial institutions tighten, what banks might do is that in search for, they might engage in risk-taking behavior. We test in 2 steps for this channel, and we don't find evidence for it. And I'm happy to discuss this bilaterally or during the Q&A session. Another channel through which, for example, the differential effects of minimum capital requirements could operate is also the cost of capital or the cost of or borrowing cost channel, because when minimum capital requirements tighten, one way to comply with them is with these regulatory requirements is to decrease the risk-weighted assets. But another alternative would be essentially for banks to increase equity. So increasing equity could be costly for banks, and this could be also translated to higher borrowing costs. And again, this is something we test for this channel. I will not have the chance to show everything, but we don't find evidence for it. So the last thing that we kind of try to do is that, given that we find that there are these differential effects of macroprudential policies, we also want to see, and that are reflected in the loan amounts that are issued by banks. We want to see whether those also translate to house prices. So we tried to do analysis at the micro level, but we don't find evidence of this happening. But then we also tried to do some analysis at the more aggregate level, in which we group households by the income, by different income buckets. And here on the left-hand side, we have the house prices, the median house price within each income bucket, and we regress that on the macroprudential policy variable of interest, and then some controls. And what we do is we find that those households that are in the lowest income bucket essentially end up buying cheaper houses when taxes on financial institutions tighten. So this could be one way for those households or in this income bucket to hedge against higher borrowing costs. Yeah, so this is like one of the key takeaways. But in the interest of time, I will not discuss this in more detail. So we do some robustness checks as well, and because there could be concerns that the differential effects might not be necessarily driven by these specific macroprudential policy instruments. There could be concerns that the differential effects could be driven by monetary policy, and it could be also concerns that the differential effects are not necessarily driven by the differences in household income, but it could be that other household characteristics are driving these differential effects. So we do a different kind of analysis along those lines to test for all of these possible concerns, and we find that all our results continue to hold with same signs and similar statistical significance. So let me conclude here and just say what are the key takeaways from our analysis. So first, we find that there is evidence of lender-based macroprudential policies affecting households of different income differently. So higher income households tend to be more affected when macroprudential policies that are targeting total assets tightens, whereas low-income households tend to be more affected when macroprudential policy that is targeting risk-weighted assets tighten. And as we show that the differential effects essentially operate through different channels, and this result is important because this is something else that potentially policymakers could be taking into consideration when deciding what type of macroprudential policy instruments to employ in order to take into account the distributional effects. Thank you.
Thank you very much. We have time for one question. Is there anybody? If you want.
I'm not sure this is a question you'll answer quickly. Your regression the regression one, so the baseline one, appears to be in the level of the loan amount rather than and so the elasticity, it's not an elasticity, you're just telling me so the question is, what happens if I look at percentages? So you would expect, for instance, that if the interest rate went up, that the percentage of the loan amount would go down, not the absolute loan amount. So the question then is, what if I did this in logs? And the related question is, in the result, you have these numbers, the coefficient, which is the coefficient beta here, is a number like minus 0.002. What does that mean in euro terms? How many euros are we talking about? So the first question is sort of about percentages rather than, because I would expect the percentage to be larger for the percentage might be the same, but the absolute amount then would be bigger the bigger the loan amount, and this number I'm trying to figure out what the economic meaning of it is, because the loan amount average is 110,000, so this number looks small. So okay, thanks.
Shall I collect the two questions and then answer them?
No, we are out of time, so you can answer them now.
Okay, there was another question there.
I think we don't have time. We can continue the discussion in the coffee break, if that's okay.
Okay, so basically we have, on the first question, so we have loan amounts, because this is not a panel, so we cannot look at the loan growth, so I don't know if that is a question, but so we are not. Mm-hmm. And look at the semi-elasticity. Okay, so but then maybe we can yes, but then on the second question that I think you're raising a valid point. Like these amounts are indeed small. So basically, here what we get is there is a decrease. So for one unit change, so one tightening because tightening are just like 1 or 0. So one tightening in this policy basically results in 0.1% increase or decrease in the loan amount. So just to give you in terms of how much that is in euro. So the left-hand side is in logs.
If okay, let's continue this discussion during coffee, if it's okay.
Okay.
Thank you very much.
Thank you.
Is Juha here? Juha is not here.
So, ladies and gentlemen, we are about to start the second session of this conference, which is also the last session before the first lunch of this conference. This session is all about the syndicate credit lines, and we have not one but two presentations from the Federal Reserve Board in Washington, D.C. So the first presentation by Viktor Stebunovs is about how U.S. monetary policy modifies these syndicate credit lines while going through and transmitting into the real economy. through these credit lines. And after that, we have Filip Zikes, who will introduce us how to quantify the liquidity risks that lie within the banking sector balance sheets and are hidden in these complex networks of the credit, of the syndicate credit lines. So without further ado, please, we have but we have remote, right?
Let's see.
Do we have Viktors? Online.
Good morning. Hello, everyone. Can you hear me?
And we can hear you. So the floor is yours. So it's...
And you, just to confirm, you can see my slides as well?
We can. So
excellent.
Previously, it was for each presentation 30 minutes and the presentation in 25 minutes, and please leave at least 5 minutes for the conversation afterwards. So.
Great. Thank you very much. I wish you could be at the conference in person, but alas, I couldn't make it. So thank you very much for accommodating me. So the title of my presentation is U.S. Monetary Policy and Credit Risk of New Corporate Lines, and it's a joint work with Lucy Liu, who is an economist at the International Monetary Fund. And because we like our jobs and would like to keep them, there is a disclaimer that we're going to talk about our personal views, not the views of our respective organizations. So what the presentation is about. So as a stylized fact, I'd like to bring up that the United States originations of syndicated corporate credit lines far exceeds those of syndicated corporate term loans. So we're talking about something into trillions of dollars in sort of outstanding amounts, with the majority of those loans not being yet drawn. So that creates significant liquidity risk to banks originating those credit lines. With the global financial crisis, and then more recently with the pandemic, there was a lot of attention paid to corporate credit lines because of massive drawdowns and because of liquidity risks that they created, to banks. And so, you'd think that in literature, both risk-taking channel of monetary policy that operates through term loans and credit lines will be studied, but it doesn't seem to be the case. Most of the papers are really just about the risk-taking channel that operates through originations of term loans. So it made us wonder whether, there are some good reasons for it. We thought that, maybe someone else looked at it but didn't find much. Or maybe literature sort of confuses term loans with credit lines and doesn't really understand that they're two distinct products and should not be considered, at the same time. And so, if that's sort of the case, then all the methodology about studying risk-taking for credit lines should be different from that for studying risk-taking through term loans. And one sort of particular issue here to keep in mind is that borrowers are more likely to draw on their credit lines when they are in difficulty. And this is something that banks should surely appreciate and take into account how they approach their risk-taking decisions when originating credit lines. And so on the next slide, I'll basically show you the biggest takeaway from the presentation, and that's pretty much all you need to know about the rest of the paper. So here I'm using a cartoon to make a point that the first rule of originating a risk credit line is this: the borrower should convince you that they're not going to actually draw on this line in the first place. Okay, so moving on to the literature. So our paper draws from and contributes to multiple literature strands. So first one is about loan syndication. The other one is about syndicated loan contracting. And finally, the last one is about monetary policy transmission. So banks originate and retain corporate lines of credit, meaning that there is no really secondary market for lines of credit. So if banks originate once, it may remain off balance sheets for a while until it's drawn, and then it obviously enters the balance sheet once it's drawn. And the sort of drawn amounts on drawn amounts do not get sold. So it's a big contrast with what you observe in the United States for term loans, where a large amount of them gets securitized or sold off. Then the second point, again, is about how banks approach management of liquidity and capital risk associated with originations and drawdowns of credit lines. So obviously, for a bank, a credit line drawdown is a liquidity shock, but also it's a capital shock because it's expands the balance sheet with some risky assets. So banks obviously would like to mitigate those risks, and they do so apparently through particular pricing of options that are built into credit lines. So here we draw on Berg, Sanders, and Stefan that sort of highlight all the complexities of pricing of credit lines. In particular, the pricing compensates banks for options that contracts give borrowers, and they also use sort of pricing structures to screen borrowers for likelihood of exercising these options. So we combine this insight with what we think about a priori about non-repulsive transmission of credit lines, and we're trying to show that in response to policy rates, banks originate risk credit lines conditional on the pricing of those lines in order to discourage drawdowns of these lines. Sounds a bit complicated, but it's not really the case, as I'll try to convince you. So what kind of data we use? We use a pretty long period with lots of stress episodes and monetary policy cycles. So it goes from 95 to 2019. We use deal scan, and from that data set, we draw US dollar lines originated by US and foreign banks to US borrowers. So credit lines is really something that is mostly used by US corporates. We have some foreign entities, foreign borrowers in the sample, but they're too small to be sort of meaningful for analysis. So we only focus on US borrowers. What we're sort of trying to use to our advantage is that there might be multiple syndicates originated to the same borrower around the same time. So basically, that's where you can control for borrower characteristics, but then at the same time have variation in terms of loan characteristics. Then deals can sort of not a great data set to provide any information about credit risk. So we merge to it Moody's expected default frequencies in order to measure borrowers' ex-ante credit risk. And we're trying to match the horizon of EDFs with the maturities of lines, which means that for the same borrower, if that borrower has credit lines of different maturities, those credit lines will have different EDFs associated with them. Then because our example period includes a zero low bound, instead of your typical federal funds rate, we actually use a shadow federal funds rate by Wu and Xie. And then we also control for bank characteristics. In particular, we're interested in what kind of effect the strength of bank regulation supervision has on banks risk-taking in terms of originations of credit lines. Okay, so as I mentioned, credit lines are pretty different products than term loans. And, first of all, they tend to have shorter maturities than term loans, but then they also tend to be larger than term loans. And as the left panel on this slide shows, they actually tend to be there is still a pretty long right tail indicating that they're actually quite many highly risky borrowers that apply and get credit lines. And then in terms of their ratings, it appears that in the data for credit lines, the cutoff for investment grade quality is around 1% of expected default frequency. So the right panel tries to pick on that. So the first box plot is for investment grade loans, and you can see the whisker. So the 75th percentile ends up around 1%. So that's sort of the reason why we claim that investment grade ends up with probability of default of the horizon of the loan. So that will come into play later. So that's why I spent so much time sort of highlighting this fact. Okay, so the literature suggests that banks do protect themselves against a drawdown shock. Again, as I mentioned, borrowers are more likely to draw on lines when their situation deteriorates, and borrower's option to draw on the line exposes the bank, to the banks to liquidity and capital shocks. So when the borrower needs cash, it's in bad situations, it's a high credit risk, and that's exactly the moment when this undrawn committed line becomes a drawn line and shows up on the bank balance sheets, drawing not only on bank's liquidity, but also on its capital buffers. And the evidence suggests that such items, such balance sheet entries may actually stuck on balance sheet as balance sheet exposures for some time. So it's a draw on sort of liquidity and capital for banks for quite some time. So this is where this point by Burke, Sanders, and Stefan entered. So loan pricing correlates with the ex post usage of lines. So in particular, borrowers that pay a lower spread on the drawn portion of the line, but a high spread on the drawn portion of the line, are less likely to draw on their line. So basically, with pricing, you can control, how borrowers sort of self-select in particular, credit line contracts, and that then subsequently affects the likelihood of them drawing and not drawing on their credit lines. So how does it sort of look in the data? So we construct ratios of undrawn and drawn spreads, which we abbreviate as UDs, and we know that the median ratio, so of the spreads, is about 5, with a very long right tail, and that's what you see in the right panel. And sort of to see how it sort of came about, you can take a look at the left panel and compare the box plots for drawn spreads, which is the red one, and drawn spreads, which is the blue one. So you may wonder whether this UD ratio is in fact like another way to think about credit risk, but it turns out it's not. So this scatter plot here tries to make this point by correlating distributions of UDs in log form against the logs of expected default frequencies. As you can see, you get some kind of cloud that looks a lot like a straight line. So this allows us to claim that UD, so sort of this metric for likelihood of drawdowns, is not correlated with credit risk, but it stands for something else. Okay, so now we are ready to put all the pieces together and reveal this sort of maybe somewhat intimidating regression model. First of all, we refer to a given bank stake in a syndicated line as a line. That's just for simplicity. So as you surely know, there might be multiple, or actually there are multiple lenders in each syndicate. And from the data, we know stakes of individual banks in each syndicate, or something like that. And so we're going to refer to that stake as a line. So we're going to sort of treat it as a separate thing. Then on the left, we'll have a log of that line made by Bank L in Syndicate J, made to borrower B. And on the right, we'll have interaction terms. And some of them pick on a risk-taking channel of monetary policy that operates a credit line. So that's the first thing with the sort of some colorful, coloring up there. Then obviously we need to control for bank characteristics and borrower characteristics, and we try to do that by the usage of borrower time fixed effects and bank time fixed effects. The reason we can do that is that in the data we have multiple banks making actually many loans at each point in time. And then we also have borrowers that may have received credit lines, multiple credit lines at the same time as well. We also try to control for bank and borrower fixed effects. So that's sort of a way to check whether past relationships actually bear, anything on the size of the loans that borrowers receive. To be relatively standard controlling literature. So, at this point, you may have gathered that our approach requires quite a bit of data. We have to merge deal scan, we have to merge Moody's expected default frequencies and bank characteristics and stuff like that. So our sample is not huge. Then also our empirical setup only allows us to study an intensive margin. So it's whether a line once it's originated is big or small. And we also do not study determinants of this UD ratio, which picks on likelihood of credit lines being drawn, which is assumed it's one of the conditional variables. Okay, and just sort of spend one more second on risk-taking channel of monetary policy of credit lines. So it's captured by interaction term, where you have both EDFs and UDs on one hand, and then R, which is the proxy for the federal funds rate. Okay, so just a few words on hypothesis. So here again, I replicate the term that captures monetary policy of the Fed that operates through originations of credit lines, and I will work off the literature on the risk-taking channel that operates through originations of term loans. So UD is not something. So this ratio UD is not something that applies to term loans. So that part of the transmission channel will disappear, and the literature suggests that the remaining coefficient, this beta ER, should be below 0. So once the policy rate goes down, then risk of loans being originated should go up. Then for credit lines, naively so, it might be the same, but this is sort of something that we're going to find out. And then the credit line specific part, which is interaction of the ratio UD and log CDFs, may have a coefficient that sort of intuitively is negative, meaning that if a loan is unlikely, if a credit line is unlikely to be drawn, that maybe banks may be more willing to originate a risky line when the policy rate goes down. And so for credit lines, the overall effect then could be negative. But again, we don't know that a priori. Okay, so what does data suggest? So in this table, we show the regression results for some of the coefficients, and the key ones are highlighted in colorful boxes. You may recognize the interaction term I talked about, the interaction terms I talked about earlier. So it turns out that the data suggests that when the policy rate declines, risk of credit lines being originated also declines. And that's given by the positive coefficient in the blue box. However, the coefficient on the triple interaction term that takes into account the likelihood of a credit line being drawn is negative. And at this point, it's difficult to gauge whether the overall effect is positive or negative, because we haven't said that much about typical values of the ratio UD.
Excuse me, you have 5 minutes.
Yes, okay. So yeah, thank you. So the model is obviously highly nonlinear, and so you need to do some extra calculations to come up with the overall effect. And it turns out that it's positive for most of the values of the ratio UD. So it's only for credit lines that are extremely unlikely to be drawn. You see a risk-taking channel of monetary policy sort of operating. And that's what you can see by the the dot with the whiskers around the 99th percentile of the ratio UD. So, you may think that, this is not much of a risk-taking channel, but it turns out that you can push, things a bit further. So there are other ways how banks can protect themselves against drawdowns of credit lines. So one of them is to require borrowers to hold substantial cash reserves or generate substantial amounts of cash. And if you look at the presence of cash flow covenants and contracts and supplement, that information with the one we actually can infer about likelihood of drawdowns based on differences in drawn and undrawn spreads, you get an extra kick. And so this table kind of walks you through the process, but let's focus on the third column, which contains a dummy in the yellow box, which is a combination of a loan having a high UD, so meaning that it's unlikely to be drawn, and then has a cash flow covenant. And in this table, you just can adapt the coefficients immediately. You don't need to do anything complicated here, and you'll see that the negative effect dominates. So basically, if you have a contract with cash flow covenants and it has pretty high ratio UD, then risk-taking channel monetary policy operates there unambiguously and quite to a significant extent. Now, so far I haven't said much about the importance of bank characteristics, and it turns out that some of them can amplify this particular risk-taking channel, and some others can mitigate it. So surprisingly, foreign banks tend to be sort of more willing to originate risky credit lines when interest rates decline, even though they not necessarily have robust access to dollar liquidity. And then banks with the more internal liquidity tend to originate risky credit lines as well, and that's sort of a more obvious point. If you have more liquidity on their balance sheets, then more protected against liquidity shocks that come with credit line drawdowns. And then banks that experience more powerful supervision, have more transparent financial statements, and better capitalized, sort of engage rates less in risk-taking response to low interest rates. So we also check in the paper whether the channel that we have here operated before the GFC, and it is the case. And so GFC is a global financial crisis. But we have some evidence that it weakened, since. And speculatively, we say that it might be because banks learned from their GFC experience, and also post, crisis regulatory and supervisory changes probably affect bank behavior as well. Okay, and to conclude, so we think that banks surely appreciate the regularity that borrowers are more likely to draw on lines when they're in difficulty, and that there is some kind of version of the risk-taking channel that operates through risky credit lines, at least through the ones that are least likely to be drawn. And we speculate that some banks may be exposed to massive drawdowns of these lines in the stress episode, just like we see in the pandemic. And thinking what it may imply for the supply of credit more generally, it could be that such drawdowns will strain the capacity of banks to provide credit to to other businesses, households and what have you. And in fact, in literature, there is some kind of evidence that is working in that direction, but doesn't take into account the risk of the existing lines. So the papers that I mentioned here by our Fed colleagues just merely sort of document that once banks are hit with significant drawdowns, they cut supply of credit more generally, and particularly they distribute credit from small firms to large ones. So this concludes my remarks.
Thank you, Viktors. So now we have time for one or two quick questions. Do we have any questions in the audience?
Thank you. Thanks. This is really fascinating and an enormous amount of work. I have you cover a a long time period, if I understand correctly from scanning the paper. It's about 25 years, starting in the mid-1990s. And I wonder how you think about the rather large changes, first of all, in the structure of banking. There's been a substantial amount of consolidation over that period. And so a lot of banks that existed in 1995 don't exist as independent banks today. And the second thing is that there have been very big changes in regulation. So for instance, lines of credit today are subject to a partial liquidity coverage ratio and the leverage ratio requirement and the exposure measure, at least for some banks and not for all banks, and that's changed. The banks for which that accounts have changed over time. So I'm wondering whether or not you have information that allows me to see how the evolution of those two things, banking structure and regulation, are affecting the lines of credit, because they certainly affect the costs, I would think. Thank you.
Should I try to tackle this question? Okay.
I'm sorry. Yes, please do.
Yep. So we tried to take care of some of those issues by relying on bank time fixed effects and by aggregating sort of participation in this market up to sort of top holder. And we also spend quite a bit of time checking for stability of this particular channel. So as I mentioned, it operated before the global financial crisis. And since then, we find some evidence that it weakened, and we associate this weakening again in part with changes in bank regulation. And sort of one of the things that has happened all the time is that sort of really short-term credit lines where even undrawn pieces were not subject to any capital regulation, and now they are. And with that, you actually see pretty much a significant reduction in those 364 days facilities, so which are used to be considered to be short-term and thus were not subject to capital regulation. So so we're doing our best, but I think our sort of hands are a bit tied how much we can explore.
Thank you. Maybe we have time for other very short questions, or if not, we can continue, the program.
Thank you very much.
Give big applause. And welcome, Filip, Zikes.
Okay, good afternoon, everybody. Thanks to the organizers for including the paper on the program. It's a pleasure to be here. It's also my first time in Helsinki. Coming from the US, the jet lag is still pretty brutal, so hopefully what I'm going to be talking about is going to make some sense. So this is joint work with Vlad Yankov, who is a colleague of mine at the board, and Kevin Kiernan, who used to be our research assistant and financial analyst and has since moved on to Fannie Mae. And the usual disclaimer applies. Okay, do I move the slides or do they? Yeah. Okay. Okay. So I'm glad to be presenting after Viktors, because he sort of set the stage for me already by talking about credit lines. So as he mentioned, banks are major providers of liquidity to the corporate sector, especially in times of stress. According to our estimates, in recent years, the outstanding commitments have been in the range of $4 to $5 trillion. So that's about 20% of US GDP. So significant amounts of money. Now, it is well known that most of these lines of credit are syndicated, about 70%. But what is perhaps less known, or less well known anyway, is that many of these lines contain components called sublimits. And these are highly liquid components that allow borrowers or third parties to draw on demand on the same day, essentially. And what is also perhaps not very well known, that these sublimits, because of the arrangements within the syndicate regarding these sublimits, give rise to a network of interbank exposures. And so what this means is that if we want to study the capacity of the banking system to provide liquidity in times of stress, it's not sufficient to look at the individual banks, right, and the available liquidity at individual banks and compare those with the drawdowns on those banks' credit lines. We have to take into account this network of interbank exposures as well, okay? And so that's what we're going to do in this paper. So we're going to take a step in this direction. We're not going to obviously solve the problem. This is a complicated problem. But we're going to develop a simple model of liquidity capacity in the banking sector, a model that explicitly incorporates the network that arises from syndication. And we're going to calibrate it using historical data. We're going to calibrate stress test scenarios based on historical data and what we observed in the past, and also using actual data on observed credit lines and interbank exposures associated with these credit lines. And with the model, then we're going to examine, measure effectively, or try to measure the capacity of the banking sector to provide liquidity and how it evolved over time, and in particular, how it was affected by the regulation post-GFC, in particular the LCR. And so to preview the results, in case I don't have time to go over everything during these 30 minutes, what we find that the liquidity capacity has increased significantly, and that's primarily due to the improvement in liquidity at the banks at the core of the network, which is the largest banks. We also find that capital requirements are not binding in times of stress, so it seems like banks have sufficient amount of capital to be able to honor the drawdowns on credit lines, but the LCR requirements are binding. And even for moderate drawdowns, the LCR goes below 1, right, the regulatory minimum. And so it's important to allow banks to dip into their liquidity buffers in order for them to fulfill their role as liquidity providers to the corporate sector in times of stress. We also find that these interbank commitments, right, that arise through syndication provide an economically meaningful insurance to corporate borrowers when some of the banks in the syndicate suffer from liquidity shortfalls in times of stress. Now, in the second part of the paper, we study empirically how the liquidity capacity relates to corporate liquidity management. This part of the paper is currently underdeveloped, and in the revision, we're going to spend much more time on that. So I don't think I'll have time to cover this part. Okay, so I've told you in the beginning, right, that there are these sublimits, these liquid components of the credit lines that give rise to interbank exposures. So how does this work? How does this come about? So as we know, loan syndication is some sort of risk-sharing agreement among banks, right, to fund a credit facility to a corporate borrower, and this can be in terms of term loans or credit lines. And when a firm draws on a credit line, typically all members of the syndicate have to fund their shares and have a couple of days or 3 days to do so, right? But these sublimits are components which allow the borrower to draw funds or a third party on the same day, right? The swing lines in particular are sort of like credit cards where the borrower shows up and says, I need X amount of dollars today, okay? Now, it would be impractical for all the members of the syndicate to have to come up with liquidity on such a short notice. So what typically happens in these syndicates, that there will be a bank, a designated bank called a fronting bank, and this bank assumes the entire sublimit drawdown and advances whatever the firm, the corporate borrower requested on the same day, okay? And then the fronting bank has the option to turn around and request the member banks to fund their pro rata shares in the sublimit. It doesn't have to do that if the fronting bank feels like it has enough liquidity and it's going to be able to service the loan. It doesn't have to go back to the member banks, but it can do so, right? And if it does, the member banks have an obligation to fund their pro rata shares, okay? And so this is how you can already see how the fronting exposures arise, right? Because the fronting bank, by assuming the full sublimit drawdown, is on the hook on a larger share than its pro rata share in the syndicate, right? And in case, when the member banks suffer from liquidity shortfalls, ends up funding a higher share of the sublimit drawdown, okay? So it is in effect exposed to all the member banks in the syndicate. But at the same time, this is good for the borrower, right? Because if the fronting bank is sufficiently liquid, it effectively insures the borrower against liquidity shortfalls at member banks, right? So if some of the member banks don't have enough liquidity, the fronting bank is sufficiently liquid, the borrower doesn't care and still gets the full sublimit drawdown, okay? So that's the fronting exposures, perhaps best illustrated through an example. So here we have an example of a syndicate with 3 banks. The syndicate extends a swing line of 100 to a borrower. So again, a swing line is like a credit card. The borrower can show up any day and request funds on the same day. The fronting bank therefore commits to fund 100 on demand. And it has exposures of 25 each to the member banks, right? Because the member banks have a share of 25 in the syndicate. And the member banks, in turn, have a participation commitment of 25 to the fronting bank, okay? Now, in the middle panel, we show a situation where the borrower maxes out this swing line. So borrows 100, requests 100. And all the member banks are liquid, so the fronting bank pays 50, the member banks pay 25, and everything is fine. Now, on the panel on the right, however, member bank 2 defaults, right? And so the fronting bank now is on the hook for 75, as opposed to 50, which was its pro rata share, right? And these 25 is precisely the shortfall of liquidity at the member bank that the fronting bank has to make up for, right? And then we can also think about that as the insurance that the fronting bank provides to the corporate borrower, okay? So this 25, I'll later use some metrics to quantify the amount of insurance that fronting bank provide in the stress scenarios. So this is exactly the 25 in this example, okay? Now, of course, in practice, there are many syndicated loans, syndicated deals, and in some of these deals, a bank can serve as a fronting bank. In other deals, it can serve as a member banks, right? So if we look at the deals as a whole, we're going to end up with a complicated network of exposures, okay? And I'll show you an example later on. Okay, so with the sort of mechanics of fronting and sublimits in mind, we're going to build a simple model to measure the capacity of the system. And we're going to have a stylized balance sheets, right? On the asset side, we have liquid assets and illiquid loans. On the liability side, we have equity, we have deposits, insured deposits, and we have uninsured debt. And then we have off-balance sheet items related to the credit lines. So on the asset side, we have the undrawn revolvers denoted by U. So these are the commitments of banks to their corporate borrowers. And then we have the fronting exposures on the asset side, right? So that's the exposure of the fronting banks to the member banks. And on the liability side, we have the participation commitments. So these are the commitments of member banks to the fronting banks, right? To fund their pro rata share in the sublimit in case the fronting bank requests the member bank to do so. Okay, and then how are we going to think about stress in this model? So the stress will have 2 parts or 2 components, right? So first, we're going to assume that bank I, or every bank actually in the system, experiences an outflow of uninsured debt at rate of lambda, right? So some short-term creditors pull their funding. And second, all firms draw down on their lines of credit, both on the regular revolvers and on the sublimits at rate alpha, okay? So the equation in the middle, I don't know if there's a pointer here. So the equation in the middle here tells us what bank I is requested to pay in the stress scenario, okay? So the first term these are the commitments to the borrowers, right? So this is what the borrowers draw, what the funds they request. And these are the participation commitments to fronting banks, okay? So this is the total payment. PI bar is the total payment that bank I has to make. Now, of course, the bank cannot pay more than what it has in available liquidity and what it gets to member banks in terms of participation commitments, right? So the actual feasible payments, which we denote by P, has to be less than the available liquid resources and whatever funds the bank receives from other banks in participation commitments. Okay, so we have this set of budget constraints, and what we need to do is we need to solve for P, right, the feasible payment. So how do we do that? Well, I'm sure many of you in this room are familiar with the seminal model of Eisenberg and Noe, right, about contagion and payment systems. And it turns out that we can cast our problem in the framework of Eisenberg and Noe and use their technology to solve for the feasible payment, okay, what they call the equilibrium payment, PI star. Okay, in order to do that, we have to make a bunch of assumptions, such as limited liability of equity, priority of debt obligations, the drawdowns are serviced in proportion to nominal claims, and we also assume that banks cannot monetize their illiquid assets, right? So this is a fairly strong assumption. So the only liquidity that banks have available to themselves are the high-quality liquid assets, less the outflow of short-term funding, okay? So with these assumptions, we can solve the model, right? We can find the PI star, and going back, so we can find the P, the feasible P, and we can then compare the feasible P with P bar, right? And the difference between the two is the shortfall of liquidity in equilibrium. Okay, so we can calculate a bunch of measures of liquidity capacity, such as the aggregate shortfall. We can also look at how many banks become illiquid in the stress scenario, and we can also calculate the effective reallocation liquidity through fronting, which is the insurance part of the fronting exposures and commitments, right? Remember the 25 in that example, the amount of liquidity that the fronting bank provides in excess of its pro rata share, making up for the shortfall at member banks, okay? So we can quantify this insurance function of fronting as well. Okay, so to calibrate the model, we use a bunch of different data sets. There is no single data set that would allow us to calibrate everything, to calibrate the syndicated credit lines. So we rely on DealScan, just as Viktors did. That's a public data set. But we also use our proprietary data set called FRY14. That's maybe familiar to some of you. That's a data set that the Fed collects for the purposes of running the annual stress test. So this is very granular, sort of loan level or borrower level data on a variety of balance sheet items, okay? So we're going to use that too, and we're going to essentially combine DealScan with Y14 to construct some kind of snapshot each quarter of the outstanding credit commitments, the sublimits, the fronting exposures, the participation commitments. Okay, so it's an elaborate data construction is described in the appendix. Of course, there are assumptions that we have to make, and there are associated measurement errors that potentially plague the analysis and the estimates. So you should probably take them with a pinch of salt. Okay, now in terms of the balance sheet information, the available liquidity that banks have, we use the publicly available FRY9C and banks' LCR disclosures. Okay. For corporate borrower information, we use standard data sets. And so what we end up with is over 5,000 borrowers, over 750 bank holding companies, and the sample period is from 2004 through 2020. Okay, so before going to the results of the stress test, let me quickly show you a snapshot of the fronting exposures network, because like I said, this is, at least to our knowledge, new. This hasn't been looked at in the literature. So what I show you here is the network of the 750 whatever bank holding companies in 2019. This is a directed network, right? Because banks can serve both as fronting bank as well as member banks, right? In different syndicates. And as you can see, as in many financial networks, the network has a well-defined core periphery structure, right? It has a core. The core consists of the largest banks. Small banks typically do not serve as fronting banks, right? Small banks typically participate as members in syndicates. And that sort of makes sense, right? Because they don't have the ability and the capacity to provide so much liquidity. They don't have so much liquid assets like the largest banks. Now the dots in the red are what we call the net fronting banks. So these are banks, these are fronting banks whose fronting exposures are larger than participation commitments, right? So they provide these fronting services on the net. So that there's a high concentration of these net fronting exposures among those 4 banks, okay? Now, in the paper, we kind of look at the structure of the network over time, and what we find is that it's essentially pretty stable, right? The core, the membership in the core, the number of banks seems to be fairly stable over time. Okay, so now I'm going to calibrate the stress test scenarios. Remember, the stress test scenario involves 2 things, right? One is the outflow of short-term funding. Here we're going to assume either 0% or 10%. I'm going to present mainly the results for 10%. The 10% is motivated by the GFC, what we observed during the GFC. So I'll focus on that. In terms of drawdowns on the credit lines, again, both the sublimits and the regular revolvers, we're going to calibrate the drawdown rates by industry. And we're going to focus on three main scenarios, right, that we call GFC, COVID, and EAD. So the GFC scenario is calibrated to the drawdowns observed during the GFC. On average, across the industries, it's about 9%. COVID is calibrated to the drawdowns observed during March, April 2020, about 16% on average, okay, which is the amount drawn of the available committed lines of credit, okay? And EAD, which stands for exposure default, is a scenario that we calculate based on what banks report to us in the FRY14 data, where banks tell us what they expect the credit line utilization would be in the case of distress of the borrower, okay? So this is a fairly severe scenario, right? Because remember, in our stress test, all firms will be drawing, right? And so this essentially assumes that all firms are in distress. And that's about 24% on average across the industry. So pretty severe scenario, especially compared to what was observed in the past in periods of stress. Okay, so this table summarizes the main results, right? So in the first highlighted rows, we first report the drawdown amount, right? So, you know, we hit the system with the stress. How much do the corporate borrowers request in funds? How much do they want to draw on their credit lines? Now, what you see is that in 2019, which is the right panel, the dollar amounts are much larger, right? And that's not surprising because the banking system has grown. The assets in the system have grown a lot. And so in dollar amounts, for the same drawdown rate, right, the dollar amounts are much higher. However, as shown in the second line, relative to the available liquidity, where the available liquidity is calculated by taking the high-quality liquid assets less the outflow of short-term funding, the drawdowns are actually much smaller, right? In the extreme scenario in 2019, the drawdowns are less than 1, right, in relative terms, about 78%, whereas before the crisis, they were higher by a factor of 3, okay? So it seems, right, that at least in aggregate, the banking system has sufficient liquidity to honor all drawdowns, even in this extreme scenario. Okay, but of course, you know, these aggregate numbers are deceiving, right? Because, you know, even if the system as a whole has the liquidity, it doesn't guarantee that all banks will be able to honor their claims, right? So that depends on the distribution of liquidity across the banks in the system, and also on the network of interbank exposures, right? So that's where our model comes in. So now we're going to run the model with these drawdowns to see what the liquidity shortfalls would be. So what we show in what's highlighted here are the overall shortfalls, again in dollar terms, and relative to the drawdown, right? They're actually not that different, right, across the two periods, but in relative terms, they're uniformly smaller in 2019, right? So in 2019, even in the extreme scenario, the shortfall is only about 37%, whereas it was 75% in 2006. Okay, so a significant improvement in liquidity capacity in terms of lower shortfalls. Okay. We also look at how many banks fail. And what we find is that uniformly fewer banks fail. By failure, I mean banks run out of liquidity, right? And especially the banks at the core of the network, right, are now much more liquid. Very few, actually only one defaults in the extreme scenario, right? And the LCR banks are also in a much better shape, okay? Can sustain much larger drawdowns. Okay, so these results that I showed so far apply to all drawdowns on all credit lines, right? Sublimits and the regular revolvers. Now I'm just going to look at the sublimits, right? And remember, the sublimits are the parts of the credit line when the fronting banks serve as the main liquidity providers, ensuring the borrowers against shortfalls at member banks, right? That's where the fronting banks have to step in case there are shortfalls at member banks. And the main result here is that post-GFC, the shortfalls on these sublimits are extremely small, both in dollar terms and in relative terms, right? And that's precisely because the fronting banks, which are at the core of the network, have become much more liquid and rely much less on short-term funding. So they are able to fulfill this insurance function much better than they were to do so before GFC. And the amount of liquidity that these fronting banks provide is shown in the third line, right? If you want to quantify how much insurance they actually provide, right? It's about $32 billion in this extreme scenario, right? So if these fronting commitments didn't exist and the fronting banks did not step in to cover shortfalls in member banks, the corporate sector would have received $32 billion less of liquidity in this extreme scenario. Okay, I'm going to skip this one. This is a cross-sectional analysis. And I'm going to go to the last two things, which I hopefully have time to quickly mention. So in the model, we did not impose any constraints on banks' ability to provide liquidity except the quantity of liquid assets they have available, right? That was the only constraint. But of course, in practice, banks face a bunch of different constraints, such as liquidity and capital constraints. And so what we do here is we calculate the post-stress liquidity and capital ratios in the different scenarios, okay? So what would the LCR look like for a given drawdown rate, right? So the column labeled 0 is the LCR before stress, right? And as you can see, all the banks in our system are well above the regulatory minimum of 1, right? But once we start increasing the drawdown rate, the LCR starts dropping pretty quickly, okay? The average LCR drops, also the minimum LCR drops, and the number of banks that have LCR below 1 also increases quite dramatically. So what this means, again, I may have mentioned that in the beginning, is that if we do want firms or banks to continue providing liquidity in stress times, we have to allow them to dip in their liquidity buffers, allow them to go below 1 in their LCR temporarily, and of course, require them to restore it above 1 eventually. But when it comes to capital requirements, what we find is that we find the opposite, right? In any of the scenarios here that we consider, there's very small impact on the risk-based capital ratio, I should say. This is risk-based. This is not the leverage ratio, which is not risk-based, right? So this is in the jargon of capital regulation. This is CET1, and we find basically that there is very little impact on the CET1 ratios. One reason why that is because the committed lines of credit, the committed funds, have to already be incorporated in capital requirements, in capital calculations, up to 50%, right? So 50% of the undrawn lines of credit have to be already incorporated in capital ratios, and so actual drawdowns will then have a much smaller impact on the capital ratios than it otherwise would have been the case. Okay, so let me summarize very quickly. So the main message is that the liquidity capacity of the banking system increased significantly, and this is primarily due to the fronting bank, the banks at the core of the fronting network, the largest bank, being much more liquid and relying much less on short-term funding, as opposed to the smaller banks in the system where their capacity also increased, but only slightly. We find that fewer banks experience liquidity shortfalls, and as I said, the core is much more resilient than before. Capital ratios, risk-based capital ratios, do not seem to be binding in the stress scenarios, but the LCR requirements certainly do. And so, I'll stop here.
Thank you. So, time for one question, perhaps, from the audience.
So, thanks. Yeah. So, thank you. Thanks a lot. Very, very interesting. So, Grzegorz Hałaj, the ECB. The question is about really the structure of the network. Let's say of the network. Yeah. So, is it a resilient structure? Yes. You see some concentration. Yeah. So, is it like can you draw some conclusions from the structure of the network that's actually something that probably is not the optimal point of the system, that rather fostering some reconfiguration would be actually beneficial for the system. So I mean, since you have this data right on the structure, maybe it could be sort of explored in this direction.
Yeah, that's a good question. We haven't played around with sort of reconfiguring or rewiring the network. I think the key result that we have is that the core is much stronger than the periphery. Right? So, the structure itself is important. What is also important is the balance sheet strength of the individual nodes in the network, right? In order not to transmit stress, right? You may have a core which is highly connected, but if the core has a lot of balance sheet capacity, any shocks that will hit the core will stay in the core and will not be transmitted further. So in that sense, we believe that the network is pretty stable because the core is very, very, very strong and highly liquid and well capitalized, right? But yeah, we haven't done any sort of counterfactuals. What would happen if we rewired it?
Perhaps one more, since we were a bit late already, so we have a really short one.
Clarification. You're making some assumptions in the model. I need clarification about one. So what do you assume happens if a bank falls below its LCR requirement? Is that it fails?
No,
is it possible that it actually takes some strategic preemptive actions to rebuild its LCR in order to be able to meet its obligations in that? Because to me, it just sounds very strange that it will fail just because it falls below 1 in LCR. We know in principle these are buffers, so they should be dippable.
Exactly.
What exactly are you assuming there?
Exactly. And like I said, in the model, we do not impose the LCR to be binding. Okay? If we did so, right, the capacity of the system would be way, way smaller, right? Because as I showed you, once you stress the system, the LCR drops pretty quickly, right? So I shared your view that we should allow banks to use their liquidity buffers, right? And in fact, during COVID, at least in the US, banks were encouraged to do so, right? To temporarily dip into the below 1, into the buffers, of course, with the idea of eventually rebuilding the buffers back to 1 or above 1, right? Right.
Okay, perhaps due to the time restrictions, we continue this conversation during the lunch. So just a housekeeping message, there will be lunch served in the lobby, that direction over there. And while you're having it, please take a look at the posters as well. There's a poster session right next to the lunching area. So enjoy those as well while you're at it. Thank you very much.
Good afternoon, everyone. It's time to resume our session. I hope everyone had a nice and relaxing lunch break. And it's time now to talk about interactions between banks and money market funds. I'd like to introduce our next speaker, Mr. Javier Suarez from CEMFI. So please, Javier, the floor is yours.
Thank you very much. Great pleasure to be here. I think for the second time in a row, for second year in a row. So that's a great achievement, and it's also showing that last year this was very interesting. So I'm also having same feeling for this year. This is joint work with Martin Farias, who is a PhD student at CEMFI, and is a, as the title says, is a piece on the interaction between banks and money market funds. What we aim to provide in this paper is some sort of background conceptual framework for understanding issues that became relevant, for instance, in the context of the March 2020 DAS for cash. At that point, we learned that withdrawals or redemptions from money market fund sector, as well as other parts of the mutual fund sector, were creating liquidity tensions here and there. And what the perspective in this paper tries to provide is that this do not happen in isolation, and not necessarily because of money market funds' fault. In the background, there are illiquid secondary markets for the securities that money market funds hold and have to sell if facing redemptions, and there are connections with the banking system. In fact, money market funds and banks compete at the level of attracting investors' demand for cash-like assets. In many of the policy reports that I have read in recent years about reconsidering the structure and regulation of the money market fund sector, there is typically a paragraph trying to explain what is the rationale for the existence of money market funds, and they are described as an alternative to deposits in, for instance, allowing firms to manage their cash holdings in an alternative way. But the money market funds and banks also interact in the primary and secondary markets for short-term securities. In fact, at least in Europe, and I think in the US, at least in the old days, money market funds were main buyers of banks' commercial paper, as well as CDs, and they were entering in repo transactions with banks. And when the money market fund sector faces redemptions, they have to sell their normally held to maturity short-term assets to someone else, and commonly someone else is the banking system. In fact, when in March 2020, the Fed established facilities to support the money market fund sector facing abnormal, so to say, redemptions, some of the facilities were for banks to borrow so as to lend to the or to acquire the assets from the money market fund or other mutual funds in that setup. So there is a lot of attention from the policy perspective, at least in Europe, but very few models in the literature that provide for explicit interactions between the money market funds and the banks, or more generally, the mutual fund, which is part of the so-called non-bank financial system or financial intermediaries, and the banks. And we aim to construct a model where deposits and money market fund shares coexist. And I can tell you it's not so easy. So we produce something very close to the current draft 1 year ago. We were not super happy with the way we got to the coexistence. I will tell you how we do. But 1 year later, I still don't find a superior alternative that works to deliver this coexistence of bank deposits and money market fund shares. And as a microeconomist, I think that exploring micro foundations, like why do these things coexist, help you identify the frictions that could be behind each of them. Of course, in the absence of friction, some sort of Modigliani-Miller or complete market type argument will say that none of these specific financial structures have any specific role to play. So let's see what you think about this. So what are the main modeling features in the current construction? I will emphasize two and then refer to a third, but the third is just to complete the model and could be subject to several modifications. The first is having who demands cash-like assets. In our model, it's going to be firms, but actually it will not take much to reinterpret them also as maybe sophisticated households wanting to hedge potential liquidity needs at a later date by holding sufficiently liquid assets. But I'm going to call them firms, firms that are trying to self-insure against liquidity shocks that may be coming in an interim date in between the time they invest and maybe the time the long-term assets in the economy mature. In the context of possibly accommodating needs of liquidity in an interim date, deposits have the advantage in the model and the feature in the model of promising fixed conversion value. Whereas, at least nominally, you will see that there is a friction associated to deposits because otherwise deposits will be the dominant and only form of satisfying this demand for cash-like assets. Money market fund shares are instead redeemable, so they are liquid in their own sense, but at a potentially fluctuating market value. So in the model, we have floating value money market funds, and in periods or states of the economy where there are lots of investors redeeming their money market fund shares, the funds have to sell their assets in secondary markets subject to frictions, which pushes the price of those assets down, and those down prices of the liquidated securities will push the mark-to-market value of the money market funds shares down. So investors will redeem, but not get exactly the face value of their initial savings. Now, I already mentioned how money market funds through sales in secondary markets subject to frictions will, in a sense, erode the liquidity convenience yield of what they are offering to those who want cash-like assets. On the side of deposits, the current model, and this is where I don't feel completely happy, imposes a friction to bank deposits that consists on, with some probability, the money in the deposit is not available when you need it. So if it is available at the promised fixed conversion value, but with some perhaps very small probability, the bank has lost access to the network, has suffered cyber attack, or is object of a speculation around its solvency, and for some reason, think of this as uninsured deposits, the regulator is not willing to allow depositors to fly out to take all the money without prior consideration of, I don't know, is there enough assets to make everybody paid. In other words, this second ingredient, of which I do not feel particularly proud, is a friction needed to compensate for the fact that money market funds will suffer the disadvantage coming from selling assets and therefore not offering very attractive redemption values in times of negative aggregate shocks. But given that in the model, the friction associated with deposits is regarded an idiosyncratic friction, so it will affect only a fraction of the deposits in the system and not to interfere too much with the hedging by the firms that want cash-like assets. I'm going to assume that these are holding actually well-diversified portfolios of deposits. So in a sense, it's only a fraction of their deposits that get trapped by the idiosyncratic convertibility risk. I could reinterpret the idiosyncratic convertibility risk as anything that makes deposits not as competitive as money market funds in offering return to investors. And maybe here you will sort of stand closer to me in terms of accepting what this friction means. So it might mean market power and banks not willing to pay as much on their deposit accounts as maybe on their CDs or on their commercial paper, which is typically sold to the money market funds. So what is interesting of the model is that at the end of the day, and this is pretty much a summary of the architecture of the model, I'm going to have final savers that allocate their liquid funds here called net worth, just to make it complete, in either deposits or money market shares, money market fund shares. But at the end of the day, the money market funds invest in commercial paper, which is also funding the same as deposits for bank assets. So the big question in the paper, as a step back to the policy discussions on money market funds, is what makes this indirect or more, two layers form of intermediation and equilibrium phenomenon, as opposed to maybe the old days in which all cash-like assets were deposits. They were directly placed in the liability side of the bank's balance sheet, and we didn't have this sector, right? So you can see the paper as an attempt to explain why such a sector can exist in equilibrium, and in that I will have to take a view on which frictions are affecting each of the pieces. So money market funds in my model are going to invest in banks' commercial paper. On the other hand, I'm going to regard bank assets as perfectly liquid. Of course, this is a shortcut. In reality, banks are performing maturity transformation. But one way to justify the assumption for the time being is that banks have access to central bank facilities. So maybe their assets are not directly liquid, but they are made liquid by the access to the central bank facilities. Whereas maybe mutual funds in a near future or even today already have access to central bank facilities where commercial paper can be discounted. But in the context of the model, when they face redemptions from those who place their money in them, will have to sell the commercial paper in a secondary market that we know is extremely illiquid. So if I now look at the uses and sources of funds of my three sectors at the interim date, which is when most of the interesting action occurs, there will be shocks that I will explain in a minute that will produce possible reallocations of firms' holdings of deposits and money market funds. If money market funds suffer net redemptions, which will be marked to market, and this is the market price, they will have to sell commercial paper at whatever prevailing price there is in order to allow the exit of the redeeming shares. this commercial paper will be sold back to the only other agent in the model. I could have an expanded version of the model with the central bank, and maybe some of this commercial paper could end up in the balance sheet of the central bank or as collateral for central bank lending. But in the current model, where it goes is back to the balance sheets of the banks, which in the process of acquiring that commercial paper in the secondary market experience some frictional cost. Now, this frictional cost could be due diligence, because it's not your own commercial paper, it's anyone else's commercial paper, minimal due diligence, or the fact that this is an OTC market, so you have to phone somebody and you must have a match. And an important assumption in the model is that these costs represented by lambda are going to be increasing in the aggregate amount of commercial paper that is sold in a given state of nature at the interim date. So when a lot of commercial paper gets for sale in this secondary market, the market gets congested. The telephone management of the transactions, the cash that the buyers need to mobilize, the due diligence, or whatever other search cost, including, of course, this is not in the model, the fact that this is an asset that once it's acquired by the bank might be subject to capital requirements. So implicitly, the lambda could also be associated with the shadow value of the capital that the bank will have to mobilize as backing the acquisition of that, in principle, risky, or at least regarded not totally safe from a regulatory perspective. Now, what are the type of shocks that the firms are trying to accommodate at the interim date? Well, the most important is the possibility of having what in the model is an investment opportunity. So firms at t equals 0, the model is a 0, 1, 2 model. At time 0, when deciding how to allocate their liquid funds across deposits and money market fund shares, are concerned that with some probability they will have an investment opportunity producing abnormal returns at the interim date. And they want to be ready to take that opportunity. That's a positive reading. You might say this is an extraordinary expense due to some type of technical failure, and if you don't correct this failure, your firm is in real trouble. So whatever it means is something that the firm wants to actually undertake. And then firms that will experience that shock will see in the model an investment project appearing as a relevant use of its funds, and that firm will get rid of past deposits and past money market fund shares and try to invest in this quote-unquote project as much as possible. Firms that do not suffer such shock will just simply roll over liquid positions from T1 to T2, but in an optimal manner. So facing new prices are associated, yes, for convenience, deposits are priced at discount here, and new prices of money market fund shares, they will decide how much they want to allocate to deposits and to money market fund shares at the interim date. Just to end with the elements in this slide, the banks that suffered the funny shock, with which I am not totally happy at the moment, are banks that get virtually frozen at t equal 1. So these are banks that maybe because of operational risk will just have their positions roll over from, they are not represented here because they are just mechanically with all their positions roll over for one more period. So firms will find that they inherit some non-accessible deposits from the previous date for those banks that suffer, if you want, the cyber risk. and they will just have to keep those until the final date. So it's not that this is going to produce them losses of capital. This is not credit risk. It's just loss of access that impedes, if the firm is one with an investment opportunity, to make all its savings liquid when needed. So firms at the ex-ante date, when deciding how to allocate their savings across money market fund shares and bank deposits, will be fully aware of the fact that in an aggregate state that there are two states in our simple analysis, the normal state and the dash for cash state. In the dash for cash state, there is an abnormal wish to hold deposits. So we model it, and I'm sort of disordered today in my presentation. We model it as in this aggregate state that happens with probability gamma. Firms need to make sure that they can pay their payroll in the middle of the pandemic. So a given fraction of their initial endowment needs to be in bank deposits, no matter what. That's the way we model a dash for cash, and we model an abnormal need to redirect liquid resources from banks to money market funds. Actually, because the holders of money market fund shares want to deposit their money into the bank. So in the end, you see, is this chain of intermediation that is going to increase the friction that happens in the secondary market for the commercial paper in this particular model. I've been advised that I have no more than 5 minutes. So I think I'm going to keep my presentation without going into all the equations that describe the model and the equilibrium. The logic of what happens is then very, very clear. In the state of aggregate illiquidity, when there is this dash for cash, abnormal redemptions, in the money market fund sector, there will be sales of commercial paper and asset price declines. So the holders of money market fund shares will feel disappointed when trying to do something with those shares. The ones who do not want to do anything with those shares, on the other hand, can just hold them, and at T = 2, the payoffs will be as high as if this aggregate state had not happened. By the way, a lot of the literature and the policy discussion around this sector focuses on first mover advantages. By assuming mark-to-market of the positions of the money market fund, I am ignoring those. And here the surprising result comes. Even without first mover advantages, the competitive equilibrium that takes most of the analytics of the paper to characterize exhibits inefficiently large initial holdings of money market fund shares by firms. Why? This is now a popular story, at least among academics in finance, pecuniary externalities. When the firms decide to place their savings in money market fund shares, which means that more of the funding of the banks comes through commercial paper, and more sales of commercial paper will have to happen in the dash for cash equilibrium, they neglect how much extra pressure they are adding to the secondary market price of the liquidated assets. And that damages the liquidity provision role of the money market fund sector itself. In a sense, there is an illusion of liquidity. Associated with the arrangements, right? But there is also like an illusion of what commercial paper is providing. The banks, by issuing commercial paper, feels isolated from its own liquidity shocks. It's a long-term asset from the perspective of the bank, but actually it's not a long-term asset from the perspective of secondary trade and holders of those commercial papers. So the need to cover liquidity shocks with trading commercial paper is the source of inefficiency. And in terms of the model, a pecuniary externality can be dealt with a proper Pigouvian tax at the relevant level. So at the relevant level, and this is maybe from a policy message the most provocative idea, what should be taxed to accommodate the inefficiency that we identify is either the investment in money market fund shares by the final investors. Of course, you can tax at the money market fund sector level. The incidence is what eventually matters. But equivalently, you could tax banks' issuance of commercial paper, because this is what is creating this industry where there is the illusion of liquidity in normal times that then disappears, at least partially, in bad times through the fire sales that everybody talks when the bad times come. Okay, but I want to give this message that we are not saying the problem are money market funds per share, as many policy accounts of the sector sometimes suggest. It is more this externality that needs to be coped with. So maybe the policy message in the end is beware of when we regulate simultaneously banks and non-banks. Historically, we have felt that banks were first not internalizing systemic externalities that they created. Second, implicitly or explicitly subsidized by the safety net and ex post interventions. So we thought the size of the banking sector is excessive, and then we had like a latent sympathy for the non-banks. But the non-banks carried their own imperfections that also operate at the systemic level and also make us worry. So we need to be able to regulate with the impression of these interconnections across sectors in mind. So if anything, then don't take my Pigouvian taxation proposal so seriously. But if we are taxing the banks, maybe we should tax them a little bit less as a way to accommodate what will be otherwise the need to tax the sector where things are flowing and which might be causing trouble in its own peculiar episodes. One last remark. I was presenting this in Chicago in front of Douglas Diamond in the few days after Silicon Valley Bank demise. And of course he said, well, now you should consider the reverse shock in your model. So instead of a dash for cash, now is taking money out of the banks and back to the money market fund sector. That could create other frictions. So I hope just to make a contribution in sort of the analytics of this issue. Thank you.
Well, you can take them there as well. Yeah, how you prefer. So thank you very much, Javier, for your insightful presentation. And now we have time for questions. So
there's actually one in the chat. It's from Pierre Mananga from South African Reserve Bank. Banks and MF and AM use repo transactions quite a lot. Most of the times these repos are made of HQLAs, which also count towards the bank's LCR. Have you considered when, for example, a repo transaction is defaulted, what happens to bank's LCR and the liquidity of on the MF and the AM? Thank you.
Very complicated question. Thank you very much. Maybe, I mean, what this rings me is the bell of basically, in this model, many things are stylized. And money market funds are only holding commercial paper. They could be involved in repo, and the connection between banks and money market funds could be in the forms of repo or reverse repo. Yes, I mean, we are not explicit about what these bank assets are. They could be central bank reserves. They could be treasury bonds. They could include loans, but then treasury bonds could also appear in the balance sheet of the money market fund. So reality is always more complicated than models. But I will say our message will go through, even with money market funds that hold treasuries and have to sell treasuries back to someone else when a dash for cash occurs, insofar as the treasury market is not a completely frictionless market. And we have discovered this year that the treasury markets are not frictionless markets, right? The gilt episode is an episode of struggles of liquidity in the treasury bond market. So I don't know I answered the question, but maybe because I don't have the final answer.
Yes, then we have a question here in the front.
Thanks a lot, Javier. Very exciting analysis. Actually wanted to ask, so have you thought about this Professor Diamond Dupwick's question, what would happen in this reverse situation when the money market funds actually attract a lot of flows? And another point, so your point was really thought-provoking about the regulation, so how should we actually think about those externalities? Of course, in the reality, we still have many more actors. And I'm actually wondering, have you also thought of expanding the model, having also investment funds who could be, then buying the equity of the firms and being also part of this very complex interaction? So what would happen in that type of situation? And what would be the optimal policy then?
Well, sure. If I see a model like this, it's just a stylized description of what happens in reality. I think that if we build on this type of blocks, we could have eventually a quantifiable model, ideally dynamic, that is able to connect the balance sheets of the different sectors. And the mutual fund sector is not just the money market funds. But my cheap answer at this point, as a microeconomist, let me play that role, will be that if you want a model of the interactions between banks and mutual funds, just remove one of the M's. And instead of commercial paper, you put bonds or TLAC or whatever the banks are selling to the market, to the mutual funds. If there is, because in a sense, mutual funds are also selling liquidity to their holders, to the holders of their shares. And the mechanics of what you are going to get is very similar. On the reverse, I'm not sure we have time, but if issuing commercial paper in a hurry, we're subject to the same congestion as we have in the secondary market for commercial paper, then the conclusions will be pretty symmetric. But maybe this is not that realistic. I think that banks are much more ready to issue commercial paper at short notice and without the frictions that we face in the secondary market, though the buyers in the primary market might be suffering a struggle, especially if what is originating the episode is a bank failure. Right, so I think that in the days after Silicon Valley Bank defaults, it's not that clear that the money market fund sector can absorb lots of new commercial paper without thinking twice who is the issuer, right? So I think that the logic could be very similar, but we have not explored what it means. I think that it means that this extra layer of intermediation doesn't come for free to the system. So yes, we might like less important banks in the system, but banks one way or another are the ones providing the credit to the final sector. Thank you.
Thank you very much, Javier. I think in the interest of time, we are going to move on to the next presenter, and we can continue discussions with Javier over the next break. Okay, so our next speaker is going to be Dilyara Salakhova from the IMF. She'll be talking about interactions now between derivatives margin calls and money market funds, and she's participating remotely. So just to let you know, Dilyara, I'll let you know by opening the mic when you have about 5 minutes presentation time left. But now the floor is yours.
Can you hear us? You can start your presentation when you are ready. We can't hear you yet, but yes, you can share your slides. We are trying to work out if the problem is on our end.
Maybe we can change the order. Yes. So, Paul.
All right, we're gonna do another speech right now, if you can still hear us. Okay.
Yes.
Let me see.
So I know Dilyara also works on climate change. So maybe I can give you the disclaimer. These views don't represent mine, but actually they're hers. But I don't think I'd be so bold. No, look, this was meant to be in the next session, but I'm happy to front load it, I think, now and try and preserve some time for coffee to go relatively quickly. What I can say is it's actually more a survey paper than it is a sort of narrow analysis. So what you're going to see is I'm going to bring you a tour a bit through what we've been doing in terms of dealing with multiple methods to try and give us the empirical basis that we would see necessary to inform broad considerations on macro-prudential policy for climate change. And these are still in a relatively nascent phase. So I think it's only in a better part of a year. We've been thinking about how would you orient prudential policy to deal with the issues related to climate change with a narrow financial risk perspective. What evidence would you use to justify that, and what potential tweaks would you need to have in the Macroprudential toolkit, at least here in Europe, to deal with that? And this is based on work of the European Systemic Risk Board, together with the Euro system that we're doing together. So with that in mind, let me skip forward to the next slide. Yeah, great. So what I would like to do today is, very quickly, it's going to be quite a quick tour. All the references to models or methods I'm going to survey are listed in the slides. You can always dig down deeper for more. And happy to take questions, of course. Okay, the thing is, of course, we want to think about prudential policy and motivating that. We want to start with presenting the evidence on risk, and that's basically what this is. And what you can see in terms of the background, what I'm going to do today in terms of the outline, is go from distribution to evolution of risk, i.e. the cross-sectional dimension of systemic risk and the time series dimension. And then talk about the prospect of systemic amplifiers. After that, I can make the switch then to what macroprudential considerations could be actually built upon these evidence-based considerations, and then give you a little summary. So without further ado, let me break in with just some background as a start. Now, this is not based on proprietary work, but just I think there's a variety of people in the audience today. We already heard from Steve this morning, which I think suggests many of us have strong priors. And that's not surprising. Climate, I think, evokes a lot of strong reactions. I think the goal of the work we're doing is not to come with an evangelical view of any sort. It's rather to bring as much measurement as we can to the question, to ask, would we necessarily be expecting systemic risk to erupt because of a climate change-related shock? Now, here's just about the shocks. It's the only thing I'll say about the shocks. The left-hand side chart, now this just comes from environmental scientists. And it's the idea, if you look at what we have to do to bring global warming down to 1.5 degrees centigrade, it's this green dotted line. It's extreme, and it should have already started. Rather, what we are is this pledges and targets blue shaded area in terms of government targets. And there's pretty much what I would call an inevitability to environmental science. Once you start putting greenhouse gases in the atmosphere, they don't disappear, particularly given we don't have carbon capture and storage and scale of in any way, and that won't come soon. So with this in mind, physical risks are pretty much inevitable. The question is what in terms of the government commitments, which are becoming more and more prominent, would imply if we were to actually have a transition to bring us to the 1.5 degree scenario. And this right-hand side chart is just one that was actually from a paper of Patrick Bolton and colleagues. And it's a very interesting one where they say if we're to actually have a fair experiment where you have the industrial composition of your investment portfolio in financial investments is actually fixed. And you can move it maybe plus or minus 2% relative to an industrial breakdown benchmark. So you can't wholesale move out of industries from all of your manufacturing into IT technology, but rather you have this fixed area. What would it imply in terms of reductions we need to see across the board? If we had started last year, it would be around 10% per annum reduction in greenhouse gas, so carbon intensity of portfolios. In 5 years' time, that's around 20%, and in 10 years' time, it's actually impossible to achieve. So with this in mind, if we are to believe government commitments that would get us on this green dotted line you see in the left-hand side chart, extreme things are needed. Recall in a COVID lockdown, we were talking about reductions in the greenhouse gas emissions of around 8% in complete lockdowns. So either we're going to have transition risks or physical risks or both. Now with that in mind, what our work has been doing is much more about trying to employ data we have at the disposal of supervisors, of regulators, and models to try and better understand what would be the exposures to such shocks. So not to talk about the shocks themselves, but more about the exposures. And with this in mind, we've basically, I'm going to start here with the idea about what the cross-section would look like. Where's the distribution of risk? And here we've tried to develop an idea that you would have, of course, you could look at exposures, and that's what I'll do here predominantly in the slides. We think about the non-financial sectors, the real sector exposures, the financial sector exposures. Before I get to the bottom part of system-wide, it's just where are those exposures, how do we detail those out? And then moving from exposure to risk is, of course, climate exposures alone might not tell you much. It's more about how does that interact with financial risk elements like leverage or questions about firm potential vulnerabilities or other actors in the system. Now, the reason I say firms a lot here, and I'll just skip forward to the next slide to give you to get to more data, is on the side of firms, that's where we have the best data when it comes to granular data sets. And so all the foundational work we've been doing is to try and build out a canonical data set we can use for all related elements of climate exposure and to map that into risk. What does that involve? It's the left-hand side column here, you have, of course, the physical risk and transition risk comes from experts in the field. So what would be your proclivity to have an exposure to a climate-related shock? So particular address level elements, you'll see in the next slide, which would have a high physical risk potential susceptibility. Transition risk is much more, of course, of carbon taxes, preferences in terms of consumer preferences or technologies, make carbon-related investments more difficult. And of course, it has different scopes of emission. It's quite complicated, but for the purpose of exposition today, just to say that you can have a composite score you can apply to any firm. And what we can do with these is map them into firm financials with identifiers we have of firms based on standard firm level data sets. So when you have firm balance sheet fundamentals or performance, you can link them through to what is their potential climate susceptibility. And then the last step, of course, is to bring it to financial exposures. So what would be happening in bank credit registries or securities holdings? So on the side of lending of banks or securities holdings. And we can look more broadly in securities holdings, of course, at investment funds and insurance companies and the like. ultimately, just to say, it leaves us with 2.3 million firms and quite some consolidated banking groups, around 400 and around 1,600 banks in the euro area. So with this, you can do quite a bit in terms of granular setting. And let me just give you a quick snapshot of what happens in terms of exposures on the physical risk side. So each dot here is a firm in this left-hand side chart. And what you see is that there's some high and projected, present or projected exposure over the next 20 years to firms in particular geographic locations. So obviously coastal areas are important for sea level rise, but you get into wildfires or heat stress, it's much more here in the Mediterranean basin. Flooding would be much more resident in Central and Eastern Europe, riverine flooding. Now with that in mind, what's interesting is you can actually map that through. So recall I showed you can have bank exposures, so in terms of lending exposures or securities holdings. What you see is it's predominantly in floods when it comes to high or medium, but it's not necessarily that large a proportion of the complete balance sheet towards firms, this is, of course. But if you look at any hazard, it starts to rise to a relatively high number, around 30% of their firm-level exposures could be to any one of these particular exposures. And of course, what Margarita will show you in the next session will be much more about the insurance protection gap. I don't want to talk too much about this, but of course, these are all gross. So gross exposures don't equate to net financial risk. And of course, on the side of net financial risk, you'd ask, are these insured? I think I can foreshadow what Margarita will tell you, I think, which is not terribly a lot, so around 25% of exposures tend to be insured, and it varies quite a bit across jurisdictions. So clearly on the side of physical risk, we are concerned about concentrations which are geographical or regional. On the side of transition risk, so what if we are to move in this setting where governments actually transition the way they say they want to do? Well, in this case, we would see that bank loans in particular are very much oriented towards high-emitting firms, so firms which are currently have a very high carbon footprint. And those need to be managed down if we're going to manage to have a transition to a lower carbon economy. So with that in mind, the exposure on the side of transition risk is much more going to be in the sphere of bank lending more than securities holdings, which seem to be adapting quite a bit more and are not necessarily as skewed towards high-emitting firms. And across industries, I think it will be definitely, obviously, some industries, the ones which are responsible for the production of a lot of greenhouse gases, like the electricity sector or mining and quarrying, will obviously be places we'll be looking for that adjustment to take place. But interestingly, I think the work we've been doing suggests, and this is a log scale, is that if you look within industry, differentiation is almost as important as across industry. So there are very energy efficient firms and energy intensive firms in given industries. So to apply a very strict and sort of broad brush tag to industries saying you are carbon intensive or not might be a bit heroic. And we'd be thinking more about firm level dynamics here. So again, the key takeaway, transition risk exposures tend to be sectorally concentrated or even within sectors at the firm level. Now what we've done, and I think this starts to get more interesting into the modeling side, is we've basically been looking at trying to have scenario analyses to give us an impression of what is inherently forward-looking. Because again, these physical risk phenomena tend to be ones in the environmental science sphere which have an inevitability to them. Once you pump out more greenhouse gases, there is global warming. It's almost an identity, if you will. Yeah? And so with this in mind, it's about looking at forward-looking methods to try and back that out. Now, stress testing models thus far on the climate side or scenario analysis are still obviously in a phase where we're trying to do more investigation of what constitutes the right modeling approaches. We have a variety of them, and I think it's the composite view which comes through looking at different perspectives, which is giving us the view on what we should be thinking about here in a forward-looking perspective. And I'm going to temporarily separate. So first, medium to long term. And that was the initial phase of work we've been doing here. And it was to say, if you have, of course, carbon-related reductions, so in greenhouse gases, you could imagine we are in a current trajectory where not much is being done, or you have adjustment which is either gradual or sharp and late. And with that in mind, you can build out then representative scenarios. And this is a lot of the initial work was about this. Do you have the trade-off, because I already showed you, of course, physical and transition risk in isolation, but of course they're related. The more transition, the less physical risk, of course. And with this in mind, you can imagine there's a particularly scenario which is more benign, say, or sort of as a benchmark, where you have this orderly adjustment through to ones where you have more transition risk or more physical risk. Now what we see, and I won't delve in this one in particular detail, is we have to, of course, adapt our models to deal with some of the peculiarities of climate change. And of course, you could spend an entire lecture on just talking about this. But let's say what's important here is as usual in a stress test exercise, you have macro level scenarios, and you try and feed these into balance sheet fundamentals, but it's about these transmission channels. These are the ones we need to adapt in our modeling apparatus to try and deal with climate-specific elements. And that is, where does carbon price actually start to bind or impinge on operating revenues of firms or costs? And where might you see the need for financial risk, so more leverage to deal with the necessary investments or adaptations to be there and lead into credit risk or market risk? And the same holds true on physical risk, and perhaps even more so, where these are areas we haven't necessarily been so focused in our modeling apparatus in the past, about elements of destructive physical capital through to production supply chains, or this element of insurance or adaptation costs, which again feed into firm costs, feed into losses. So with this in mind, we've been doing quite a bit of work here. I won't get into the big detail, but rather give you an overview that in the end it looks a bit like a J-curve. And no matter how you get around it, you need to invest quite a bit initially. There's a short-term cost of any adaptation, which would lead to likely higher defaults of any median firm in our sample. And the benefits would only start to accrue with around a decade time having elapsed. And those benefits, of course, start to outweigh the short-term costs as you move further out in the horizon. What is true is, I think, of course, to look at this is that there are, of course, a heterogeneity of firms, and we should play with the granularity in the sample we have to look at carbon-intensive firms and high physical risk firms who might see a very different sort of amplification along that path. So hence you'd see probably much more costly transitions for the high carbon firms and much higher risk, physical risk in the medium term for firms subject to those risks. Now, ultimately, I think what you can say about this is path dependence is very strong in these data, and that's a key finding we have here. Now, what we've done, just to round it out, short-term scenarios are becoming much more dominant now, because I think one of the critiques of the early work was that these long-term scenarios, decades-long horizons, A, you have very large confidence bands as you move out, as we all know, and B, I think actionable horizons for the perspective of a politician, a financial market participant, or just anyone in the economy, of course, is the one you want to maybe focus upon when you're thinking about financial risk. It's more congruent with our standard stress testing and more congruent with the way we think about financial risk. So with this in mind, we've been doing much more about what could happen actually in the short term. So this is just from our recently minted financial stability review. We have a box. And there it's just about the idea that you obviously, if we are to believe what the EU has in plan, in tow, for this reduction of emissions by 55% relative to 1990 levels, you could see that there's multiple paths get you there. And those paths will inevitably interact with the energy mix we have. And you'll need to move in 2022 through to 2030 in either of the accelerated or delayed transition, such that you also reduce, of course, the element of gas, coal, and oil, which is here in this light brown in these scenarios, and through to more renewables in the mix. And that's going to entail economic costs as we go along, of course, and you can see that PDs of firms obviously move around with this in mind. I encourage you to look at the box if you want more, but maybe better to just quickly talk, because in view of the time, as I started a bit later, talk about systemic amplifiers a bit before I get to macroprudential considerations. Now, all of what I've shown you so far, I think the dominant finding we've had so far, there's these risk concentrations, and a lot is happening in the granular setting. So a lot of adjustments are there, and you can imagine there are a lot of frictions along the way when you have these industrial adjustments. With this in mind, I think what we want to see is would there be potential for amplifiers to bring forward market pricing or bring forward prospective risks which could be occurring otherwise in the medium term? And we've come up with 3 different systemic aspects, and I'll walk you through them very briefly here. So one is the element where you could have, of course, the element of correlated defaults of firms when you start to make the transition risk intensities. So the carbon reliance of individual firms could determine credit rating agencies, for instance, we're looking increasingly at climate change, their perception of firms and their ratings. Should those ratings change, you could obviously have higher PDs, which result for firms. And those PDs would, in an interconnected network, here we're just looking at financial linkages, could lead you as you start to jack up carbon prices to ever higher levels towards more pairwise correlations of defaults and novel correlations. And the correlations might not be ones which are standard financial risk hedging. The other element, of course, is the interdependency of natural hazards. So a lot of we look at in climate change tends to be about unique incidences of heat stress, floods, or wildfires. But what we know is that these tend to be interrelated. So water, anything to do with water, floods, any storms, water stress, sea level rise, tend to beget more of the same types of natural phenomena. And the same holds true in the heat, stress, wildfires, linkages, whilst not even talking about the fact that these are even self-reinforcing. So wildfires tend to spread, of course. So with this in mind, it's hard to ex ante to draw up a natural hazard exposure such that you actually take into account these interdependencies, which we're learning about as we go along. Now, the overlapping portfolios, just let me speak to in the next slide, which is this idea that if you take a system-wide stress test approach, you can also look at the potential for cross-holdings of assets to lead to a rush to the exit. We've been hearing a lot thus far, of course, about liquidity stress and fire sales. This could be present also in the climate sphere, insofar as you have physical risk or transition risk dependent assets, which are fire sailed into a declining market. And what we find thus far is that much of this in the market space can result in quite some pronounced amplifications once you take into account the potential for fire sales beyond first-order impacts. And I won't be able to talk about this in detail, but you'll see a lot in the slide here, that these cross-holdings, overlapping exposures themselves can also lead, of course, to bringing forward shocks, which otherwise might be long-dated. I won't talk here much about spillovers, just to say the input-output interdependencies of firms matters a lot, so value chains. And when you think about some of the jurisdictions that will be susceptible to climate change, in the context of globalized value chains, this could imply obviously bigger adjustments than one would see just necessarily looking at the headquarter firm. And with this in mind, some industries seem to be ones which are more pronounced, where you have air transport, for instance, extraction of coal and others, where you could have quite some pronounced sectoral impacts through input-output chains, and that could impact through the banks. Again, I won't be able to talk through this in detail. The report gives you more about the elements which is referenced there. Just the last systemic aspect, I think this is the one we're learning about, and it's the more novel one, is the idea of risk transfer to sovereigns. And so with here, I think what we are concerned about is the following: that there are contingent liabilities on the side of sovereigns that are either explicit or implicit vis-a-vis state-owned enterprises, which predominantly we look in the past where sovereigns have had to actually, say up to 2014, we'd looked at around 15, 20 years of data. Sovereigns have tended to have to provide support on a contingent basis towards three particular industries: utilities, transport, and manufacturing. With that in mind, those are the types of industries you can imagine with climate change are going to be ones which are going to be in potential distress as we move along this transition and see marked reallocations. And on the other hand, of course, there's a question about financials, which have a contingent liabilities towards climate change. Could you see the irresistible temptation of sovereigns to actually step in and take on some of this risk? And as risk transfer, so bailout risk is something which is obviously one we're looking at in climate change as well. Now, I'm conscious of the time, and I just want to briefly go through what does all this evidence that I've showed you so far lead us to in terms of macroprudential considerations. And here I'd say it's more, in a sense, we feel that and I think the standard setting bodies have come around to the same view, that the standard risk channels we would have, the standard risk typology, credit risk, market risk, operational risk, liquidity risk, still holds climate change is merely a potentially amplifying feature to existing risks, rather than a new risk in of itself when it comes to financial risk. With this in mind, what we're concerned about, of course, is what would you see in terms of the prospect of micro and macroprudential policy to tackle this. On the side of microprudential policy, of course, we've been setting out a lot of requirements for firms to take up expectations, mainly for reporting and measuring and understanding the risk. What is true is on the macroprudential side, of course, it's going to be more about externalities and these systemic amplifiers I mentioned earlier. And you can think about classic systemic risk elements, but also the climate-specific ones. And I've shown you about novel risk concentrations, carbon-intensive sector lending, which might itself be at risk as a collective whole, or the element of amplification when you have also particular overlapping portfolios. With this in mind, we've been looking at the macro side, also thinking about resilience purposes. So all of this is about financial risk, not about tackling climate risk per se, which is in the sphere or jurisdiction of industrial or fiscal policy. Nevertheless, the financial risk which emanates from inaction or action is clearly going to depend on and interact with this industrial fiscal policy. So you cannot treat prudential policy fully. It's almost a conditional experiment to some extent, conditional on the types of adaptation measures whether being taken. Now, on the policy side, what I wanted to get to is the following. We've done a quick look at what would constitute broad categories we could think about adapting in the macroprudential space in particular. So lender vulnerabilities on the side predominantly of banks here. I think you could also talk about non-banks, but let's focus on banks where the macropru toolkit is most established. And you could think about absolute risk requiring more capital in the system potentially, or relative risk. So different, I've talked a lot about granularity, industrial adaptations. So relative risk might be a place you want to look, risk weights or questions about concentrations. And obviously then the capital, non-capital based follows. Borrower vulnerabilities could also be there when it comes particularly to real estate. A lot of what I showed you here is about firms today. But of course, in the real estate sector, we're seeing energy performance certificates become much more prevalent in terms of their binding nature. With time, we'll be able to measure that better. We still don't have the granular data sets in the same ways we do for firms to tackle it. And lastly, of course, it's not just allocator, but informational failures, and a lot is being done to try and rectify those. Now, a lot to digest here. Again, it's in a report that's cited. What we can then foresee is that if you look at the existing toolkit in the macropru space, what we have is some candidate tools which could be considered. And the ones we consider most promising along the angle here is one which is a more capital-based systemic risk buffer, which you can deploy in Europe. So it's a very European instrument. It doesn't exist in other jurisdictions in the same way. But you can deploy it at a general sense or a sectoral sense. Now, sectoral is also not well defined, that it need not be existing economic sectors, but groupings of some sorts. And the groupings could be a function, of course, of transition intensity foreseen, not the existing carbon dependence. Concentration thresholds is one which is obviously not necessarily as capital-based, but still could get you out of the egregious sort of elements of very large carbon concentrations, which could come back to engender systemic risk. And I talked about borrower-based measures. Now, just on the capital side, I think there's a very useful recent paper by the Fed, which has talked about the question of whether climate risk will increase you could think about it as increasing the mean or the variance or both of potential losses in firms. And I think that's the key one to understand what will be provisioned for expected losses and what will inevitably be ones which will have to do with capital, so what is not provisioned for and unexpected losses. And with this in mind, I think that we are still, I'd say, in an investigative phase. We're not quite there yet. How these interaction of climate risk drivers, the interaction of risks, correlated shocks, feedback loops, end up driving losses into potentially a higher mean setting, which means you'd want macroprudential supervisors to encourage provisioning, or maybe capital. In the end, you cannot actually understand the distribution of losses so easily ex ante, and you have to deal with potentially ex post concerns. With this in mind, I'm conscious of the time, so I don't want to be too long. Is that we're already eating into the coffee break. So macroprudential will probably be then having this overlapping set of a prudential space. You have some shared elements and you have some systemic elements which are distinct from the macroprudential counterpart. This just gives you a little bit of a breakdown. And of course, you can think of it as somewhat of a continuum. And depending on the extent to which you have externalities in the system driving it towards the macroprudential components which are listed here, or the more idiosyncratic ones which are listed here. And I think this is our current work in progress, our current homework. So without further ado, let me just quickly summarize. So we have climate shocks. I think hopefully with the evidence in the first part, you walk away with an appreciation of the concentrations which are there, and this idea that you might have some bumpiness given systemic amplifiers. And then the element of macroprudential policies, of course, is going to be this element of trying to have a financial risk focus, so loss absorption, so resilience, loss absorption capacity, and the system-wide element that risks largely in this sphere, in our view, will necessarily move because of these elements of overlapping portfolios or common exposures into the broader and not just bank sphere. Now, of course, what's clear is going to be about the attribution of policy intensity between prudential efforts and other efforts. And as I say, that's going to be, I think, one which we have to watch closely that we don't have mission creep. So with this in mind, it's work in progress. All feedback is welcome, maybe in a coffee break at this stage, since I think everyone probably needs one. Do you want to try a question or go do it in coffee?
Let's see if we have a quick question. Yeah, thanks a lot to Paul, and thank you also for your flexibility in stepping in at kind of short notice there, basically. Do we have a quick question here from the audience? Or yes, Javier, please. You can.
Thank you very much for the presentation. I'm intrigued about two things. So one, well, many others, but one is how to accommodate the response of the prudential regulators, both micro and macro, to the fact that many of the high emitters need to adapt, right? So I think there is a danger of a front-loaded policy essentially eliminating them instead of favoring their transition, no? Their technological adaptation to become greener. And that's a little bit of tricky to me, no? So if you penalize the current emissions, you are not properly distinguishing those with the ability to adapt and those without the ability to adapt, but maybe you are making the cost, the financial cost to those who need to adapt higher. Huh? And then I don't have much sympathy for concentration measures because I think that although they look very appealing from a partial equilibrium perspective, you are pushing whatever you are limited at a given institution to another institution or to another sector, and then also it forces you to take a view on what is an optimal quantity, which I think in the world of externalities is much harder to decide than what is an optimal price. So in a sense, I would prefer capital type measures for penalizing the externality producing activity in terms of financial risk.
Super. I think they're both great questions and ones which I can maybe then even try and synthesize in a single answer. Let me try. Which is, in the central banking side, the analog has been tilting versus exclusion. And I think that's an important consideration because if you're tilting, it's something you can put in place and communicate. It's almost like signaling versus portfolio rebalancing. You signal you want a transition in sorts, and you don't have any initial requirement, but you signal in the future, I might increase the requirement with time. And as such, with the because I think we have a steady state we can see ahead of us, which is firms will, and with certainty, have to produce transition plans. That is coming, but we don't yet have those. So absent these transition plans, we still have commitments which are on page 162 of annual reports of firms, of varying degrees of credibility. And with that in mind, I think it's going to be this element of trying to signal that this tilting would be a more active measure to try and consider with time, as information becomes available, what will be the roadmap in terms of forward guidance almost, where will we be asking for more, rather than exclusion as such, where as you rightly point out, A, there's a boundary effect, you start to move it around the system in ways which is unhelpful, and B, establishing the thresholds might themselves also be subject to controversy. And C, it may be counterproductive, as you say, because you also take the firms which should be greening. If that's the goal is to reduce carbon intensity of the economy in an orderly rather than disorderly way, one would want to make sure that that happens in a way where you're actually greening. You're not just putting all your money into ICT instead of manufacturing, which would be highly disruptive. So this in mind, I think that the questions are well taken. Honestly, I think the answer I provide is still rather high level, but I think the direction of travel we're moving is not immediate imposition of requirements, but rather communicating a roadmap.
Great, thanks a lot. Perhaps now it's best to adjourn and continue the discussions over the coffee break. Thank you, everyone, for attending the session.
And welcome to the last session, number 4 today, and then followed also by a keynote. So as you know, there was a swap of slots, so now we would continue with Dilyara Salakhova from the IMF. Apparently, well, we are hearing her. I'm not sure if she's hearing us, but that's all right. There's a chat also. So Dilyara, please, the floor is yours.
Okay, hello everyone. Sorry for the technical issues. I can't hear anything, so but I'm happy to be here, and I'm happy to present the work I've done with my former colleagues at the ECB about the derivative margin calls. Is it a new driver for money market fund flows? And let me start with the motivation. So in March 2020 market turmoil, we have seen a large volatility in money market flows. You can see it on the chart on the right. Particularly between March 13 and 20, we saw that Euro area money market funds experienced outflows of nearly 8% of the assets under management. And these outflows were stabilized thanks to the responses by the central banks, such as the pandemic emergency purchase program by the ECB. The outflows from the money market funds can have significant consequences for financial stability and also funding of the real economy, as financial institutions like banks, but also non-financial corporations rely on short-term funding provided by money market funds. So the question we ask is, what are the drivers behind these flows? And before we dig deeper, I want to start with giving you some main concepts, reminding probably for the most of you. So first, money market funds have two important functions for the financial markets. First, on the asset side, they provide short-term financing to financial institutions, corporations, and governments. On the liability side, they serve as short-term cash management tools for investors to provide a high degree of liquidity, diversification, and stability of value. As for margins, they're collateral that are required to protect the two parties involved into a derivative contract in the event of default of one of the counterparties. So there are two types of margins. First one is initial margins. Those are posted at the execution and adjusted during the lifetime. So their aim is to cover losses between the last variation margin payment and liquidation of the trade. So variation margins are daily payments, usually in cash or in highly liquid assets that reflect fluctuations in the market value of the contract. So the European money market funds manage about 1.2 trillion euros of total assets. The majority of this, so the euro-denominated funds represent about 46% of this value, while the remaining are USD and GBP-denominated funds. In terms of domicile, the European money market funds landscape is represented essentially by Luxembourgish, Irish, and French money market funds, managing essentially 95% of the sectoral assets. And within the euro-denominated money market funds, French MMFs prevailed, managing about 61% of the total assets. So in our study, we will focus only on the euro-denominated money market funds. And I want to show you first some empirical, even more anecdotal evidence of the relationship between money market fund flows and the variation margins faced by the insurance companies and pension funds in the Netherlands. So on the left chart, you see the two curves. One is the yellow is the cumulative net flows into Irish and Luxembourgish euro money market funds. And the blue one is the estimated net variation margins received by Dutch ICPFs. And you can see that over the period mid-February, end of March, really the heat of the pandemic turmoil, the correlation between these two curves is about 80%, really high. So if we want to know, so what drives the variation margins? So we look at the what investors hold. So and the insurance companies and pension funds hold to a large extent derivative contracts in credit derivatives contracts in interest rates and foreign exchange. So and we overlap the variation margins received with the 30 years OS rate and the Euro USD foreign exchange rate. And we see that indeed the variation margins are driven very much by these two underlying curves. So then the question is, again, we know this sequence and we want to show that the variation margins drive the outflows from the money market funds. And that's what we will explore. So this is our main hypothesis, that variation margin payments is a driver of money market fund flows. In the literature, there are also other hypotheses, such as flight to safety or characteristics of money market funds. For example, the low volatility NAV structures, LV-NAV, which are common for the Irish and Luxembourgish funds. So they have been identified also as a source of the outflows from the money market funds when investors start worried about the liquidity characteristics of these funds. So our standpoint is that we propose a new additional channel. So we say that, okay, there are reasons related to the funds, money market funds themselves, but there are also reasons related to the investor side, why there are outflows from the money market funds. So, and we say that this variation margin payments is actually a new source of liquidity stress for institutional investors during crisis times. And because institutional investors use money market funds for liquidity management, so they also pass through the liquidity shock from from variation margins to the money market funds and from there on. So the preview of the results, we do find that variation margin payments faced by some non-bank investors holding money market funds were an important driver of the money market fund flows. And we have a double result. So because we look separately on the money market funds outflows and money market funds inflows. So, and we see that indeed both channels are active. So the rest of the presentation is structured as I will talk to you about data, model, results, and conclusions. Let's start with the data. We have really 3 highly granular and unique data sets. We start with the fund-by-fund Refinitiv Lipper to obtain daily money market funds flows at fund level. So the best granularity we can have. Then we use the securities holding statistics by sector to identify holdings in individual money market funds by investors. And here there is a big unfortunately, is that investors can be identified only at the country sector level. So instead of knowing that this particular insurance company holding that amount of assets in money market funds, we know that only French insurance companies hold that amount of shares in this money market fund. And then we have the biggest data set is the transaction by transaction EMIR data to compute variation margins. And again, here we have data at the investor level, but because the holdings are at the country sector level, we have to aggregate variation margins at the country sector level. And as I said, we focus on the euro flows, both euro-denominated money market funds and the euro variation margin payments. And our estimation period is during the pandemic, which is February to April 2020. Here we can look how the margin calls and money market funds outflows look like. So on the left-hand side, you see the variation margins posted, the positive, and the variation margins received, negative values. You can see the volatility of the variation margins over the period. And you can see that two curves are almost symmetric, but not exactly. So it's actually normal that the two curves are symmetric because margin payments is essentially 0-1 game. One firm receives, the other has to pay. Why it is not exactly symmetric is because in our sample, we have only European companies or euro-denominated transactions. So sometimes we see companies which are outside of the perimeter and we see only one side. So on the right-hand side, we have money market funds outflows or flows. And as I mentioned, we look only at the three main domicile, which is France, Ireland, and Luxembourg. French funds really stand out, a very unusual pattern of inflows during the beginning of the year, significant drop in significant outflows in March, and then stabilization at a lower level over the spring. While for Ireland and Luxembourg, we see this important volatility of flows getting into the funds and then leaving and then returning and stabilizing at positive levels. So our hypothesis, again, variation margin posted by money market fund investor can lead to money market funds outflows. In terms of the regressions, it looks as follows. So we regress outflows of fund I at time t on the main variable of interest, which is the interaction variable between variation margins posted by sector G at time t times the fact that this sector holds money market funds at this time, this specific money market fund at this time. So it's this held GI is one when this fund is held by investor G and zero otherwise. And so we are interested in this coefficient beta G, which we expected to be positive and significant, at least for some investor groups. What is important to notice is that we run our regressions separately by domicile. And we control also for times fixed effects and for funds fixed effects. So here we have top 10 holders of euro-denominated money market funds by domicile. So essentially what we do is that we reduce the dimensionality of our problem, because we have in the database 190 investor country sector investors, and we can't run the regression on 190 investors, which also doesn't make sense because not all of them are relevant. So what we do, we first choose top 10 investors which are significant holders of the money market funds of a specific domicile. So what is interesting to see here is that, again, French money market funds really stand out. There is a high concentration of investors holding these money market funds in the domestic sector. So it's essentially French insurance companies, investment funds, and NFCs, which hold more than 60% of the French money market fund shares. While for Luxembourgish and Irish money market funds, we see there is quite a significant heterogeneity, but already within the first 10 investors, we dropped to either below or around 1% of holdings. So then we look at who of the investors, of this top 10 investors, who are the investors who also have large variation margin payments. So actually, who are the investors who do trade derivatives? So, and this you see in bold. So like this bold are the top 5 which also have large derivative positions and who are relevant from this point of view. So here you have the statistics. For example, you can see on the first line, it's the French banks who have the largest derivative position and the largest variation margin flows. But because French banks hold almost none of the money market funds, we exclude them from the analysis. And then the top three, we see the Dutch pension funds from our example in the empirical evidence. Then we have Luxembourgish investment funds and we have German investment funds who have the largest variation margin flows. And then if we look at the regressions, it is not surprisingly that it is these three investors which appear to be significantly important drivers of the margin calls for these investors appear to be statistically significant drivers of the money market funds outflows, essentially for all the three domiciles. And if we think of the economic interpretation, it is essentially the following. So and we can have a look at this Dutch pension funds driving the Irish money market fund flows. So when Dutch pension funds post €1 billion in variation margins, Irish money market funds held by this Dutch pension funds are estimated to face outflows of around €11 million. So it's not a huge effect, but it is economically significant effect. And in fact, our results are somewhat underestimated because of the data we use. So if we had data at the investor firm level, we may have much larger effects. But because we have to aggregate them at the country sector level due to the data specificities, we are probably reducing this effect because for some companies, the effect can be stronger, for others smaller, and so with some sort of average out the effect. Then as a robustness test, we also look at the forwards. So why forwards is because our position is from the money market funds point of view. So if money market funds experienced outflows is because, money market funds flows experienced outflows. This means that today, tomorrow, or the day after, these investors have to post their margins. And so we look at the forwards. And so here what we see is that essentially it is only the contemporaneous effects which are significant. As for the money market funds inflows and variation margins received, so here we look at the lags, because if if money market funds received flows, it means that today, yesterday, or the day before, investors received some variation margins that they later put into the money market funds. And we see that essentially it is, again, the contemporaneous effects that prevail. There is only one effect with the lag. When Irish insurance companies receive 1 billion in variation margins, the next day Luxembourgish money market funds receive 40 million of inflows. So, and now I can conclude that variation margins faced by some non-bank investors holding money market funds were an important driver of the money market flows. The effect is stronger for the margins posted, which tend to increase the money market funds outflows, as some investors quickly redeemed money market funds to pay their margins. The effect is somewhat lower for the money market funds inflows, and this is actually probably due to the fact that investors, especially during the crisis, when they receive margin payments, they don't hurry up to put their cash into the money market fund shares, but they probably rather keep them at the deposit or somewhere closer. So non-banks used money market funds to manage liquidity related to margin calls. And we saw that in March 2020, this liquidity shock from the margin calls was propagated to the money market funds, but also to the funding of banks and NFCs, which is not part of our analysis, but this evidence is available. And our paper has important policy implications. So first, I remind you that the OTC derivative, so over-the-counter derivative reform, required stricter margining, and this helped to reduce counterparty risk that was prominent during the 2009 financial crisis. But at the same time, these stricter margining practices increased liquidity risk. So this is the first point. The second point is that the same reform required data reporting, and this is thanks to this trade repository data that we were able to analyze the behavior and the relationship between margin calls and money market fund stress. So what are the two main policy implications is that first, investors rely on money market funds for their liquidity management. And they assume that the money market funds have the cash-like properties, which turned out not to be really the case during the turmoil. So the first point is really to enhance the liquidity preparedness of investors. But the second point is to enhance also the money market funds' resilience to the significant outflows and somewhat improve the cash-like properties. So this is kind of the two sides of the same coin. So we improve the money market funds' cash-like properties by, for example, requiring high liquidity buffers. But we also require investors to take care of and being prepared that money market funds are not as liquid, especially during the crisis time, as the investors hope. And the second policy implication is that we need to enhance monitoring and understanding of interconnectedness, because we can see how from a very different part of the market, shock can be propagated to another side of the market. And this can be done with regulatory reforms to enhance data collection or to do the new data collections. And this paper, this study is just the first step, because indeed, money market funds are not the only source of liquidity for non-bank investors to meet their margin payments. And there are other sources like bank deposits, liquidation of assets, repos, etc. And it would be interesting to see how margin calls affect also other types of the markets. And also, so we focused our analysis on the variation margin payments, but the initial margins have been shown to be volatile, to rise significantly during volatile periods of like a crisis. And so this is something that could be explored further as well. And I thank you for your attention. Okay. I remind you that. So I remind you that I can't hear you.
Okay, so.
Okay, I see you will remember. Okay, thank you.
Yeah, so the situation is still that that she doesn't hear us, we hear her. So we decided that you could contact her directly with email if you have any questions. Salla is conveying this message via chat or email to her. Then again, if somebody has a comment, maybe Javier, maybe someone else that you would just like to share with us here, please feel free. But we can, of course, continue talking about this excellent presentation later on during the pauses and the evening program. So, given this solution and decision in the situation, so we are ready to continue with the second paper of the session. So Margherita Giulzio, I hope I got the pronunciation close enough, and the macroeconomic effects of the insurance climate protection gap, very exciting. Please, the floor is yours.
All right, so thanks a lot to the organizer for giving me the possibility to present this paper, which is quite topical, unfortunately, as the different catastrophes that we have seen in the last months. And it's on the macroeconomic effects of the insurance protection gap, specific to climate events. As you can see, this is a joint work between ECB and EIOPA. So here is the bunch of authors that have helped me in addressing this topic. And the usual disclaimer applies, as these are our views, not the one of the ECB, Eurosystem, or EIOPA. So let me provide first a bit of background. We have seen in recent decades that the number of relevant natural loss events has increased worldwide. This is not only because we have better data and a better understanding classification of these events, but also because the economic activity in specific areas have increased. And therefore, if hazards are natural, the disasters are man-made, in the sense that we can control the exposure and the vulnerabilities to certain risks. And indeed, it's about the vulnerability that I'm going to focus today and how to minimize it. So when we project or try to project the impact of climate change on the economy, we cannot just consider the frequency of these hazards, but also other factors that are able to mitigate or amplify the effects on the real economy. And one of these factors that we find to be quite key is the provision of insurance. As you can see on the right chart, also the insured catastrophe losses have increased in recent decades, as particularly the ones that are related to weather events. So the contribution of this work is indeed to understand the role of insurance in building resilience. There is already a bit of empirical literature assessing the benefits of having an insurance versus other type of protections like government payments. And insurance appears to have a beneficial effect on GDP growth because it provides liquidity in a prompt way and is able to speed up reconstruction, which is a key factor to minimize macroeconomic losses. And there is both macro and micro evidence of these benefits. Now, what is the current gap, so the share of uninsured losses? In Europe, this is quite high. On average, around 1/4 of climate-related catastrophe losses are insured. And you can see that this number is quite heterogeneous across countries, with some countries having insured losses as lower than 5% of the total. But not only the status quo is worrying, it's also the projection of this insurance protection gap going forward, which is expected indeed to increase because of the frequency and severity of disaster. So the contribution of this paper is at least threefold. There is also a fourth one. So the first is to provide a theoretical model showing that insurance is beneficial, at least on mitigating macroeconomic losses, so mitigating losses to GDP. We also try to analyze this from an empirical perspective, so providing evidence of how insurance has helped in past disaster to mitigate losses. Very briefly, I will go through also a scenario analysis of what could be the future impact of disasters with and without insurance coverage. And then the fourth contribution is actually regarding a follow-up paper which has just been published by the ECB and the EIOPA as a discussion paper, providing some policy options to reduce the climate insurance protection gap. So I'm going to focus today on the first 2 points, but also would like to provide, if time allows, a quick overview of the policy options to get your feedback. So let me start with our models. Here is an overview of the final model of output, but I'm going to explain step by step how we arrive to that formula. So for simplicity, we abstract from the impact of disaster and climate change on labor, and we're going to focus only on the impact on capital. This is just a first step to modeling output as a function of these variables, so we have to simplify quite a bit the equation and make some assumption. So the first one is that we model output as a function of capital, K, temperatures, or any other climate-related variables. You could think of precipitation as well, but for simplicity, I'm going to present only temperature here, and natural disaster, which are intermittent but highly destructive disasters. So capital is sensitive to both this increase in or change in temperatures that we model as deviation from the historical norm, and disasters that are modeled as jump processes. But disaster also affect insurance provision. This is not. This is usually the case when we see a disaster that insurance prices or insurance premium increase, or the supply decreases as an effect of the losses. But we also think that insurance is sensitive to changes in temperatures because of the effect that these have on the frequency of the disaster. So we model this endogenously. So as I said, let me go through this model step by step. First of all, considering the impact of natural disasters on capital. Here you see our output Y as a function of initial capital K, which when a disaster hits is reduced by an amount, 1 minus Z times K, which is the damage. And insurance there plays a beneficial role in reducing these capital losses, and you can see it here as WK. These are the insurance payout. So the intuition here is that output growth is constrained following a disaster, as both the available capital, the stock of capital is reduced, and because resources are allocated away from the optimum. So there is a misallocation after a disaster. So insurance payout can reduce the uncertainty and support the demand and investment for reconstruction, accelerating the recovery. And this is without assuming any effect of climate change. It's really only dependent upon disaster. You may think this is a quite intuitive result, but it hasn't been shown, let's say, in this type of macroeconomic models. So what happens when we include the effect of climate change? Let's focus first on the direct effect of increasing temperatures on capital. What we see here is that in the long run, capital is sensitive also to changes in climate variables, and here we borrow this technique from Kahn and co-authors, where they also actually include precipitation as climate variable, but here for simplicity we exclude it. And the intuition here is that the impact of global warming on output growth occurs via gradual losses on physical capital. You can think of this as land desertification or sea level rise that can reduce the available capital, or a reduction of natural resources productivity. So as a result here, if global warming directly affects capital without changes in the probability of disasters, then the output growth in this equation is lower than the one in the previous slide. So climate change makes the impact on capital worsen. Now, what happens when we also take into account the impact of climate change on the insurance? We add here a third term in the equation. That basically affects the provision of insurance. So the protection gap can widen because either the insurance premiums become too high or insurance decides to retreat, which has happened in many high-risk areas. And what happens here is that obviously the frequency and severity of disaster that depend on climate change increase, and therefore the resulting impact on capital and output growth are worsened. So if you think of the comparison with the previous slide, this output growth is going to be lower if the sensitivity here psi is larger than 0. So this is the, let's say, the macroeconomics behind our model. There is still the missing step of calibration on which we are working, but it's basically all you need to know about the model. So in the empirical analysis, what we do is to test the first prediction, the first step that I've shown you. So abstracting from climate change, we see if the prediction of our model of GDP, on the impact of GDP growth of disaster are verified on a bunch of countries and events. And what we expect from our model is a positive relationship between damaged capital, a negative relationship between damaged capital and GDP growth rate, and a positive relationship when insurance is high. So the share of insured losses is high enough. And basically, here what we try to do is that to show that with historical evidence, insurance has been beneficial, especially for highly disruptive disasters. So this is our sample. We have as dependent variable the quarterly real GDP growth rate from the OECD for 45 countries. We include both advanced economies, but also some emerging markets like Brazil, India, Russia, and Turkey, as there the insurance or the provision of insurance is even lower than the one I showed in the background slide. As explanatory variables, we use the disaster data from MDOT, which is quite a standard database for disaster analysis. And the overall data here cover 5,000 of disaster events since 1996. But unfortunately, we have information on the insured losses only for a bunch of them, 657. On average, these are the larger events which have information on insurance. So the first step that we take is to impute this share of insured losses to arrive to around 2,000 events in our sample to have this split. And this imputation is performed at a country and disaster type level. So just to give an example, the average disaster cost is around 0.16% of GDP, while the average share of insured losses is 47%, so a bit higher than the aggregate statistics. The pie chart also shows the type of events that are included in our sample. As you can see, most of them are hydrological events, also meteorological, geophysical, and climatological. So among the geophysical ones, there are also earthquakes, which you may claim they are not related to climate, but we keep it in our sample because they are among the highly destructive hazards. And since we have information on these for insured losses, we like to keep it in our sample. Just it doesn't really affect our question. So here are the results using this panel regression as dependent variable. We have the quarterly GDP growth rate, And here we show the two independent variables of interest, which are damages as share of GDP and the interaction between these damages and the share of insured losses. So in the first two columns, you can see the results for the original and imputed sample, for which we have obviously more observation, while in the third and the fourth column, you can see the effect of the lagged independent variables, because we want to see if there is a rebound effect on GDP growth, but I will explain it later. So what we can see from the first column is that there is this negative relationship between damages and GDP growth rate in the quarter of the event. And this relationship or this impact is mitigated by the share of insurance. This is true also in the sample with imputed insured level. As you can see, the significance, but also the magnitude of the coefficient stay the same. Now, very interestingly, in the third and fourth column, where we have the lag of this dependent variable, we see that there is a rebound in GDP growth. And this is quite common to observe, and this is due to the reconstruction effects. So all the activities that affect or actually have a positive effect on GDP growth rate in the subsequent quarter. But this is also speaks about maybe the unreliability of this measure of GDP growth rate when it comes to welfare, to measuring welfare effects. So just to provide the economic magnitude of these results, here there is, let's say, the linear impact of natural disasters on GDP growth rate using different size of damage on the y-axis. On the x-axis, and a different insured share that you can see in the different colors. So if we take a large disaster creating a loss of 1% of GDP, the effect on GDP growth rate in the quarter is estimated to be around 0.25 percentage points in the absence of insurance. Now, the average GDP growth rate in our sample is 0.7%. So this means that the impact of not having an insurance would be a decline of GDP to around 0.45%. If instead half of the losses are insured, which if you remember the first statistics that I've shown you, it's a situation better than the current one, then the GDP growth rate only falls by 0.06 percentage point. And if we have an insured share of 75%, which is very unrealistic, the estimates suggest an increase in GDP growth rate due to the boost of the reconstruction activity. But as I said, 75%, it's really unrealistic, and in our sample, we see it only in very few cases. Now, to take into account some non-linearities, which, as you can see here, could be quite important, we estimate a different specification in our sample by using a dummy variable indicating if the event is highly insured. So where the threshold of highly insured damages is 35%, which is the median in our sample. So what we see here is that GDP growth rates decrease following large-scale disaster of around 0.1% of GDP when insurance coverage is low. So you can see it here. Not only in the quarter of the event, but also in the subsequent ones, meaning that there is a persistent effect of the catastrophe on the country GDP growth rate. If instead the insured loss, the share of insured losses is high, and high meaning higher than 35%, then we do not find a statistically significant impact of catastrophe in the quarter of the event or afterwards. Now, I think I have still some time to present to you a bit of a scenario analysis. This is not really the focus of our paper, but it's just to provide a more forward-looking perspective on this topic. Using the scenario provided by the JRC Peseta 4 exercise, we estimate the impact on GDP of the protection gap under different scenarios, here of 2 and 3 degree temperature increases by the end of the century. So in the table here, you see the expected annual damages from climate-related catastrophes of different events as estimated by the JRC colleagues. And we take the numbers or the scores of insurance protection gap provided by EIOPA. Projecting our estimates that we have seen in the previous slide forward in time, we assess then the future impact of natural disaster with different levels of protection gap under these two scenarios. So here I show the finding on the severe one, so on the one which expects 3 degrees temperature increases by the end of the century. And we can see that there is quite some difference in the economic effect in different levels of insurance coverage. You can see here on the chart the level no insurance, the current one, and full insurance. So by 2050, the difference between full and no insurance would be around 3% under the severe scenario, and by the end of the century, it can widen to 14%. Now, of course, this exercise has many caveats because there is significant uncertainty around these estimates of 30, 80 years into the future, and also it assumes no adaptation or mitigation measures, but it's just an exercise to provide a bit what could be the impact in the next, or in this century. So let me conclude and give a bit of the sense of policy implication. So what we find in the theoretical and analytical part is that climate change has the potential to impair the stable provision of insurance, and in this sense has therefore a financial stability impact. And the losses could create some financial issues for households, firms, but also banks, as the connections that also Paul highlighted in the previous presentation. And this could be a problem also for sovereigns, because in the absence of insurance, sovereigns may need to step in and provide ex-post financial aids to these households and firms hit by catastrophe. And it could create some suboptimal, let's say, solution in terms of capital and financial and fiscal allocation. The second conclusion is that there are significant data gaps on climate losses and the part of insured losses. So what I've shown you and what we have used in the paper actually rely on two main data sources, which are the protection gap dashboard that has been developed by EIOPA and this MDAT database, which have significant caveats related to data availability and data collection. And third, and it's about this is about the other discussion paper, there should be policies to reduce the protection gap. And here, just in the last minutes, I would like to highlight what we found to be quite relevant from a policy point of view to implement, both for the private insurance sector, but also for the public sector. So as I said, this is the result of a discussion paper that has been published recently, and as the name suggests, we are very open to any feedback and comments you may have on these policies. So here we take the so-called ladder approach to reduce the climate insurance protection gap, starting from policies that could be useful for highly frequent but low impact events. So the base of our ladder is private insurance, which remains the primary line of defense against catastrophe losses. And here our colleagues from EIOPA have worked on what is called impact underwriting, so an improvement of the underwriting and pricing strategies of cat policy contracts. Now this pool, as you've seen in the first slides, is quite poor at the moment. So this base is not as wide as we would like to. And this is also related to the fact that a lot of households and firms are not aware of the risks that they face or how much they are exposed to specific catastrophes. So the first line of defense would be to increase or make this insurance pool wider. The second rung of the ladder is related to reinsurance and alternative risk transfer, also via financial markets. If you think of cat bonds, for example, it could be a way to transfer risk to other investors that could diversify their portfolio by making it dependent on something that is not related to financial markets, like catastrophe risk. And then we could also see benefits at a national level for public-private partnerships, because the private insurance sector cannot really, there are some distortions related to moral hazard and adverse selection, and because of that, public sector may need to intervene. For example, if in high-risk areas the premiums increase and become unaffordable, then the public sector may need to provide a backstop and ensure that this premium become low enough for people to insure. And then for very low, frequent, but highly impactful events, we would see benefits also of an EU insurance component because of risk diversification across member states, but also because this EU mechanism could provide some conditionalities and a further backstop to national schemes, while at the same time promoting adaptation policies and complementing existing instruments like the EU Solidarity Fund, which has not been very much used by member states for catastrophes. So with that, let me thank you again for the opportunity to be present here. As I said, we are very much open to any comments or feedback, both on the analysis, but also on the policy options. So please do reach out. Thank you.
Thank you very much, Margherita. So we have plenty of time for questions or comments. So please, Javier, please start.
Thank you very much. Let me start saying I sympathize with what you are doing. I think that there can be an insurance gap, and you are offering very thought-provoking evidence. As a macro modeler now, I feel a bit frustrated with your theoretical framework, at least in a first approximation to it, because you seem to model the effects of insurance or not in a very technological manner. If I understood the model, the same catastrophe with insurance seems to destroy less physical capital. This is very hard to digest. But then during your talk, I was sort of imagining what would be my fuller structural model in which I could make sense of that. I think it will be one of firms potentially subject to financial constraints. They carry some net worth. So without insurance, maybe the catastrophe eats up their net worth and their financial capacity to reconstruct. Insurance is providing a flow of finance for the reconstruction, is not avoiding the destruction of the physical capital, right? So I think that the time to build a new physical capital and the potentially greater cost of reconstruction in terms of physical materials, etc., is going to be there with or without insurance. But the financial capacity of those directly affected by the catastrophe varies across regimes. I can imagine that I could produce the structural model in which eventually your reduced form is sort of possibly justified. But in that model that I have in mind, what is key to the transmission of the effects of insurance is eventually the speed at which, if at all, the firms affected by the catastrophe can survive and reconstruct their destroyed assets. I think that regarding your empirical evidence, one point to take in mind is that the countries, I think your analysis at country level, have self-selected into using insurance or not, right? I think you run regressions and show that countries where the proportion of insured losses are bigger suffer less with catastrophes. But in a theory of insurance, What is insurable is idiosyncratic risk. What is not insurable is aggregate risk. So it could be that the countries that have a lower fraction of their catastrophes insured is because there is more of non-insurable risk in those catastrophes. So then the extrapolation to the policy front is a little bit more complicated. We'll have to deal with this endogeneity of the proportion of insured losses that you observe at the moment. That, again, I believe in the story that could potentially lead to justify policy intervention, but that should be based on externalities of these net worth channels preventing reconstruction or some sort of aggregate demand externalities, especially in the affected areas that feed into the GDP dynamics, and could justify eventually something like a subsidy on privately provided insurance. Thank you very much also for giving me the chance to think about this.
There was one question in the chat. What about the resilience of the reinsurance market? What about the reinsurance market failure of Q4 of 2022? Less capacity and higher prices.
Thank you. Was there possibly a third question? Okay, we'll take that and then you will have a chance to answer. I hope you can mark down your... Okay, so...
Yeah, thanks. I think that just to build a little bit on Javier said most of the things that I would say, except for much more eloquently and coherently. But I think that the way that I think about this is the way that he started, which is that there's a loss, something's been destroyed. And the issue now is who suffers the loss and how do I distribute that loss? And if I want to rebuild, which is a question, who pays for the rebuilding? So the issue of insurance is about the distribution of the loss, not about the existence of the loss. And so I think that's the problem that maybe we have with this equation. Now, what's also interesting is that the history that you have is very, very different, which is interesting. And I thought what was most interesting about your regressions was the recovery was instant. Okay, so that after 2 quarters, I actually get nothing. And that I think is really fascinating. So what happens is I dip down and I go back up. I would check carefully how seasonal adjustment is done in that data, because it may be that what you're looking at is seasonal adjustment that's not taking into account disasters in one form or another. But that's another story. But what's interesting then is that what you're looking at is you're looking at non-climate related, not climate change related disasters, which seem to be not affecting long-run GDP at all, regardless of whether they were insured or not. And that means that they probably were pretty idiosyncratic. At least it looks that way. So anyway, this is the main point though is that this is about risk sharing, and also to get to another point that Javier made. When you do rebuild, creative destruction suggests that you'll rebuild at the frontier of the technology where you may not have been before. So that could actually help you, and I don't really know how to deal with that. But it's interesting, and just for the record, I'm now really convinced it doesn't matter, because your regressions really showed me that it didn't matter.
Can I? So thanks a lot for the questions and comments. Point well taken in the sense that this is a very simplified model. So any idea on how to improve it is very welcome. So let me go to your first point on the capital, the effect of damages or disasters on capital. Of course, capital gets destroyed no matter if it was insured or not. So what we assume here is indeed that if it is insured, it's immediately rebuilt. So this is the simplification and assumptions that we make. So actually in the appendix, I think I have one slide on how we think about the changes in capital and how much it depends on the reconstruction time. And that's exactly where insurance is providing the benefit. That's what we know, for example, for the papers from the papers of Hallegat and co-authors at the World Bank. So there they are more general in the sense that they do not really point to insurance only, but any financial aid that comes after disaster and can support reconstruction activity, being bank-based or insurance-based or government-based. But what we found instead in the empirical analysis and also the BIS paper that we use in the literature is that it's indeed insurance among all these financial aids to have a prominent role in providing prompt liquidity. Normally, government aids are come with, for example, in the form of tax reduction or after many months, and they do not really improve, the status of liquidity or the uncertainty that households and firms face when they have to invest to rebuild. So this is indeed, I think you really pinned to the specific assumption in the paper I didn't mention. So it's right, capital gets destroyed anyway. We assume that the capital that is insured, though, gets immediately rebuilt. It's a simplification. And indeed, your point on the speed of reconstruction, that's indeed how this works. On the empirical evidence, so you mentioned countries with lower insurance may be the ones with no insurable risk, but actually we find quite some heterogeneity across perils within countries. So I think what we have to consider there is that we don't only have the issue of insurance supply or provision, but also insurance demand. And in specific, in some countries in Europe, this insurance demand is very low. It could be for different reasons. EIOPA actually published a recent survey on the demand of insurance that points to questions related to moral hazard. So I'm confident that anyway the government will help me after catastrophe, and risk awareness. If you think of more common perils, yeah, of course you can link it to potential income-related reasons why people do not insure or provision of insurance. But in most of the cases, it's really about being aware of the risk, and I think in that private insurance may be more helpful. And then on the distribution of the losses, okay, it's partly who is going to bear the losses, which I understand it's a key question, but I think it's also a question of the amount of losses. So if you look at the empirical evidence, not only of our paper, but also the BIS one, what we see is that, what the evidence suggests is that the amount, so the impact on GDP growth is decreased if the level of insurance is high enough. Now, the threshold is not clear and probably is per country specific, but it's not only a question of who's bearing it, it's also how you provide this liquidity after catastrophe. So I think there is a ranking, let's say, depending on the speed of liquidity provision and the reconstruction, for which, for example, private insurance come first, and then at the end, government aids in the form of tax reduction, for example. And then on the reinsurance, so I think there is a question of diversification. So how much reinsurance can take of this risk, and because geographically, we see with climate change an increase in the frequency and severity of catastrophe all over the world. So indeed, it's a question how much insurance can diversify across countries and across perils. But there seems to be still some space and appetite. So it becomes more of a question of what is the right premium between for which insurance can reinsure these risks. About the long run, so we do not really test this empirically. So in the empirical part, we only test the first prediction of our model. So if there is any benefit in insuring or not against catastrophes, but we do not include here the effects of climate change, which is the one that we think may have more the impact in the long run. And what we learn from this empirical evidence about the rebound is what we already expected. But it may be very misleading, and this I want to stress, to only look at GDP growth as a welfare measure, Because indeed, it's peculiar that we found a rebound here, so even a positive effect of a catastrophe because of the reconstruction activity. But behind that, there is a misallocation from the optimum, a misallocation of capital from the optimum, because I'm not investing anymore into new activities or new capital, I'm investing in building what was already there. And this is suboptimal, but it doesn't show in the GDP growth number. So this is, the only measure that we could think of, but anyway, an imperfect measure to assess the macroeconomic impact. So I think it is quite misleading to only look at that. If you have any idea on other measures that we could use that are more, that could reflect more this welfare impact, they're highly welcome. But I think this is, quite misleading. Obviously, we don't think it's beneficial for GDP to have catastrophes, right? So thanks a lot for all these comments. Very welcome.
Thank you very much, Margherita. We are running a little bit late, but let's move on to our keynote. Hope we have Alex Jung online, and apologies, Alex, that we are running a little bit late. Let me just very briefly tell about Alex. So he obtained his PhD from TU Vienna in 2012, and is currently a tenured associate professor for machine learning at Aalto University here in Helsinki area. Besides his research, which focuses on the mathematical theory and practical techniques for trustworthy machine learning, so Alex also serves on several editorial boards in this research area. And his textbook, Machine Learning, the Basics, has just been published by Springer in 2022. So without further ado, welcome Alex, and the floor is yours.
Thanks a lot. Can you hear me and see my slides?
Yes, we do.
Yes, very good. Yeah, so as already introduced, and you might guess from my English, I'm from Austria. So just a quick overview of what I do currently. My main research is on federated learning, so where we learn from large collections of data, of local data sets that are, for example, obtained by different organizations or different countries. A more recent research area is on explainable machine learning, and this is what I actually do today. I try to explain machine learning to you. So let's see how successful my explanation will be. In overall, this second research area is also related to regulation of machine learning. So one of my main claims is that regulating and making good use of machine learning needs a handy language. And one of my goals today is to give a glimpse on what I think is a handy language for machine learning. Okay, so you find also a lot of material that is related to my talk today on my YouTube. And yeah, as already indicated, the basis, the solid basis of my talk is the machine learning book that you might consider also for your research. Yeah, so first of all, I like to give a one-slide summary of machine learning. And maybe I disappoint some of the excitement around machine learning nowadays. I guess you have heard about chatbots, large language models. This is all machine learning, and this all follows the same principle of fitting a model to data, period. That's machine learning. So nothing new here compared to what we do since we started to collect data and fit models. So what is it about? Machine learning, I like to define machine learning as the search or the learning of a hypothesis within a model that incurs the smallest loss when predicting the label of any data point. So you see here a lot of terms.
Sorry, Alex, can you put your mic to your closer to your mouth, because I think it's pointing now to the ceiling. Thank you.
Sorry. Thanks a lot. So you see already here several terms that's part of my language that I started to develop for machine learning. And within the keynote, I will try to open up all these terms. So I will talk about hypothesis, I will talk about a model, loss, what is a label, and what is data. As you might guess, we need data for machine learning. Okay, so, but again, just to repeat, and I like to kill this hype or counteract this current hype because it might be misleading and sometimes also dangerous. So machine learning is nothing but empiricism with modern IT. So just read about the fathers or founders of empiricism, at least in Europe, which is, for example, Francis Bacon. And the idea is also there to fit a mathematical model to observe data. But what is now different compared to this empiricism of the 17th or 18th century is this immense development in computational power, computational infrastructure, like cloud computing, supercomputers, and the data. So we have basically we have extended our sensory devices like ears, eyes, tastes, with a lot of IT. So for example, here's one example. I want to see a nest live. This is a snapshot from a live webcam from some bald eagle nest somewhere. Where is it? Somewhere in North America. So we have available sensory inputs from all over the planet and even beyond. So we have now an incredible amount of data available that we can fit, that we can use to fit extremely high-dimensional models. So maybe some of you have heard about these modern ChatGPT models. They have billions of parameters. So these are billion-dimensional models. Okay, so this might sound like a mouthful. So I like then always to step back a bit and try to provide more intuition for what is going on in machine learning. And my claim is that this one of our instincts is to learn, in the sense that we want to make sense. We want to find the patterns underlying what we observe in order to get security, in order to understand the world. Because maybe or at least I don't like uncertainty. I want to know as much as possible and be able to predict as much as possible. So if I show you this sequence here, this is just observed data. How many of you would know what the next sequence element would be? So what would you replace? Which number would you use to replace the question mark? So I'm not sure if this works here. Can we now have comments from the audience, or is this difficult?
Am I supposed to answer?
Yes, you, for example. Very good.
It looks good.
Yes. So what would you fill in for the question mark?
Anybody?
Yeah, ask help from somebody else.
10 and a half was the answer, but I would say 9.
Yes. Okay, so we have now two predictions here, 10 and a half and 9. So these are two possible predictions. Why not? Then, of course, I would ask you why. Why did you predict 9?
Oh dear, looks like a natural continuation of the series.
Yes, so you formed mentally, and this is what I also did, or many of you maybe did, you formed a hypothesis. You formed a hypothesis that explains this sequence of numbers. And this hypothesis, you have visualized a straight line, something increasing steadily, a linear increase or a linear model. And you have tried to adapt this linear model, the slope of the straight line, to these numbers. So there is one number, you go to the next number, you increase by 1. You go to the next number, you increase by 1. So what you did is you have fit a linear model by fixing the slope, by matching the slope of the linear model to this sequence of numbers. And then you have just extended this linear model to make a prediction for the future. Okay, so this is one way. How do you know if this is true? Is 9 the correct answer? Any comments on that?
The answer here is well.
Okay, well, yeah, so per se, you do not know, and I do not know, because I don't remember what I thought when I prepared this slide last year. So I don't know what is the true answer. And this is actually very a good application, or a useful or a nice application when you know the true answer. We call this labeled data. But often in machine learning, we need to make predictions, like a prediction would be now, what is the number instead of the question mark? And we do not know what is the correct prediction. So this is then related to unsupervised machine learning, which I will talk about in a second. But if we would know the true answer, like this would be a teacher who wrote down a sequence of numbers and just removed some of them, he or she knows the true answer or the labels. But sometimes we might not know the true answer. So we just make a prediction. And actually, in some applications, for example, also in politics or in policy making, you can also steer with the prediction. So you have an active influence on the data generating process by your predictions. Okay. Yes, so here's just a visualization, or visualization of what you might have done. You have fit a hypothesis, a straight line, to the sequence of data or to the observations, and extended it then to make a prediction. Here's another example. Here the sequence elements, they consist of two parts, of a geometric figure and a number. So, and this geometric figure I call features. So this is some property of a data point. And another property of a data point is this number, which I call label. So what do you think could be the label? What could be the number that is replaced here by the question mark? What do you think?
One has been suggested.
Yes, so the prediction is 1. And what is the explanation for this prediction? Do you have a justification? So you might have yes.
It's two triangles, and the triangle counts as half.
Yes, because it seems that each triangle has the same area, and the sequence elements contain the same triangles area-wise, but different properties, the colors or the rotation, the orientation, which seems to have no influence on the number. So you basically try to find all the symmetries of the data. So you might have concluded from these sequence elements that rotating the triangle doesn't change the label. So you have learned some invariances in the data. And this is actually what you use when you define integration. So you could define integration by fixing the area of an elementary shape and then require that the area doesn't change under rotations or translations. So you might learn, when you have enough of these examples, you might learn how to integrate, how to compute integrals. I'm not sure how many of you have learned integration in this way. So I would be interested to hear about a university or a high school which teaches integration to teenagers by showing thousands of such examples. Okay, yet another example. Here's a data point, and I would like to know, can you tell me where this is? Where is this place?
No.
No. Would anybody have an idea how to find out where this place is? Is this impossible unless you are working for the CIA or Austrian Secret Service? Or do you have already a tool? Do many of you have a tool at your hand to find out where this place is?
You can try to find it through the pictures, through Google Pictures or any kind of set of pictures.
Yes. So I don't know how many of you have used Google Lens already, and I did this demo sometimes in some of my talks, and they found out. So this place is near the archipelago, near Turku, in this beautiful Finnish coast. And this Google Lens was able for many people who didn't visit this place to spot this lighthouse. Another example is this mountain. So you might find out that this mountain is in Austria by just taking a snapshot with your smartphone and asking Google Lens or searching with Google Lens. Okay, so this is all about making predictions. Yet another more currently popular example of such predictions is the responses of a large language model. So here is one example of a data point, where a data point being a ChatGPT prompt. And the prompt consists of the question or the request: draft me a 1-hour keynote about machine learning for an audience from economics and finance policymaking. And the response, here this response is also a form of prediction. So this ChatGPT trained a model, or is a trained model that tries to predict what is the best answer, which answer pleases me the most. And yeah, so it started with the hint, make an introduction and grab their attention. So that's what I now try to do, basically. For the last few minutes, I try to grab your attention as much as possible, as being the last talk before a nice evening in Helsinki. So this is the prediction. And how does ChatGPT know if the prediction was correct?
By your answer.
By my behavior, which could be I click here this thumbs up button, or more elegantly by how I continue. So I was not too unhappy and I continued and trying to be more. I asked then ChatGPT to be more specific about a certain point. So it predicted first, provide an anecdote. Here it mentioned, it's not here, yeah, provide an anecdote about machine learning in this field. And then I asked to open up an anecdote or a statistic about the impact of machine learning on economics. And it then give a more specific answer. Okay, so machine learning apps like this ChatGPT are nothing but a software that delivers you predictions. So it reads in properties of a data point, like the properties being my question or my input to a ChatGPT window. This is called features X, which I will talk about in a second, and it delivers a prediction or a predicted label. So what ChatGPT implements is nothing but a function. So it's quite. It looks a bit too simple that it's about evaluating a function, but this function is from a very high dimensional space. So as I said, this ChatGPT uses a model or a space of functions with billions of parameters, so billion dimensional function spaces. So then, of course, two questions come up here. How do we know if this function is any good, which I partially answered partially already. So it just looks at how I behave or how I react. And then the next question is how do we find the optimal hypothesis? So this is then related to optimization. And to explain this in more detail, I like to think about the three main components of machine learning, which are the data, which is what we observe, mostly passively. So we observe data, and from ChatGPT perspective, the data might be my input, or might be everything that, who has built ChatGPT? OpenAI, Microsoft is also involved. So whatever data Microsoft has at their disposal, they can use as data. The more data you have, typically, the more powerful things you can do with machine learning. That's why Google is so ahead in machine learning, because they have so much data available, and in particular, very, very rich data that tells a lot about us. We tell a lot about ourselves by what we search, what we ask Google. Second component beside data is a model. Without a model, there's not much we can do with data except storing it somewhere, attaching it to an email, sending it to colleagues. We must learn from data by fitting a model. So we can only learn from data when we fit a model. And the third component comes then in this model fitting. We need a loss function. So these are the three main components of machine learning, and they they come up with, or they have all their design choices. So we have a design choice for what we use as data, what we use as model, and what we use as loss function. And these design choices, they crucially affect the computational properties of machine learning and the statistical properties. Okay, let me start with maybe mostly main component of machine learning, which is data. And I like to define data very broadly in order to not limit ourselves unnecessarily. So data is a set of data points. Okay, so far so good. So what is a data point then? And I like to think of a data point as any object that carries relevant information. So this is, of course, a very broad and abstract definition, which makes it versatile and flexible. So we can measure, we can use this concept for many different application domains. I will touch a few now in the next slides. But it's important always to be very precise about what you use as data points. So this is also related to data engineering. And as I understood, or there are statistics about the time allocation within machine learning projects, and often the majority or most of the work time goes into defining what data points are and acquiring data points. Okay, so a data point could be some time period, could be some day, or a data point could be a month. And this is used in the field called time series analysis or signal processing. I have studied originally in electrical engineering signal processing, and in signal processing we mostly look at data points that represent periods of time. Another data point could be a country. This might be interesting for macroeconomics. So a data point is a country, an entire country like Austria. Another example for a data point could be a particular partial differential equation. So I've heard in my previous talk, I think I heard something about PDAs or differential equation models. As I understood, they're also popular in econometrics. And here we could look at a partial differential equation as a data point. Yet another example, a data point could be a household or a household loan. There might be several household loans for the same household. And we look at each household loan as a separate entity or data point. Okay. Yeah, a data point is an object that carries information, and it carries information in its properties. And in machine learning, we like to distinguish between two types of properties. One type or group of properties is called features. These are properties that one in principle can measure or determine or compute easily in an automated fashion. So features are any quantities or properties of a data point for which you don't need a fancy machine learning algorithm, loosely speaking. The other type or group of properties is called labels. A label is the meat that we are ultimately interested in, the high-level information or the quantity of interest of a data point. So let's look at a few examples. For a data point being a protein, so the features might be whatever we can measure easily in a laboratory with physical devices, and the quantity of interest would be the function of this protein. So would this protein be useful for a COVID vaccination, for example? This is the quantity of interest, and this is what we want to predict. For this, we use machine learning. Another example I've shown here for a country. What could be the features of a country in econometrics? What do we measure? What do we measure in an automated fashion about a country or an economy of a country? Well, whatever comes up in the statistics, in the National Statistic Institute, or a few numbers like GDP. And what would we like to know? What is the quantity of interest about a country? What's the ultimate goal to find out in econometrics?
For instance, the well-being of the population.
Yes, very good. Very good. I like that. This answer is exactly what I wanted to hear. The well-being of the population. That should be the goal, for example. And nowadays we can really use tons of data. Tons of data, of course, limited to data protection law. But I guess in Europe, so I have mostly experience with Europe, there are authorities collecting a lot of data, a lot of statistics. We count the number of students, we have tax offices, tax administration, which knows a lot about our economic well-being. So we have tons of data, but I'm not sure if we have already a good model that turns this tons of numeric data into a predictor of the well-being of the population. So it might be still mostly efficient to run a survey on 3,000 people and ask them, are you doing good? Are you well? Are you happy? Okay, but of course, having such a tool would be handy for policy making, for politicians. So whenever you have think about or debate a policy or change in policy, you could try to ask a machine learning model, if you implement this policy, will this improve the well-being or not? Okay. Yes, so here's an interesting case that shows the flexibility in the design choice for what a label is. So here I have shown a data point is a GPT-4, a large language model conversation or prompt, and my input, so the features, so to say, that is easy to determine for ChatGPT, because I input it in my keyboard. I input the prompt, translate the following word to Bavarian, shaker. So these are the features. And what do you think was the label? What did ChatGPT try to predict here?
The closest word of shaker in the Bavarian dialect. And
Yes. This could be one way, one choice for the label. Does anyone have another suggestion for what this ChatGPT tried to predict?
We don't give the mic away here because we have so many questions, so you have to deal with my answer, sorry.
Okay, sounds good. Sounds good, yeah. So this is perfectly fine. So from this prompt, it might have understood, predict the translation of shaker, which is schüttler, a schüttler. But it turns out, or at least there are some recent papers, research papers, that claim what ChatGPT is actually doing here. It's not only predicting the translation of shaker, but it's predicting how to translate from English to Bavarian. So it does not only predict the translation itself, but it predicts the translator, the translation algorithm. So this sounds now a bit meta, but this hints at this extreme powerful machine learning capabilities, because it not only makes predictions of certain simple quantities like a translation, but it makes predictions about extreme complicated things like how to translate. It predicts an algorithm that can translate from English to Bavarian. And then, of course, once you have predicted this algorithm, you just apply it to one specific word, which is shaker. This is called, maybe some of you have heard this, this is what is known as zero-shot learning, because it predicts a translator from English to Bavarian without being fed thousands of examples, without being fed a dictionary or a dictionary of English into Bavarian. And this is a bit spooky. So it seems in some application domains, this ChatGPT has been trained on simple tasks, like just predicting the next word in a sequence of words, but it has somehow caught up more higher level properties of our language, or higher level structures that are hidden or somewhat embedded in these large amounts of text that has been used for the training. And this parts of these structures are how to translate between different languages. Okay. Yes, yeah, here I also want to mention what you have heard maybe about foundation models. So what a foundation model does is basically it's learned, or it's a model that has learned to predict features, features that are more useful for a certain task. So, and again, here you see that this distinction between features and label is blurry, because here you have a model that wants to predict features, although normally what you want to predict is a label. However, the features that are predicted here by this foundation model are such that they can be used for simpler models, like for linear models. Okay, I just want to highlight again that this, and this might be the most difficult part of applied machine learning nowadays, to choose or to define what data points are, what you use as their features and use as their label. These design choices are guided by computational aspects, by statistical aspects, and by legal and ethical aspects. So as an example here, again, when you look at the data point being a country, then you could use whatever you have at your disposal as features. So for a country, Austria, you could use, for example, every single frame of every webcam recording that is placed in Austria. So immense amounts of data. Or every traffic volume counter that is installed in Austria. And you can use all these recordings since they have been established, since 20 or 30 years. So you have billions and billions of terabytes of data about the single data point Austria. However, you need to process, you need to digest them somehow. So you need to find the most relevant features. And this is still a lot of manual labor. And this is also where domain expertise comes into play. For example, from an economic point of view, if you want to predict the economic future or provide an economic outlook, an economics expert might know it doesn't help too much if you now use all webcam recordings from the skiing resorts in the Alps. Or maybe actually this might be very useful because Austria's economy is relying to a large degree on ski tourism. So there is where domain expertise comes into play. But the fitting of a model, this is now something that is done, that is kind of manufactured already. This training, also training foundation models. This is something you can download from your favorite AI company at a reasonable price. Often they are for free, but also if they demand money, I think it's affordable still to buy such models. The hard thing is to find out which data should you feed into these models. Okay, so now I move on to my second component of machine learning, which is the model. A model, in my terminology of machine learning, consists of several hypothesis maps. So what is a hypothesis? A hypothesis is a map that reads in the features of a data point and outputs a prediction. And again, this might sound very simple, but the features can be billions of numbers. So this is a very high dimensional map or hypothesis map that might be very non-trivial to evaluate. So just evaluating this age of X might be require some highly skilled computer engineering. Yeah, the important thing here is if you only have one single hypothesis, you cannot learn. You can only learn if you have more than one hypothesis. So in the simplest case, the simplest model consists of two hypothesis maps. And what machine learning then is about, find the best hypothesis within the model, within the set of hypothesis maps. And to find the best model, we need a measure that tells us how good is a model doing. So this is then the third component that comes into play later. Yeah, maybe the most popular model is the linear model. So the linear model consists of all linear maps. And maybe some of you have learned or are able to fit a linear model to data points. So if you minimize a specific loss function, the squared error loss, you do least squares regression. So you can do it on pen and paper. But if you do it for high dimensional data points, it's not so trivial already to fit a linear model because it involves inverting large matrices. So this might require already some excessive computation power. Yeah, here an example I found from the conference proceedings. Here a linear model that relates properties of a household loan with the variable y, which is the label, but I don't now remember what was the quantity here. What did y stand for? But yeah, maybe you know better. So this is an example of a linear model. If you consider alpha, beta, and gamma as the tunable parameters. So these are the parameters you want to optimize. Okay. But linear models might be not sufficient for your application because the relation between the features you have or the features you use about a data point and the quantity of interest might be inherently nonlinear. Like if the features are the pixels of an image and the quantity of interest is the confidence in having a cat in the image, then this relation is highly nonlinear. So you need to somehow make the hypothesis map nonlinear. And one way to do this is just to pre-process the data, so transform the original features into new features, and then feed those new features into a linear model. So one such pre-processing could be to create indicator functions. So each new feature, phi, is just an indicator that tells us the original feature was within a certain interval. And if you then apply a linear model to these new features, what you get are these piecewise constant functions. And if you make this interval sufficiently narrow or small, which of course also increases the number of new features, but then you have more and more finer details for the hypothesis map. So you can approximate almost any nonlinear function. Okay, and yet another example of this feature transformation is if you use a foundation model. So you use a powerful pre-trained foundation model applied to your data points, which might be images in this case. And these new features are so nice that you can apply a linear model and get nice prediction results. Okay, so this was the second component. So we have data as the first component. We need to fit a model to the data points. And to fit a model, we need a measure for how good is a prediction. And this measure is what I call a loss. And there are many different ways to get to define a loss function. So maybe most of you know this thumbs up or this like button from Facebook originally. And this is one way to get a loss function. This is one way to tell Facebook's algorithm, yeah, I like this post that you recommended to me, because this post that has been recommended, this is a prediction. A recommender system is nothing but a system that predicts content that you would like to see. And if the prediction was correct, you typically give a thumbs up. So this is one way to get a feedback or a loss function. But there's also more subtle or more fine-grained feedback. Like here, this is one feedback I found on Amazon when I was looking for one of these protectors against snakes and moles. And here, this feedback was quite negative. But you can do more. So you could use a language model to read more specific details out of this feedback to get a more fine-grained loss function. I mean, one loss function in when you want to sell something, when you do a business, the ultimate loss function is, of course, does the customer buy or not? Is the customer happy or not? So this is a very strong loss function, but this is a very coarse-grained loss function. You don't see at which point the customer turned away from your product. Okay, but maybe many of you also know the squared error loss. So This is maybe the most popular loss function when you want to predict a numeric quantity. It's just the predicted quantity minus the true quantity to the power of 2. That's a nice loss function because we can minimize it using gradient methods. So the main computational algorithm to fit models in machine learning and in deep learning is still gradient descent. So you start with some prediction. You try a first prediction, and then you evaluate the error or the loss at this prediction, and then you change the prediction according to the gradient of the loss function. This, of course, only works if the loss function is differentiable. And for many machine learning methods, the loss function is actually not differentiable. So you need to use a bit of more advanced methods than gradient descent. But if you can use gradient descent, then chances are good that you can minimize this loss or fit the model efficiently. Okay, yet another example for loss functions is used in unsupervised learning. So maybe, I guess many of you have used cluster analysis. And also in cluster analysis, what we want to learn is a hypothesis. We want to learn a hypothesis that reads in a data point and predicts the label. And the label is the cluster index or the cluster assignment. But here, of course, in clustering, you never know what is the true cluster assignment. So it's unlabeled data. But still, you can define a loss function. You can define a loss function, for example, as the spread of a clustering result. So you have some hypothesis for the cluster assignments. This results in this clustering, and then you can measure the spread of these clusters. So this gives a quantity that you can then try to minimize by varying the cluster assignments. Yet another example or another class of machine learning that is based on a specific choice for loss functions is called reinforcement learning. So in reinforcement learning, we never have, like in unsupervised learning, we do not have labeled data. And my favorite example for reinforcement learning is the control of an autonomous car. So when you drive, when a machine learning algorithm drives a car, what it predicts is the optimal steering angle of the car. And this prediction is based on the features of the current driving situation. And the features is everything that the car can read in from an onboard camera or from its ultrasound sensors or ultrasonic sensors. So this is again a machine learning problem of learning the best map or predictor map that reads in all the measurements of the onboard camera and outputs a prediction for the optimal steering angle. And what does any one of you have an idea what could be the loss function here? What is the feedback that the machine learning algorithm can use in an autonomous car to find out if the steering angle was now good or not?
Whether the car is staying on the road or not.
Yes, that's a very good feedback signal. So it could use some GPS signal and find out or try to track if the car is on the road in the middle of the lane, not in the middle of the road, or any crash sensors, which is of course a very costful loss function when it's informative. So when this crash sensor provides feedback, then it might be already too late. So maybe you use this GPS signal or distance sensors that measure if you are too close to some obstacle. But you will rarely have data points for which you know the true steering angle, because to get such training data, you would need to spend a lot of time with test cars driving around in all possible conditions. So you cover all possible driving conditions and always record what the test driver, which is an accident driver like Mika Häkkinen, for example, and you record what did he use as driving direction. And this is the true label. So imagine if Mercedes would have to run such a campaign with Mika Häkkinen over a year in all roads over Finland. So it's impossible. You cannot generate label data for such an application. You can only use indirect feedback data like GPS signals. Okay, So I think I'm already towards the end of my talk, so we have enough time for questions. How many minutes would I have?
Around 9 minutes still left.
Yes.
Overall, so you have like 4 minutes maybe?
Yes, thank you. Okay, so this gives me good time to provide a wrap-up. So again, the three main components of machine learning, and this is what I like always to burn into the brains of any student in my course. They must answer this question even if I wake them up in the middle of the night. So the three main components of machine learning are data. Data is a set of data points. Each data point is characterized by two types of properties. The features, which are low-level properties that you can measure easily in an automated fashion. There's no need for intelligent machine learning, just sensors or the like. And the other type of property of a data point is the label. This is the high-level quantity that we want to predict with machine learning. Then the second component is a model. In machine learning, we need models. Examples of models are the linear model, deep neural networks, decision trees, which I didn't talk about today, but you can, of course, read and watch my lectures where I talk at length about this different type of models, or in my book. And the third component is needed to bind everything together. We need a loss function. We need some metric or some objective function that we can minimize. So from an algorithmic point of view, machine learning is a subfield of optimization. Machine learning algorithms are optimization algorithms that continuously try to minimize the loss function by choosing or trying out different hypothesis maps or choosing different values for the parameters of a model, like the weights of a deep neural network. Okay, and yeah, what I like to convince you or try to point out that when you think about these three components, you have a form of a map, or you can map out this really exploding landscape of machine learning models. You hear about a new machine learning model every day, or a new large language model every month. I mean, ChatGPT 4 seems to be like prehistoric already in the meanwhile. It's really a flood of different machine learning methods, but these are all variations on the same theme. These are all variations using different design choices for model or data or loss function. So each machine learning method can be located by telling what is the model, what is the loss function that has been used to training, and on what data has it been trained. And this is also called system cards. So maybe some of you have read system cards of large language models. And what the system cards do is they basically explain these three design choices. Okay, thanks a lot for your attention, and I'm happy to take any questions.
Thank you. Could you elaborate a little bit about synthetic data? Because in many situations we are lacking actual data, and you could use synthetic data instead to train, pre-train, and yeah. Could you elaborate on this field a little bit?
Yes, very good. So the key bottleneck in machine learning is the ratio or a key quantity that tells you or tells us how well will a machine learning method work is the ratio of model dimension, or the size of the model, and the number of training data points. So this is this rule of thumb that I like to say: always try to have 10 times more training data points than number of learnable parameters. So if you have now a modern machine learning model with billions of parameters, this means you should have tens of billions of training data points. And for a country, for example, there are not tens of billions of countries on the planet. So how can you train a more complicated model? Well, you can generate synthetic data or simulated countries like Austria 1, Austria 2, Austria 3, Austria 1 billion. So if you have a model that generates data,
You can basically make as many data points as you wish. And this is the cool thing about generative AI, because it unlocks basically every standard machine learning, a high-dimensional machine learning model by providing enough training data. The only problem is that you need to be sure that the synthetic data that you generate has the right statistical properties. So you typically generate the synthetic data by exploiting some symmetries. Like my favorite example is you can use one cat data and generate 10 cat. You can use one cat image and generate 10 cat images by using rotations by 10 degrees. So 10 times 10 means 100 degrees in total. So you have not even used all of the 360 degrees. So by using these symmetries, and this is what generative AI is doing, it exploits some intrinsic symmetries in the data. Like for cat images, a rotated cat image is still a cat image. So if you have one cat image, you can generate many, many other cat images by rotations. Another example is robustness. So if you have one cat image, then flipping 3 pixels of that image is still a cat image, or flipping 10 pixels of that image is still a cat image. So this generative AI are computationally efficient ways to simulate new data points based on invariances in the data.
Thank you. Is there any more questions from the audience here before we wrap up?
First of all, thank you for an interesting presentation. You mentioned now and then here a little bit on the robustness, which I think is a very interesting thing, because let's say that you have some sort of historical data set, you train your model on it. I mean, what the model is going to do then is basically say, okay, this is what's going to continue happening. So that's a little bit argued, because often this is the thing we try to build into models when we have more sort of expert-based model, that you actually have some sort of overarching theory of what's going to happen. So do you see a sort of challenge there in that the model is it's going to be a little bit limited by the sort of data set you are operating with?
Yeah, so this high-dimensional model, they of course very prone to how should I say, pathological behavior. So when you train a sufficiently high degree polynomial, then you can perfectly fit this data set, for example, here, like this. So you get training error 0, and then it behaves like this. So complete nonsense, or completely unreasonable behavior outside the training set. And there, I still don't see any other method to first of all detect such behavior, robustness problems, then validation. So the validation is the first step to spot such lack of robustness. And the second way to avoid such lack of robustness is regularization. And one way to do regularization is to fall back onto a simpler model, like use a statistical model or a differential equation model that is well established in econometrics. However, this might limit you. So there's this bias variance trade-off. So if you want to be more conservative, you might avoid lack of robustness, or you might buy more robustness, but you pay in the accuracy for it. And this, of course, is a highly active research field to find out more automatic ways to spot any potential non-robustness and avoid it by regularization. And this is highly challenging because, as I said, these models, they are billion-dimensional, and the theory of such billion-dimensional models is called high-dimensional statistics. Yeah, but in general, I cannot offer you much here. So this is still a trial and error.
Thank you.
Thank you very much. Let's give him a hand. And I think this concludes the day of the conference. And thank you, Alex, for coming to this conference. And if we have some further questions, maybe we can email you about this.
Sure.
Now we will continue in the, I think there's some practical information here from the Bank of Finland people. Who wants to take the mic?
Yes, so the speakers, keynotes, and poster people, we have a little bit of time to go to the toilet and so on, and we will leave around 5:20 to the market square to take the ferry to the villa. So be ready to pack up your stuff and head to the bathroom. If you want to go to the hotel in between, you can meet us at before 6 p.m. at the market square. Thank you.
So, thank you for today. See you tomorrow, or maybe in the evening.